on the back of news that we're getting the US and China, forming those working groups to discuss issues related to the economy and finance. So most of the benchmarks in the region are in negative territory. We're seeing the region's benchmark also headed for another day of losses despite gains on Friday, and that was really after those 4 sessions of losses. Let's take a look at how the Chinese property developer Evergrande is faring in trade today, because there were some developments surrounding the property developer. It has said that it needs to reassess its restructuring plan. It's also scrapped some of those key creditor meetings, so raising further questions about its restructuring. And it is also, bringing down some of the sentiments surrounding the real estate sector. And we saw a gauge of Chinese property developers slump by the most since December last year. Rish.
Sort of focusing on SoftBank, they've, of course, made quite a lot of money out of ARM Holdings. In some, or it's all paper anyway. Now they're also looking to raise hundreds of millions of dollars from where?
Yeah, SoftBank Corp is looking to raise about $800 million through a bond-type share sale. And this is expected to attract retail investors because of the brand name recognition of SoftBank Group, as well as the estimated dividend rate of 2 to 4% for the first 5 years. Now we're actually seeing SoftBank Corp, which is where these bond-type shares will be issued, rising along with SoftBank Group and much of the Japanese stock market. Perhaps a bit of an understanding from last Friday, where we saw the Bank of Japan keep those ultra easy monetary policies settings unchanged. Rish.
Avril, thank you so much for that. Avril Hong there joining us out of Singapore. Let's have a look at what's going on in Riyadh now as we get over to Christine Burke. Christine, looking at Middle East markets and, of course, what we've got in terms of the ups and downs, mainly the downs of bond prices and what that's been doing, and the higher for longer sentiment coming out of the Fed. So, Christine, how's that playing out in terms of investors where you are?
Well, thanks, Rich. Let's first go a little bit broad on treasuries here, because bond investors face the crucial decision of just how much risk to take in treasuries, with 10-year yields at the highest in more than a decade, and the Fed signaling it's almost done raising rates. Joining us now is Abdul Qadir Hussain, Managing Director for Fixed Income Asset Management at Arcom Capital. Abdul, great to see you. Thanks for coming on the show. So let's start broad with treasuries markets, because this is a high yield environment. You've got a U.S. 2-year yield trading above 5% and a 10-year yield just below 4.5%. Are you bullish or bearish on the treasuries market in this kind of market climate?
Yeah, I think, Christine, we're less focused on where rates are going and more focused on where they are right now. For the first time in a long time, we have income and we have yield in the fixed income markets, and I think that's what we need to focus on. If you look at the regional markets and you look at regional high grade, you're getting almost 5.6, 5.7% yields and a duration of 7. That means you're protected at about 80 basis points more of rising rates. So I think our focus very much is on earning yield at this point in time. The argument of where rates are going, I think there's a lot of argument on that. We have a view. We do think it's higher for longer, but that's really not the view that's defining our stance. Our stance is there is income right now in the market, and that's what we should be focusing on.
Okay, so you say that you are buying into the Fed's messaging for higher for longer. How does that specifically feed into your views on investment grade here in the GCC?
Yeah, so I think what it means is that duration will be your friend at some point in the cycle. We're not sure if that's exactly right now. So what we're doing is we're favoring sort of the shorter end of the IG bucket, which gives you between 5.5 to 5.8% in the next 6 to 9 months. It's a good place to sit, especially given that the term premium in the region is not very high because of the inverted U.S. yield curve. So it's not like you're going to pick up a lot more yield going longer. The only thing you do is you pick up duration, which would be great if you were certain that rates were going to come down and come down aggressively over the next 12 months. Since we're not, we rather take the shorter end for now, wait for more data, as the Fed has said, be more data dependent, and as those positions start rolling off over the next 12 months, move those into longer duration positions. So that's kind of how we're managing the landscape right now.
Okay, and we've talked about duration here, and we've talked about investment grade. What about high yield? I know that you said in your latest research that investment grade is what you prefer, but what about high yield?
Yeah, I think that, given the risk reward right now, and given where absolute level of spreads are, it doesn't make a lot of sense to delve into high yield. I think that, typically you either take credit risk or you take duration or interest rate risk to generate yield in your fixed income portfolio. At this point, for a large part over the last 5-7 years, we've been taking credit risk to do that. But I think now it's the time to focus more on duration. I think the high yield stories, the good high yield stories like Oman and maybe Bahrain to some extent are too tight. And the poorer ones like Egypt and Pakistan and stuff, I think have too much risk at this point to really delve into in any significant manner.
Okay, and what are your top picks in the region at this point in time?
So we like the short end. Like I said, we like the short end in Aramco. We like the Aramco. We like the short end in OCP. Some of the short end bank seniors. And then if we are going to go into the long end, we'd have a little bit of a barbell. We go sort of super long end, and we like Oman in the long end on a credit improvement story, and then PIF and EIG Pearl, which is the project bond, more on valuations.
Okay, quickly, last one here on oil. Where do you see things heading in the fourth quarter?
Yeah, I think we are given the supply constraints. I think we are going towards the 3-digit numbers. I think that means that the regional sort of economic trends and the regional credit metrics are continuing to strengthen, particularly Oman, which I think now is pretty much definite to be investment grade in the next 12 to 15 months, in my view. Even though that's 2 notches, but I think at this rate, oil is going to, the momentum in oil is going to help the region significantly.
All right, well, we'll leave it there. Thank you so much, Abdul. That's Abdul Qadir Hussain, Managing Director for Fixed Income Asset Management at Arqam Capital. Rish, back to you.
Thank you, Christine. Christine back then, Riyadh for us. We've got a lot more coming up on the program, including a look at what's going on with the oil price and indeed more. With Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Daybreak, Middle East and Africa. We are now talking about the chief economic advisor to the German Chancellor, Olaf Scholz, saying Europe, quote, shouldn't be too nervous about the US Inflation Reduction Act. Now, speaking at an Atlantic Council forum in Berlin, Jörg Kugis also revealed that Germany's earmarked some $119 billion to invest next year in decarbonization.
on the discussion in Germany around the Inflation Reduction Act, and I'm sure that is exactly what you're getting at with your question. So we may as well name the elephant in the room if it's walking about so visibly. We have taken a quite differentiated stance, right? On the one side, of course, we voice this in all of our bilateral discussions, that we think localization of production rules are not in the interest of global free trade. However, on the other side, we also acknowledge that, first of all, it is extremely positive that the United States launches a program of several $100 billion that will help progress the cause of decarbonizing our economy and achieving climate neutrality, and therefore putting their money where their mouth is, right? Just like Europe is doing. And if I compare the economic size of the United States of America and the European Union, and if I compare the amount that the United States of America is spending to progress that aim through direct fiscal support of different industries, it's not like the sheer size of what the US is doing is larger than what the European Union is doing. I mean, this year alone, we just passed a budget where Germany next year will invest 112 billion euros into the decarbonization of our economy through support to citizens, through support to companies, through support to projects, which is pretty similar to what, in principle, the US is doing on the Inflation Reduction Act. So in that sense, given that we have the fiscal power and the fiscal willingness to do similar things in size as the US with the Inflation Reduction Act, and as I said, qualitatively, it's not that different, I think we shouldn't be too nervous about what the US is doing with the Inflation Reduction Act. I think Europe has to wake up, in a sense, to the policy design that the Inflation Reduction Act is making, instead of the European approach.
German Chancellor Olaf Scholz, Chief Economic Advisor, speaking at an Atlantic Council Forum in Berlin. Now, let's have a look at some of the other geopolitical stories we're watching. The People's Liberation Armies urged Chinese military personnel to be careful about who they associate with. The state-run PLA Daily says cadres should purify their social circle, warning that some leaders have been removed after socializing with the wrong people. The commentary follows the removal of Qin Gang as a foreign minister in late July, and also Defense Minister Li Shangfu's disappearance from a public view. Armenia slammed the lack of support from regional allies and security blocs in its conflict with the neighboring Azerbaijan. The Prime Minister, Nikol Pashinyan, said in a televised address his country is no longer being protected by allies without directly naming Russia. His remarks coming days after Moscow decided not to intervene in Azerbaijan's military operation to take control of the disputed Nagorno-Karabakh region. A top confidant of the Israeli Prime Minister Benjamin Netanyahu says he thinks a landmark deal which would normalize relations with Saudi Arabia will be agreed on within a few months. Bloomberg's Abir Abu Omar is in Dubai. And Abir, what did we learn from the Israeli Strategic Affairs Minister?
Good morning, Grish. So yes, this is Ron Dermer, who is Prime Minister Benjamin Netanyahu's Minister of Strategic Affairs, and he said in an interview that we had earlier that, listen, this deal with Saudi Arabia, between Israel and Saudi Arabia, is very close to happening. He said within months, he said either by the end of this year or shortly after the end of this year. Now, this comes after the interview that Crown Prince of Saudi Arabia, Mohammed bin Salman, had with Fox News last week, where he said every day we're getting closer to normalizing deals with Israel, but this deal is hinging on a couple of things that Saudi Arabia is asking of Washington. Those include security pacts, those include possibly a uranium enrichment program, but the Israeli confidant of Benjamin Netanyahu said that, listen, we're aligned with the US on this. We know that this is what Saudi Arabia wants, but that deal is still close to happening.
Now, at the same time, we've got Washington really going to put pressure on its allies in the Gulf here to actually cooperate on Yemen. What's this really all about?
Yeah, so this is again an interview that we had with the special envoy to Yemen, Tim Linderking, who said that, listen, this war has been going on for 6-7 years now. It needs to end. There seems to be some genuine effort for, from allies of the U.S. in the Gulf to see this war ending. Those are Saudi Arabia and the UAE. We did report earlier that there's a rift happening between those two countries that is sort of standing in the way of the Yemeni war ending. But talks are still happening. The U.S. is still in talks with its allies, Saudi Arabia and the UAE, to see some kind of deal happening between the rivaling group that they're both supporting in Yemen. So this is what we have. We've seen some genuine effort over the past couple of years to stop this war from the UAE and from Saudi Arabia, but now it looks like it might actually materialize.
Abir, thank you so much for that. Abir Abu Omar there. They've got a lot more still to come on the programme, and just taking a look at some of those stories making headlines, and also look at the markets.
This is a project by the Bronx, for the Bronx, and of the Bronx. Bronx Point is the 500,000 square foot building that is going to include more than 500 apartments that are all affordable, and the permanent home of the Universal Hip Hop Museum. I know the importance of having a bank that does what it says, and no one does that better than Wells Fargo. The Bronx is the birthplace of hip hop. This is a project that the Bronx can be proud of.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Now, the Greek Prime Minister says his country could benefit from a warming climate because it may extend the tourist season beyond the traditional summer months. Kyriakos Mitsotakis told us that Greece needs to focus on short-term adaptation to global heating while still trying to reduce its causes long-term.
Climate change is an opportunity for us to expand our tourism season. Yes, it may be hot to come to Greece in July and August, but we will always have enough people interested to come to Greece during those 2 months. But we have now more people interested in coming to Greece in March and April, or October and November. More people interested to come to visit our cities year-round, and expanding our tourism season has always been an important priority for us. And I think, Guy, that there will be more people who, given the choice, will choose not to take their holidays in July or August. Not just because it may be too hot, but because it's too crowded. So for us, it's a great opportunity to expand our tourism season and also to open new destinations on the mainland for people to explore. So there's still it's still going to be some time until the Scandinavian beaches or the Danish or Swedish beaches are going to compete with the Greek beaches. I don't see this happening anytime soon.
I'll pass that message on next time I see them. You did face some criticism, though, in the way that you handled the wildfires this year. What lessons do you think you learned?
Look, I mean, the climate crisis is here, and it's here for good. We've always had wildfires in the Mediterranean, but we had particularly intense wildfires this year, and we also had unprecedented floods. So it's very clear that we need to focus more on short-term adaptation. And this is, of course, a case I'm also making to my European colleagues. We spend trillions of euros on long-term mitigation, and rightly so, because we want to be leaders in the climate transition. But we also need to support people when they lose their livelihoods, their houses, as a result of climate disasters today. So we need to be much more effective in dealing with these disasters. We've made good progress. For example, in Greece, we have a 112 emergency number, which we used very successfully to evacuate people and make sure that we save lots of lives. This is something, for example, that was not present in Maui. And when I look at the Maui disaster, it's so painful because we had gone through similar disasters 5 years ago, but we learned from them. And we are using technology in a much smarter way today to make sure that at least we can save people's lives.
The climate crisis is going to cost more money in terms of either dealing with events or also where you get your energy. Where are you going to get reliable, affordable energy from, and where do you get it?
Well, first of all, we get it from the wind and the sun. We are
affordable.
It is affordable. It is
reliable.
Cheaper. It is cheaper. It is reliable because we have lots of sun and lots of wind. But of course, it will not do the trick on its own. But Greece is one of the top 10 producers of renewable energy from the wind and the sun. We have 12 gigawatts of installed wind and sun energy in Greece, and much more to come. But of course, in the short to medium term, we will also need to rely on natural gas as a transition fuel. And there's a case to be made that Greece is playing a very important role in the European energy system, because we are also an entry point for natural gas to serve not just the Eastern Europe, but even pumping gas up to Ukraine. So Greece's role as a pillar of geopolitical and energy stability in the Eastern Mediterranean has certainly been enhanced after Russia's invasion into Ukraine.
That is Greek Prime Minister Kyriakos Mitsotakis speaking with our colleagues Guy Johnson and Alex Steele. Let's have a look at a couple of stories making headlines in Europe. We got President Emmanuel Macron saying that French troops will leave Niger by year's end, bowing to the demands of a junta in the former colony after a coup that upended France's strategy in Africa. Withdrawing France's roughly 1,500 troops marks a reversal for Macron, who previously rejected a September deadline by the coup leaders and said that he'd only do so at the request of the ousted president Mohamed Bazoum. British Prime Minister Rishi Sunak is facing growing anger from business leaders and politicians as he weighs whether to shorten a flagship rail project that may cost Britain $122 billion. Sunak and his Chancellor are locked in talks over concerns that the cost is spiralling out of control. A decision may come as early as this week, and that would be before the Conservatives gather for their annual party conference. Let's have a look at markets. Equity futures at the moment indicating gains for Wall Street, not so much for the Europeans. We're looking at oil very much at the fore of things as Saudi Arabia's curbs there definitely are not going away anytime soon, with the Riyadh that seemingly unflinching at this time. Inventories also on a downward arc here as well. Plus we've got this ban of on diesel and gasoline exports from Russia. That's playing out on the oil market, and this is something that we're watching, of course, here as well, and looking at the Treasury market with 10-year yields at 4.45%. So that's a look at those markets. Let's have a look also where we have the yen, 148 yen 35 cents, with the dollar pretty much unchanged. But that's the crude price regaining some of the losses that it endured last week.
43% of employees have been the target of a work-related phishing attack on their personal device. With Chrome Enterprise's built-in browser security, IT teams can proactively protect workers from data loss, phishing, and malware wherever they get work done.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Good morning. Welcome to Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. Stocks across Asia trading lower as those property woes continue to weigh on sentiment. The yuan fixing already rattling markets in the FX space. Meanwhile, the property woes continue. China Evergrande Group running out of time to get its restructuring back on track. Chinese property stocks taking the biggest hit. Now, over in the EU, the chief trade negotiator warning Beijing that during a trip to China, the bloc will be more forceful in upholding fair competition and defending its interests. Let's get a quick check on the markets here. A lot of geopolitics to really digest. What is the market read-through? Because if you take a look at what Asian markets are doing, we're going to get an update in just a moment. But really, sentiment is low. A lot of red on the screen. Perhaps some of that flowing into the European indexes as well. You are seeing the Eurostoxx 50 down about 0.2%. The FTSE 100 following in that lead. A real defensive tilt, though, to the rest of the session, because take a look at what S&P futures are doing, higher by 0.3%. NASDAQ 100 futures not far behind, about higher by 0.4%. I think what you need to know is risk sentiment around the world is lower, which really creates a bid for tech broadly and a lot of the defensive assets across the pond. Let's look at across the board and talk about the Treasury market here, because the 10-year yield is moving as well. 446 on that note. You were already seeing a move higher by about 3 basis points, and that in theory is going to strengthen the dollar a little bit. So on the surface, euro dollar is weaker. 1.065 is what we'll call there, but again, not too much reaction. A lot of that's going to change when we get the German IFO data later this morning. Brent crude hovering around $94 a barrel. NYMEX crude not far behind at about $90 a barrel. So again, if you were believing inflation is here for longer, oil is your friend. That seems to be the trade at play this morning. Time now for our top stories of the day. I'm joined now by our reporters from around the world. Avril Hong, Kevin Kingsbury, and Valerie Teitel join me. Let's start with you, Avril. Let's talk about how markets are faring in Asia right now and get the market update out of Singapore. Walk us through it.
Yeah, we're seeing Asia stocks headed for another down day, and a lot of this has to do with a bit of a hangover from last week where we really felt that higher for longer narrative, and that is translating into some of the losses and the fragile sentiment in the region today. But on top of that, we have those concerns about the Chinese property sector, and that is overshadowing any pocket of optimism that we're getting on the back of news from the US and China forming working groups to discuss issues related to the economy, related to finance. Now, the MSCI Asia Pacific headed for another session of losses, and really at the center of it all is Evergrande, after it said that it is reassessing its restructuring plan. It's also scrapped key creditor meetings that were scheduled to take place early this week, raising those concerns about liquidity woes in the sector. We also have XAUUSD, another company very hard hit after resuming trading, slumping by the most on record. And just to give you an idea of how much sentiment has been hit in the sector, we're seeing the losses of valuation of about $55 billion so far this year, just based on the losses that we're seeing on one of the gauges of Chinese property developers that slumped by the most since December last year. Kriti.
A lot to digest, and I think the most shocking thing is on a percentage basis, you see these massive moves in Evergrande and Country Garden, but then at the surface, they are, at the end of the day, penny stocks, not reflective of just how important they are to the global economy. Avril Hong in Singapore with that report. Let's dive into a little bit more detail of what Avril was just talking about, specifically when it comes to Evergrande. Joining us with those details, Bloomberg's China credit editor in Hong Kong, Kevin Kingsbury, joins the program. Kevin, give us the update here. What exactly happened over the weekend?
Sure. So Evergrande said late Friday, as Avril mentioned, that they would no longer go forward with debt restructuring votes that were scheduled for this week. The company said that after talking with creditors and advisors, and in light of sales declining over the past 6 months, not just for Evergrande, but for the sector more generally, it's decided that it needs to go back and kind of redo and relook at the offer that it was originally made back in March. And then on Sunday, the company said that because of an onshore investigation involving one of its key units there, it won't be able to issue dollar bonds based on the debt restructuring plan. Now, new bonds was a key factor in the original plan, along with equity of both Evergrande, its property management unit, and its new energy vehicle unit. Equity of all three of those have only been resuming the past 6 weeks or so, and they're all down at least 70% since trading resumed. So there's definitely a question as to exactly how much recovery the creditors can get.
And what are the implications here? When you talk about those developments you just walked us through, talk to us a little bit about restructuring some of that offshore debt as well. What's that even look like?
That's the question right now, because Evergrande was definitely going to be one of the most complex and biggest debt restructurings ever for China. And now that we are here 21 months after it initially defaulted and is seemingly going to have to redo its debt restructuring plan, it does raise questions as to whether some of these other developers who have already defaulted and are undergoing their own debt restructuring efforts, how complex they're going to be, whether they too might need to kind of reconsider compensation to the creditors.
Certainly something that we're going to be keeping a very close eye on. I mean, again, I can't emphasize enough how important the property story is for the global economy. Kevin Kingsbury there walking us through that crucial story in Hong Kong. We thank you as always. And speaking of the global economy, we're watching the Chinese property sector, and I imagine the Fed is as well. There's a lot to digest on top of the comments coming out of Giorgia Meloni and, of course, the SBB updates out of Stockholm as well. Let's bring in Valerie Teitel, our markets reporter here, because she is all over those stories, a lot of different cross currents. What's the top of your agenda?
I am very interested to see how Italian markets trade this Meloni tax update, this escape clause she seemed to have introduced to the bank windfall tax. Maybe the market will read it as a way for the Meloni government to get banks to hold more Italian debt, because at the crux of this, in the detail, rather than paying that one-off windfall tax, these banks can use that money to bolster reserves instead. Perhaps the market will read through this, that this is a way for Meloni's government to incentivize banks to hold more Italian debt on their balance sheet, which would help bring borrowing costs for the Italian government down, and perhaps allow Meloni in the end to spend more money. Now, investors are really watching Italy closely if the government will maintain fiscal discipline amid this slowing growth that Italy is dealing with, and perhaps this is a backdoor way for Meloni to shove those problems aside and continue spending.
And that's just the Italian story. I mean, we, of course, watch the BTP to Bund spread so very closely. Talk to us about the German story here as an extension of what we're seeing in Sweden, for example. Over the weekend, I think the most read story on the terminal was that saga with SBB. I'm not even going to try to pronounce the real name. I know we've already gone through our iterations of that. Why do we care about Sweden when it comes to the broader continent?
Well, look, I think we can draw read acrosses to if Sweden is dealing with the housing market having issues with higher rates, maybe it's not long until we see a similar problem crop up in Europe. And most people have their eye on Germany. We got some data from Germany on Friday that showed German housing prices are slumping the worst on record last month. So many have their eye on a possible read across to Germany with that situation with SBB going on in Sweden.
And I think it's such a great case study, right? Because we talk a lot about the housing market, I think in the UK specifically, and what that means for global economics. Then we talk about it, well, maybe a different story, but kind of related for Europe and for Asia. For the US, a lot of people are saying, well, look, there's so much demand right now, specifically in the housing market. When do you see that pop? Are we in some sort of 2005, 2006 deja vu kind of moment? Where do you think the Fed stands on that?
Well, it surely doesn't help. We had some hawkish Fed speak happen on Friday. We heard from Boston's Susan Collins calling further tightening certainly not off the table. And then we also heard from Governor Michelle Bowman signaling not one, but two more hikes might be on the table. She used the word plural to describe hikes, saying, I continue to expect further rate hikes will likely be needed to return inflation to 2% in a timely way. Now, note, Critty, most banks across the street think the Fed is done. Morgan Stanley's Ellen Zettner still predicts the FOMC will stay on hold, and that chimes with most of the banks across the street are not necessarily agreeing with this hawkish Fed speak, but it's notable, Critty, that they're out there chiming very much with what Powell told us, even ahead of all these risks on the table, one of which for the market being the government shutdown that could possibly go through by the end of this week.
And the immediate impact you're going to see, of course, in the Treasury market, but also the S&P 500. And I think Torsten Slot came out with a chart over the weekend basically saying that if you look at, say, the one-year chart of the S&P 493, so essentially taking out those big tech names, it hasn't really moved all that much. And in fact, the majority of the gains, as we know, the winners are going to be your heavyweights, but it's kind of flat. So what happens here? Is this kind of the trigger for a broader correction in the S&P 500 if that shutdown does in fact happen?
It was very interesting to see the S&P equal weight index basically flat on the year. So it goes to say the weight of those big tech stocks really dragging a lot of the equity indices higher this year. But if you strip them out, there really hasn't been a lot of progress in the equity markets. And look, I think this government shutdown is just another possible hit to growth that economists and people in the market have to deal with. Remember, it's not just the government shutdown. It's also the student loan repayments that started back at the end of this week. It's other consumer headwinds on the horizon that we have our eye on. But Critty, this is not the first time we've gotten excited about a possible turn lower in U.S. economic growth, and it continues to surprise again and again. We do get another estimate of the second quarter GDP out of the U.S. Later this week ahead of U.S. PCE on Friday. So maybe that'll do a bit to change the narrative. Maybe we'll still see that consumer strength in that GDP print this week.
I mean, again, it's all really connected. We treat these as kind of isolated stories, but really around the world, weakness in the property sector, weakness in the manufacturing sector, and already some weakness in the markets as well. Valerie Teitel, over all of those developments, we thank you as always. And as we talked about that German data coming up at 9 a.m. UK time, we're only going to get an update on that. We're also going to get a fantastic guest to talk about it as well, how the outlook for the EU's largest economy is looking as we head into the winter months. We'll, of course, be speaking to the IFO Institute President Clemens West coming up at 9:10 a.m. London time. And coming up on this program, President Biden says
by 2050, half the world's population will live in areas that don't have enough water to sustain life as it is today. But the global beverage industry has proven that solving that water crisis could also help combat climate change.
On average, we can help beverage companies reduce water usage by 25%, which results in a 12% reduction in energy and a 6% reduction in greenhouse gas emissions.
If companies want to make a difference on a global scale, they should transform the way they think about water.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then personality behind it. The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to Daybreak Europe. Look, this is the program where you wake up and you find out exactly what happened overnight, the stories that you need to know. And a great place to also get that on your Bloomberg terminal is in today's edition of Daybreak. You can type in DAYB Go to look at all the top stories. Of course, Chinese markets at the top of that. In addition to this, Nomura losing one of its senior bankers, that according to the FT. You also have, of course, an update on Giorgia Meloni's latest development in those windfall taxes. And, of course, the Hollywood strikes. Finally, a deal perhaps being made, and that's crucial as we talk about a new labor agreement between, like I said, the Writers Guild and studios, including Walt Disney and Netflix. Global business editor Karen Lee is all over that story. She joins us now. Karen, this has been in the works for a while. I think we've been striking since early May. What do we actually know about the deal itself?
We have been striking since early May, and this is the first writers' strike in Hollywood since 2007, which shows you just how big the issues are for the writers. So what we're dealing with now is a tentative agreement between the WGA and Hollywood studios. This hasn't been ratified yet. It's a tentative 3-year agreement, but once it is ratified, it's going to be what the WGA calls, it's going to give what the WGA calls protections and gains to its more than 11,000 members. And it's going to give Hollywood hope that maybe now a concurrent strike by the Actors Guild, SAG-AFTRA, could also come to a conclusion, because this is something that's really brought Hollywood to a stop over the last few months. And we're heading into award season now. The studios want to wrap this up as we come into the end of the year.
I definitely want to be there for award season, see what that looks like. Let's talk a little bit about the impact here to the broader economy, because, Karen, if I remember correctly, the last time we saw a strike of this size from the Writers Guild was back in 2007, and the damage done was billions of dollars on the industry. I think California as a whole, percentage-wise, didn't see as much of a hit. This time around, how much worse is it?
I mean, this has been billions of dollars to the LA economy already, and you have to remember, this is a city that lives and breathes Hollywood. This is the biggest show in town, quite literally. And you think about everyone from restaurants to makeup artists to hairstylists who are dependent on the industry, and they've taken that hit. And in addition, the studios, who employ thousands of people, have been unable to release their slates the way they normally would, have been unable to put new shows and movies out into the world. So this is something that's really affected not just entertainment, but business, people's livelihoods. Everybody on both sides wants it to come to a conclusion. And while today's news is terrific, at the same time, you have to remember that SAG is still striking. That's nowhere near conclusion, and we're going to wait to see if the momentum from today's deal rubs off on that strike as well.
And a big part of that story is, of course, AI. When are we going to see the actors back in work, back to promoting a lot of their major movies? Global business editor Karen Lee will be monitoring all of it. We thank you, as always, for joining the program. We'll stick with the theme of labor at the moment, because it's not just Hollywood that's striking or that's discussing a deal. It's the auto workers as well. President Biden says he will travel to Michigan on Tuesday to support striking United Auto Workers Union members. He's joining the picket line, essentially. His announcement comes as GM and Stellantis, but not Ford, are facing walkouts at 38 more facilities after talks last week failed. Let's get the latest. Bloomberg's Oliver Crook has been monitoring this very, very closely. Where are we on negotiations?
Yeah, Grady, so as you mentioned, an expansion to 38 different plants and across 20 states. And we should mention that these are really the part plants. This is the assembly of kind of the big profit centers for the big three. So again, the union trying to keep some of its powder dry and Ford being spared. So we know that conversations have gone through the weekend. We've got nothing really concrete from that. We know that everybody's at about 20% increases, but still, what is really the thorniest issue are the things that are not dissimilar to what you were talking about. The writer's strike is how this future of this industry looks like, and what are they going to do in terms of guarantees for jobs in the future. And even Ford, that has had sort of the most significant progress with the union, says that these issues are very complex, they're interconnected, and that there are still significant gaps to close. So what's interesting, if you look at what happened in the kind of the background last week in Canada, where you had the threat of a union strike against Ford, they came to an agreement, 15% increases, and now we understand the union is going to take that to kind of go and negotiate with GM and Stellantis. So we wonder if there might be some similar divide and conquer going on for the United States as well.
And on top of that, a political dimension to this as well, because Ollie, when I think Democrats, I immediately think, look, they're appealing to blue-collar workers, they're appealing to unions, but they're also appealing specifically to Detroit. How does this get more relevant going into 2024?
Yeah, so we're really at the foothills in American political terms of the election, and these are absolutely key states, right? We're talking about Michigan, Pennsylvania, Wisconsin, and we have the Democrat. Went from Democratic to Republican in 2016, then back in 2020. So these are really key states for both Biden and whoever is nominated on the Republican side. And Biden is going to join the picket line on Tuesday. He was called by Sean Fain to join them, and he really answered that call. And this is really a sort of event without a great deal of precedent in human history. And then Trump on Wednesday is going to go speak in Detroit in front of some auto workers, but also other blue-collar workers. Again, all just trying to woo this demographic here. What's interesting is last week Sean Fain had a statement out saying that we can't keep electing billionaires and millionaires and that don't have any understanding of what it's like to live paycheck to paycheck and struggle to get by and expecting them to solve problems of the working class. So really Sean Fain playing hardball here and really not giving it to anybody, but saying that really it's this political class that really maybe does not understand fundamentally what these workers need.
Really fascinating words coming out of Sean Fain, because historically, I believe the UAW has endorsed Democrats for the 2024 election. Now, clearly, to your point, Ollie, both President Trump and President Biden fighting for that endorsement. Very quickly, how much longer could this go on for?
So very quickly, if you'll indulge my sort of non-CPA math on accounting. So if we look at the strike fund, right, it's $825 million. They get $500 a week for every striking worker. There are 18,300 workers striking. That means $9 million a week. That could go on for 90 weeks, right? So this is part of the whole union's ambition of keeping things ambiguous and keeping a lot of dry powder critically. So, this is only 12% of the union striking right now. There's still, 100 and some odd thousand workers that could walk out. And there's a lot of inventory left, but now with the parts working out, walk out, you're going to start to see dealership and servicing, which are high margin parts of the industry that might come under pressure.
Oliver Crook bringing us the update and the math this morning. We thank you, as always, for joining the program. Let's look at some of the other stories we're following from around the world, kind of in the same theme, because, again, striking not just here in the States, but in France as well, where Apple workers began striking over pay and working conditions on Friday as the launch of the iPhone 15 was underway. Staff at an Apple store in Barcelona were set to join their French colleagues. It all follows a French mandate earlier this month requiring the tech giant to stop selling its iPhone 12 model in a probe that Apple disputes. And over in the States, Congress heads into a make-or-break week for avoiding a government shutdown. Leaders of the Republican-controlled House hoping that they can persuade GOP holdouts to get on board with 4 full-year bills and a short-term funding patch. A shutdown is set for October 1st unless Congress acts. Of course, if no deal is reached, hundreds of thousands of federal workers are set to be furloughed. And from D.C., back to New York, John Corzine, the former co-chairman of Goldman Sachs and governor of New Jersey, will shutter the hedge fund he started after the collapse of MF Global Holdings. It's a move that marks the end of his bid to rebound from one of the largest bankruptcies in U.S. history. The firm's loan investment vehicle has about $510 million of gross assets at the end of last year. Now, coming up on the program, we go around the world. Armenia has slammed the lack of support from regional allies and security blocs in its conflict with
connections. For over 200 years, they've been city's business. From connecting oceans and continents by helping finance the Panama Canal, to today, where we're still making our most important connections, people. We connect security, and innovation, all to help drive growth. Our global scale connects businesses to over 160 markets, and today's ideas with tomorrow's opportunities. For the love of moving businesses forward, for the love of progress, Citi.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Welcome back. This is Daybreak Europe. I'm Kriti Gupta in London. Now some headlines from around the world. The chief economic advisor to German Chancellor Olaf Scholz says Europe shouldn't be too nervous about the U.S. Inflation Reduction Act. Speaking at an Atlantic Council forum in Berlin, he reveals that Germany has earmarked some $119 billion to invest next year in decarbonization. Now, German Chancellor Olaf Scholz, chief economic advisor, was indeed, like I said, speaking in Berlin over at the Atlantic Council. I want to really emphasize just how important this is. It's really crucial as he talks about kind of making his way not just in his kind of allies around the world, but also simply the idea that he is now competing with the likes of Emmanuel Macron and others to really incentivize investment coming back to the continent. So that is going to be crucial. I want to bring you some of the other stories we're following from around the world. The Armenian prime minister said his country is no longer being protected by its regional allies and security blocs in its decades-long conflict with neighboring Azerbaijan. The remarks come days after Russia decided not to intervene when Azerbaijan began a short military operation to take control of the disputed Nagorno-Karabakh region. More than 1,000 people crossed the border into Armenia from the breakaway region, with more expected to follow. Over in India, Indians holding 2,000 rupee banknotes have less than a week to deposit or exchange them with banks before the RBI withdraws the bills. After September 30th, the notes won't be accepted for transactions and can only be exchanged with the central bank. About 7% of the notes were still in circulation at the start of September. Now, in space news, a NASA capsule containing chunks of an asteroid that may hold clues to the solar system landed in the Utah desert on Sunday. NASA says it marks the first sample return mission of its kind. The mission launched in 2016 and scooped up a large sample of rocks from a near-Earth asteroid named Bennu. A lot to digest there, a crucial moment for those who love to look at space, but also a crucial moment, I should say, for geopolitics all around the world. And that brings me right back here to Europe, where, of course, we are looking at some of the developments over the weekend, specifically coming out of Italy. Now, of course, we know Giorgia Meloni perhaps backtracking some of the moves about that windfall tax for some of the Italian banks. Well, look, let me tell you why it's so crucial here, because, of course, we know we watch the debt to GDP ratios across Europe very, very well. Italy standing above at about 1.4%. That is the chart you are seeing on your screen right now. The reason this is so important is simply because there are questions about whether the Meloni government could actually incentivize Italian banks to hold more BTPs. Does this, at the end of the day, create a little bit more affordability for the Italian bank. At least is the understanding. We're, of course, going to be walking into that monitoring that very, very closely in the hours to come. When it comes to the broader markets, you are seeing, again, weakness in EUROSTOXX futures right now, and that's going to be weakness that's really being pulled over from the Asian markets as well, down about 0.2%. FTSE 100 not far behind it, down 0.4%, but a defensive bid at play here with the futures market in the U.S., where NASDAQ 100 futures outperforming about 0.4%. We're going to bring you all the latest updates on the
By 2050, half the world's population will live in areas that don't have enough water to sustain life as it is today. But the global beverage industry has proven that solving that water crisis could also help combat climate change.
On average, we can help beverage companies reduce water usage by 25%, which results in a 12% reduction in energy and a 6% reduction in greenhouse gas emissions.
If companies want to make a difference on a global scale, they should transform the way they think about water.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
This is Bloomberg.
Good morning. Welcome to Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. Stocks across Asia trading lower as property woes continue to weigh on sentiment around the world. The yuan fixing, rattling FX markets as well. And sticking with the property story, China's Evergrande Group running out of time to get its restructuring back on track. Chinese property stocks taking the brunt of the hit. And over here in the EU's chief trade negotiator warning Beijing during a trip to China that the bloc will be more forceful in upholding fair competition and defending its interests. A lot of geopolitics at play, a lot of it stemming out of China as well. Let's get a quick check on the markets and simply the sentiment that you are seeing already souring around the world. Again, this is really a function of the pain you've seen in the Asian markets. We're going to get to that in just a moment. Right now, EUROSTOXX 50 futures down about 0.2%. Some underperformance right here in the UK. FTSE 100 futures down 0.3%. But around the world, in the face of that souring sentiment, you are seeing a defensive play come out right now. And a lot of that shows up in U.S. futures. And by the way, U.S. assets broadly, essentially, if you're panicking about the world economy, you buy American. That has been the playbook for decades to come. S&P futures higher by 0.3%. NASDAQ 100 futures are the outperformer, as I said. But let's go to the Treasury market here, because that's where you're seeing yields higher. Now, a lot of this is simply this idea that inflation may be here to stay. Those Fed comments from over the weekend perhaps having an impact as well. But that 10-year yield higher by about 3 basis points, pulling up the dollar and arguably pulling up oil and commodities as well, whereas you're seeing Brent crude higher by trading at about $94 a barrel. NYMEX crude right on its heels at about $90 a barrel as well. And again, it really all comes back to that global economy, which I think right now the story centers in Asia for how that's going. Let's get a quick market update from that part of the world. Avril Hong is in Singapore monitoring those developments. Avril?
Yeah, Kriti, centers on Asia and centers on the Asian giant's important sector, that is property. I'll get to that in just a bit, but take a look at what we're seeing on the region's benchmarks. They're mostly lower. Chinese stocks really getting hit the hardest today. There is a bit of fragile sentiment carrying over from last week on that higher for longer concern, and even the pockets of optimism that we're getting from news on the US and China, forming working groups to talk about economic and financial issues, really not helping to boost sentiment because it is about property in China, and it's centered on one company, today at least, Evergrande, after it says it's needing to reassess its restructuring plans. It's also scrapped some of these key creditor meetings that were scheduled to take place early this week. We also have XAUUSD, another property company in distress, slumping by the most on record after trading resumed, and the gauge of Chinese property developers slumping by the most since December last year, taking the losses in valuation to about $55 billion for this year. So just to give you a sense of how much the concern is in the investment sphere about the liquidity woes, despite the policy support that has come through from some of these Chinese authorities, Kriti.
Certainly something we're watching very, very closely. Avril, I want to get a quick check actually on Evergrande as well. Your thoughts on just the severity of what's going on with that story?
Yeah, absolutely. I mean, just taking a look at the amount of total liabilities that Evergrande has, to the tune about $330 billion, you can imagine just how much it not making any headway towards this restructuring of its offshore debt is actually affecting a sentiment around the company. And given how this was once one of the top developers in China, it really illustrates how far it's fallen. And in the past 2 years, not much headway has been made towards the restructuring. That really is the key concern for investors. Kriti.
Property issues in China, property issues in Europe, they seem to be taking place everywhere. Avril Hong in Singapore, we thank you as always for giving us that update. And again, perhaps an idiosyncratic story, but again, a part of a sector that we're watching very, very closely when it comes to Sweden. A major step towards some stabilizing. Swedish landlord SBB has agreed to sell a 1.16% holding in the education division to Brookfield. The deal would get SBB about $720 million of cash injection. Joining us with the details, Bloomberg Stockholm Bureau Chief Charles Daly is all over this. Charles, $720 million doesn't seem like a small amount to scoff at, but then you look at it on a percentage basis and it feels kind of small. How big of a deal is this?
Hi, good morning from Stockholm. Yeah, I think it is really quite a big deal because the company has identified a cash shortfall over the next 12 months of exactly $720 million. So this really does bridge that near-term funding gap, and I think the company generally will be cheering the news that it has been able to secure a liquidity measure.
Talk to us a little bit about SBB's lifeline here. Is everything good to go? Are we out of the woods when it comes to the property sector?
It's a good question. No, I don't think so. I mean, the scale of the debt at SBB is enormous. It has about $7.5 billion of bond debt, which it secured during the era of zero interest rates. And that still needs refinancing or rolling over the next coming years. So the company has said itself it needs to do more. It needs to raise further capital. And it's also looking for equity partners in its other divisions. And all of these things in the current market are incredibly challenging.
They certainly are. And again, Valerie Teitel, our markets reporter, was talking about this. The ramifications for the broader continent and by extension, the broader world are enormous. At what point do you start to have that fear factor around the housing sector really get amplified? Bloomberg's Charles Daly reporting out of Stockholm for us this morning on the SBB story. We thank you as always. Let's switch gears a little bit and talk about the aviation sector. Qantas's new CEO, Vanessa Hudson, is forced to fix stress points that fractured the airline under her predecessor, Alan Joyce. For more, let's get to Bloomberg's Benedict Kemal. Benedict, talk to us about what the new Qantas CEO actually has in mind.
Good morning. So the new CEO, Angela Hudson, came out on Friday in a message and said that the company had essentially let a lot of employees and a lot of customers chiefly down, that they felt that their proposition, their service was no longer what people associate with Qantas. There were things like long waiting lists on calls. The in-flight food was not what people expected. So she's basically now putting money into this problem. They're dipping into their profit. They're putting in another 80 million Australian dollars, that's about 50 million, to right the problem, to fix things, and she's basically trying to turn around the battered reputation that her predecessor, Alan Joyce, left behind.
And sticking with that, I mean, there's a lot going on in the aviation space here. I want to bring you right back here to Europe. We also heard from French aerospace supplier Safran. It says it can't quantify the magnitude of the bogus parts by AOG Technics. We already know this is something that even the FAA in the U.S. has warned about. What do we know about the updates there?
So this is a scandal that's been roiling the industry for a couple of weeks. We first unearthed this at the end of August. There's a small company in the UK, that's called AOG Technics that probably nobody has really ever heard of, but they are part of the part suppliers, used parts that go into aircraft, that go into engines. What now has come out is that a lot of these parts didn't have the proper certification that is needed. This is one of the very important parts of the aviation industry, that every part is certified, that every part is traceable, essentially, so that if something goes wrong, you know where it came from, you know who sold it, you can switch it out, and that's part of that chain that broke down through AOG. Safran, as you mentioned, is one of the suppliers, one of the manufacturers. They make one of the biggest engines for aircraft, and they're now saying, we're having trouble ourselves being able to retrace this because we sort of sit at the other end of that scale. So right now, Safran, engine makers, airlines, they're all racing to find out how many of these parts found their way into the, shall we say, bloodstream of the aviation industry, and how do you get them back out? And that's something that will probably remain with us for a couple of weeks, if not months, until all these parts are located and accounted for.
Certainly something we're going to be watching very, very closely. These things always give a little bit of a scare to the airline stock complex as well. Benedict Campbell, who leads our Bloomberg's global aviation team, we thank you, as always, for joining the program. Coming up, we talk about the EU trade chief, a warning to China that the bloc will be more assertive in defending its interests. More on the talks in Beijing just ahead.
Delta Airlines is committed to net zero carbon emissions by 2050. Because we know a thing or two about getting where we need to be. And it's time we all got going. Together.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in, but I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
your question, a year ago, under our statute, we were asked to begin a process to evaluate not the necessity of the tariffs, but the effectiveness of the tariffs. It's important to be really specific about the statutory requirements because we've got to follow the law. And so we began that just about a year ago. We are engaging in a very robust interagency process. We requested comments from the public across our economy. We had an open public comment period that closed earlier this year. Generated about 1,500 comments that we are going through very carefully.
U.S. Trade Representative Catherine Tai there speaking at the Atlantic Council Forum. Tai saying her agency is aiming to finish its review of tariffs on more than $300 billion in Chinese goods by the end of this year. She adds that Washington is being thoughtful about how to rebalance its trade relationship with Beijing. Now turning to EU-China relations, the European Union's chief trade negotiator says the bloc's trade relations with China are, quote, very imbalanced. Bloomberg's Europe correspondent Maria Tadeo is all over the story. She joins us now from Brussels. Maria, Dombrovskis is in China. What's the message there when it comes from trade?
Yes, and look, Valdis Dombrovskis, as you say, is leading this delegation. This is a very political, very experienced political operator within the European Commission, someone who really knows how the insights of this commission works, but is also very good with numbers, very good on the technical detail. And again, he's been on this portfolio for a number of years. Now on this trip to China, it's a very clear message. As you say, the European Union says this is a relationship that needs to be recalibrated, that is imbalanced and needs to be fixed. He also says, and to me this language is very striking, just the tone of it, that ultimately the European Union and China, as it stands today, they find each other at a crossroads where they either find a win-win formula that works for both or actually will move apart. Let's take a look.
Broadening access to China's market for foreign companies and maintaining a stable business environment is necessary to ensure fair and mutually beneficial trade relationships. It is also necessary to maintain our mutual trust as partners working together to address a number of global challenges.
And that was a trade boss for the European Union, Valdis Dombrovskis. And I think, credit to me, what is striking about the speech, which is happening, as we say, in China on this 4-day visit that he's leading, is that he essentially says we're facing this choice where we either recalibrate the relationship, we make it a win-win for both, and that obviously means fixing that trade deficit that the European Union has with China and China has with the European Union, or actually both will take different turns, and it's going to be ultimately detrimental in the economic relationship. We should also note the context of the speech. This is at a time in which the European Union says it will be, quote, more assertive when it comes to defending its own interests. They say no to decouple, but yes to de-risk. And obviously we have playing in the background the probe into Chinese electric vehicles. Remember, the head of the commission said China was flooding the market with cheap subsidies, happening as this all happens.
And at the same time, you have the EU, again, calling for that Chinese trade recalibration. It's not the first time they've done that. Why do we care this time around?
Look, I think it is very fair to say this is not the first time the European Commission, in fact, have said it for a few years now, that this is a relationship that was heading in the wrong way because it's not balanced in the way that is not mutually beneficial to the same extent. I think the number here, and this is a number that really set off, maybe not alarms, but definitely concerns in the Commission, and has been as a real wake-up call, is that trade deficit is almost 400 billion euros. I wonder if hopefully the producers can put the animations on the screen just so you see the breakdown here for the European Union. It is clear now that China has to open up the way that the European Union has opened to China. I think at the same time, you need to really grasp the change in political sentiment. There is now almost a growing assertiveness, going back to that interview that I did with the French finance minister, who said this idea of being scared of China, being concerned of China constantly, potentially a trade war, all of this has prevented effective action on issues that for the European Union, they're valid and they're legitimate.
Certainly something that we're going to be watching very, very closely. Bloomberg's Maria Tadeo monitoring all of those developments. We thank you as always. Let's bring you some breaking news here from the Middle East. We, of course, know that the IPO market is very, very hot right now around the world. Well, Saudi air cargo firm SAL seeks up to 2.54 billion riyals from its IPO. Now, in the kind of dollar-pound amount, in the pound amount, excuse me, it's about 600 million pounds. So that's going to be something that we're watching very, very closely. It's not going to be your biggest IPO, but the fact that people are IPOing anyway is a positive sign for equity capital markets. Now, let's bring it back to the European story. The Greek Prime Minister says his country could benefit from a warming climate because it may extend the tourist season beyond the traditional summer months. Kyriakos Mitsotakis told us Greece needs to focus on short-term adaptation to global heating while still trying to reduce its causes long-term.
Climate change is an opportunity for us to expand our tourism season. Yes, it may be hot to come to Greece in July and August, but we will always have enough people interested to come to Greece during those 2 months. But we have now more people interested in coming to Greece in March and April, or October and November, more people interested to come to visit our cities year-round, and expanding our tourism season has always been an important priority for us. And I think, Guy, that there will be more people who, given the choice, will choose not to take their holidays in July or August, not just because it may be too hot, but because it's too crowded. So for us, it's a great opportunity to expand our tourism season and also to open new destinations on the mainland for people to explore. So there's still it's still going to be some time until the Scandinavian beaches or the Danish or Swedish beaches are going to compete with the Greek beaches. I don't see this happening anytime soon.
I'll pass that message on next time I see them. You did face some criticism, though, in the way that you handled the wildfires this year. What lessons do you think you learned?
Look, I mean, the climate crisis is here, and it's here for good. We've always had wildfires in the Mediterranean, but we had particularly intense wildfires this year, and we also had unprecedented floods. So it's very clear that we need to focus more on short-term adaptation. And this is, of course, a case I'm also making to my European colleagues. We spend trillions of euros on long-term mitigation, and rightly so, because we want to be leaders in the climate transition. But we also need to support people when they lose their livelihoods or houses as a result of climate disasters today. So we need to be much more effective in dealing with these disasters. We've made good progress. For example, in Greece, we have a 112 emergency number, which we used very successfully to evacuate people and make sure that we save lots of lives. This is something, for example, that was not present in Maui. And when I look at the Maui disaster, it's so painful because we had gone through similar disasters 5 years ago, but we learned from them. And we are using technology in a much smarter way today to make sure that at least we can save people's lives.
The climate crisis is going to cost more money in terms of either dealing with events or also where you get your energy. Where are you going to get reliable, affordable energy from, and where do you get it?
Well, first of all, we get it from the wind and the sun. We are
affordable.
It is affordable. It
is reliable.
It is cheaper. It is reliable because we have lots of sun and lots of wind. But of course, it will not do the trick on its own. But Greece is one of the top 10 producers of renewable energy from the wind and the sun. We have 12 gigawatts of installed wind and sun energy in Greece, and much more to come. But of course, in the short to medium term, we will also need to rely on natural gas as a transition fuel. And there's a case to be made that Greece is playing a very important role in the European energy system because we are also an entry point for natural gas to serve not just the Eastern Europe, but even pumping gas up to Ukraine. So Greece's role as a pillar of geopolitical and energy stability in the Eastern Mediterranean has certainly been enhanced after Russia's invasion into Ukraine.
Greece has a lot of sun and a lot of wind. Greek Prime Minister Kyriakos Mitsotakis talking about renewable energy and the sustainability story there with our colleagues Guy Johnson and Alex Steele. Let's take a look at some of the other stories we're following from around the world. Europe's main auto lobby group urging policymakers to delay post-Brexit tariffs on electric vehicles, saying they could reduce production in the region by 480,000 cars over 3 years. Now, EVs have become a major focal point of global trade tensions in recent weeks as Europe frets that its automakers will lose out to Chinese manufacturers. The EU this month launched an investigation of Beijing's financial support for the EV industry. And right here at home, UK Prime Minister Rishi Sunak facing growing anger from business leaders and politicians alike as he weighs whether to shorten a flagship rail project that could cost the UK $122 billion. Sunak and his chancellor are locked in talks over concerns that the cost is spiraling out of control. A decision may come as early as this week before Conservatives gather for their annual conference. On the data front, we have a ton today. Today, we get German IFO data from the Business Climate Survey. A lot of questions about what that actually indicates about the broader German economy. Are we one step closer to tipping into recession, by extension, dragging the entire continent into it? Tomorrow, then, of course, U.S. data is where the focus is. New home sales and consumer confidence both are due. On Wednesday, it's all about the French budget for 2024. President Emmanuel Macron has promised to find at least 15 billion euros of savings to cut out the deficit. On Thursday, we get a barrage of inflation data from several European countries, Spain and Germany at the top of that list. And later in the day, Nike earnings coming out on the top of the agenda as well. And on Friday, the Fed's favored inflation gauge PCE on the prime docket. That might just be the game changer of the entire week. Now, coming up on this program, we take a look at the biggest market stories today, including an eye on China property developer Evergrande, whose liquidation worries have hit China property stocks. That conversation next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome back to Daybreak Europe. I'm Kriti Gupta in London. We now take a quick look at the markets. Bloomberg's Valerie Teitel is all over it. Valerie.
Kriti, just a quick glance on just really how bad that fall in China property stocks was. It was the worst slump in Chinese property markets since December 22. I had to take a look back at what happened back then. There were various developers back in December of 2022 raising finance via share sales, but very surprising to see that given all this negativity about Chinese property markets, that the biggest slump year to date essentially came today. And if we have a quick check then on U.S. equity markets, I want to note there really is no negativity read through at the moment to U.S. stocks. We're still seeing S&P futures in the green, NASDAQ futures also in the green. Maybe some exhaustion around the negativity around the Chinese, property market story, but it's not impacting risk sentiment this morning. It is very nice to see this bounce today, Kriti, because S&P futures had the worst week last year since mid-March, and we've actually seen the equal weight index now only up 1% so far this year in the S&P 500.
I think that's so fascinating, though, because that was really the conversation coming out of Apollo over the weekend. Bloomberg's Valerie Teitel walking us throughout that story. Where do you invest if, well, everyone is kind of maxed out? We're going to dive into that in the hours to come. Coming up, UBS says working on its full speed with the integration of Credit Suisse. We speak exclusively to the CEO, Sergio Omradi, later today. Stick with us. Up next, Markets Today, Anna Edwards, Mark Cudmore, and Tom McKenzie take you through the market open. This is Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Markets Today. I'm Anna Edwards, live in London with Tom McKenzie and Mark Cudmore. The cash trade just less than an hour away. Here are your top headlines. Chinese property stocks drive Asian benchmarks lower after Evergrande cancels a creditor meeting. US Treasury yields climb amid ongoing concern over a possible government shutdown. The EU's trade chief warns China the bloc will be more forceful in upholding fair competition. Plus, troubled Swedish landlord SBB gets a $720 million cash injection from Brookfield Asset Management, making the Canadian investor the majority shareholder. Welcome to Markets Today, everybody. It's just gone 7 o'clock here in London. This Monday morning, Mark Cudmore is still with us in London, and we're pleased he is, so he can take us through his thoughts on the markets this morning. Mark, good morning to you. Let's start with a top-level comment on what the markets are saying to you this Monday.
Yeah, good morning. I have to say that I'm not getting a very clear narrative out of the central banks last week. Last week was meant to be the week that provided clarity of where we're going. It is very clear that there's a risk-averse tone out there. You get that from all investors at the moment out there. But I'm not really sure what the yield takeaway is, apart from I do still expect to see further steepening of the curve. What that means at the front end, though, I really haven't yet got clarity. And we're now focused on the debt shutdown, government shutdown in the US. I think that might be a little bit of a red herring in terms of actually not being as risk-averse as people think.
Yeah, and in terms of getting readings, Tom, we're getting mixed signals from the Asia session and US futures. Yeah, China developers, as we said in the headline, of course, weighing on sentiment over in Asia, the biggest drop you've seen across the property stocks since about December. So that is certainly a drag. And then when you lift the hood as well, a few other components at play, including the oil story, some upside coming through there. The flip side is basic resources falling, or potentially falling as a sector on the back of much softer iron ore, and then again ties into the property story in the US. Futures then pointing lower in Europe by about 0.3%. You saw some selling, of course, on Friday. It was utilities amongst one of the biggest sectors on the downside for European stocks. European futures now down by 0.3%. FTSE 100 futures pointing to a loss of about 32 points, still holding above that 7,700 level for the main UK index. DAX futures pointing off by about 44 points, down 0.2 or close to 0.3%. Let's flip the board then and have a look at the US, given how things were shaping up. Yes, we're going to have Fed speakers as well later this week, as well, of course, as that PCE indicator, so some data coming through from the US that will maybe give Mark that clarity that he's looking for in terms of next steps from this Federal Reserve. S&P futures currently pointing to gains, actually, of around 0.2%. NASDAQ futures pointing up by about 41 points. And on the Dow Jones, you're looking at gains of about 60 points, up 0.2%. So US futures diverging from the picture in Europe so far.
Well, Tom, on the GMM, there's one very clear picture, and that is, of course, the China negativity that we're seeing out there. So you can see it in the stocks column. CSI 300 is there. You can see the yuan showing up here and the Aussie dollar kind of related to that move. And you can see over in the commodities column that metals are weak as well. And this is all about the story that the Evergrande news on terms of what they're doing with their creditors and their decisions they're making there is outweighing the potential positives that was meant to come through from potential signs of better geopolitical relations between US and China and the stimulus we saw on Friday. So it's really about China negativity. There's only one other theme to really draw attention to, is the fact that, in fact, there it is, yes, 30-year Treasury yields up 3 basis points, and that is that steepening in the curve that I think might be an ongoing dynamic over the next couple of months.
OK, yeah, certainly something to watch for, reading a lot about the steepening and how that might happen and what concerns people have about the long end. Mark, let's talk about the markets in 3 minutes. And it's an interesting one. You mentioned how it's difficult to draw firm conclusions from last week and all of the central bank set-piece activity. But we seem to have a bit less set-piece activity, at least from central banks. Plenty of data this week. But then you're left with a slightly more unpredictable sense of what the drivers of sentiment are going to be this week. What are you going to be watching for?
Yeah, I think that most of the market thought that whatever way you were kind of biased towards at the start of last week, that last week would kind of give us a clearer narrative into year-end. I'm not sure that the narrative is that clear. I think there were surprisingly few conclusions. And what was interesting to me is how the BOJ was very dovish, and yet you're not seeing yen much weaker. And I think that shows this is a market that is kind of second-guessing itself a little bit. There is this kind of risk aversion, and there is this worry about the US government shutdown. But overall, what we're watching for this week is we have the data, we have those central bank speakers out of the Fed and ECB. Do they want to kind of retweak the language or the message that came out of the central bank meetings last week? But right now, there is a bias towards risk aversion, both in terms of higher yields and lower stocks. But I'm not sure that people are really convinced by it. They're a little bit worried about expecting higher yields from here in a bond market where yields are already offering quite a lot.
OK, and then you add on to that the unpredictable nature of strike activity and the possibility of shutdowns, and there's plenty to watch this week. Oil also in focus. I know some colleagues on the Markets Live blog flagging that as an area to watch, in particular focusing on US stockpile data. We get more clues on that tomorrow and Wednesday.
Yeah, that should provide yet another kind of bullish impulse. And, you know, we've definitely paused since about 6 days ago. But it's interesting the fact that oil prices have not pulled back. And that's in the context that we've seen a stronger dollar, you've seen higher yields, you've seen risk aversion, and China negativity. These are all reasons for why you should see oil markets come lower. So I think the fact that we saw oil prices only withdraw a little bit from that kind of intraday peak last Tuesday shows that once they kind of get through this technically overbought overhang, there is still a natural driver from the supply side for oil prices to probably go higher. And that's what the data this week might help us kind of set that trend.
Yeah, absolutely. So we'll focus in on that, on the oil story out of Cushing. You've mentioned China being a focus, and that seems clear through the Asia session. You've got Japanese stocks going higher, but that's to do with the yen, and you've got Chinese stocks coming down. Interesting analysis by Bloomberg Economics. We've asked the question, how many small measures does it take to make up a bazooka in terms of stimulus in China? And they've done some analysis and come to 2% added to GDP in the second half of this year from policy so far.
Yeah, actually, And thank you for highlighting this piece to me, because I hadn't spotted it already before you kind of sent it on. But I actually think this is really interesting. It's saying that maybe one of the underpriced narratives is that Chinese growth in the second half of this year, the start of next year, is better than expectations. It's important to emphasize this is not a super bullish story on Chinese economy. It's just saying that, hey, all these stimulus measures in isolation get dismissed, but they really are adding up to something quite significant. And that is maybe one of the economic drivers out there that we need to start pricing into the market in the second half of this year.
OK, remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. NLIV Go is the function to use on your Bloomberg terminal.
OK, here's what else is on the docket for the rest of the week then. Later today, we're going to get Germany's IFO Business Climate Survey as we kind of wring our hands about the fragility of the German economy. So that should give us a little bit more guidance in terms of how things are shaping up for Europe's largest economy. Then on Tuesday, US data, including new home sales and consumer confidence, come out on Wednesday. The French budget for 2024 is going to be unveiled. President Emmanuel Macron has promised to find at least 15 billion euros of savings to cut and address the French deficit. And on Thursday, we're going to get a barrage of inflation data from several European countries, including Spain and Germany. And later in the day, Nike earnings coming out as well. So a bit of a gauge in terms of the retail sector. On Friday, the Fed's favoured inflation gauge, the PCE, of course, is coming out, or will come out, and that could give us a little bit more of clarity in terms of how comfortable we are, potentially, with the idea that this is a Fed now solidly on hold. I don't know how important that inflation data is in your mind, Mark. Do you expect that you're kind of clutching for a bit of clarity?
Yeah.
I think as many in the market seem to be this Monday morning. Do you think the data that comes through towards the end of the week is going to give us a little bit more of a steer?
I hope so, but I'm worried. I feel like we're not close to another narrative, so it'd be surprising if this week did give us that clarity. We're at that time of year where people normally like aggressively chasing trends into the year end. You know, you kind of have the dynamic that people either want to have made a lot of money and they're like retrenching, so they're not fighting something that goes too far, or people feel like they've got to push it because they're like, this is their last throw of the dice to have a good return before year end. So you quite often get new narratives that run from about late September into the end of year in the hedge fund community. I feel still that the consumer data is more important, and that goes to my narrative. I think the consumer falls off a cliff. I think we're all agreed that inflation is sticky at high levels, and it's not likely to run away again to the top side yet, and it's not coming down fast enough. So I think it's more about how quickly the consumer falls off a cliff that's really more important.
It's interesting mentioning hedge funds. I did read, connecting that with the oil story and inflation, I read that hedge funds are getting excited about putting on bets on moves higher on the oil price. So that's something we're obviously continuing to watch. 93.74 is where we are on Brent right now. I was struck by how many reports over the weekend I was reading that were referencing these unpredictable elements of the US story right now. Shutdowns, strike activity. We've had better news around strikes, around the Hollywood writers' strike, but certainly watching the auto sector and the shutdown narrative and what that does to sentiment.
Yeah, I'm worried by the strikes. Like, as we said, I think this is the element that people are struggling to price, particularly in the auto worker sector. But I think that's probably a bigger driver than the government shutdown. I mean, we have to remember the last time the government shutdown lasted for a long period of time, 2018, 2019, the S&P 500 rose throughout the crisis. So, like, it's not necessarily a stocks negative. Depends how long it goes, depends on the complications.
We also used to talk about looking through it a lot, didn't we? And how it really wasn't going to be a story that was just sort of showboating and a set-piece event that happens every now in the US. But the coverage seems to have changed.
The data suggests, historically, generally, that the economy takes a little bit of a hit, but then you get that pickup when the government reopens. So across the line, it doesn't really change the economic dynamics that much, not as much, for example, as those strikes. Ben Eamon's saying that it is the triple S that we should be looking at, the shutdown, the strikes and the student debt as well, in terms of the components going forward.
Yeah, and we'll see if we continue to get data if we do get a shutdown. Right, coming up on the programme, UBS says it's working at full speed with the integration of Credit Suisse. We hear exclusively from the CEO, Sergio Ermotti, later in this programme. Plus, Brussels takes Beijing to task, the EU trade chief, saying the bloc is ready to de-risk from China to protect its interests.
But up next, US futures are in the green just about, despite that caution driving the session in China. We're going to get you set up for this week's markets after an eventful week, of course, of central bank decisions last week. If you have any questions of your own for our guests, send them to us on IB Plus TV Go. You can, of course, get more from the Market Today team on the front page of the Bloomberg UK website or by typing TLive Go on the terminal. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Markets Today. We have 45 minutes until the start of cash equities trading for, yes, a Monday morning. And the European futures picture looks a little weaker this morning, in contrast to US futures, which actually point a little higher, up 0.3% on E-minis this hour. Tom, let's come to you. Oil in focus this week with some data due out, but you've got a slightly longer-term focus to your morning must-read.
It's interesting. You and Mark were talking about the fact that we've seen some hedge funds positioning for a little bit more upside on the back of the tightness in terms of supply coming through for that market as we look at Brent at around that $93 a barrel level. This is a piece by Javier Blas that I wanted to pull out for you. Of course, Javier Blas, a Bloomberg opinion columnist who has for many years charted and navigated these global energy markets and is so well versed in this story. And he's just flagging for us and previewing the IEA World Energy Report. It's going to be coming out in October, and they've already flagged at the IEA suggesting that look, they're going to have a report that's going to point to a peak again in terms of oil and coal consumption, fossil fuel consumption. And Javier Blas is saying, hang on a second. And what he's pointing out is that the IEA, in his words, are the gold standard when it comes to statistics about the energy markets. But he also points out that in terms of forecasting, they don't have a great track record. He talks about the fact that they called the peak in terms of coal consumption out of China. Well, that didn't come to pass. They underestimated the build-out and the demand for solar. They underestimated the impact of the shale revolution in the US. And what he's saying is that even if we get to a peak, arguably it's not the peak that's most important, it's where the demand and where the curve goes after the peak. And he says that if you look at coal, for example, the peak was called in 2013, but in fact, you've seen coal demand picking up. So he's just very cautious that even if we get to a peak, as the IE suggests that we may be getting closer to, it's where we go from there that's going to be really important. And this is the pull-out quote then. The day when the world's use of fossil fuels reaches its maximum is nearer than ever. I'm afraid, though, that anyone thinking about a rapid decline after an extended ascension would be disappointed. And, of course, this is consequential, essential for how we think about the climate crisis as well.
Tom, I love this morning must-read. Thank you for highlighting. I do love that dramaticness of that chart of how quick the decline is. I do wonder, though, if this is like some of these other technology stories where it constantly disappoints, and then changes much more radically than people think later than it happens. And particularly in this context where some of this transition might ultimately be about a technological breakthrough. So I would have a breakthrough in terms of battery ability to store and kind of transmit stuff efficiently. And then suddenly oil might suddenly fall off a cliff much quicker. So, like, I mean, this makes sense, but I do understand Javier Blas's point that these things constantly disappoint in the curve, maybe like coal. But I just wonder at some point whether we really just shut down oil very rapidly.
We also probably, with this long-term view in mind, need to keep an eye on Western governments and their level of commitment to this agenda, because the technology innovation is part of the story, but also the stick being driven by political change. And we focus on Europe last week in the UK, and today we're going to hear from Emmanuel Macron over in France on the green agenda. So plenty to think about there. Let's get a view on the markets now with Daniele Antonucci, Chief Investment Officer at Quintet Private Bank, who joins us now. Daniele, very nice to have you with us, and thanks for joining us. I wonder if we'll start with oil and the way that ties into your commodity view and where you think that takes us. A lot of people concerned about what that does to inflation from here, whether we see another pickup in inflation. Others say, actually, it won't really feed through that way. It'll just weigh on growth. What are your thoughts? Good morning.
Good morning to you. Oil is very important to our outlook, and it plays out in two ways. One, I think, at least in part, is an explanation on why we didn't get much clarity last week from central banks. At the end of the day, if you think about it, central banks have an asymmetric reaction function now. The cost of getting it wrong on the inflation side and getting second-round effects, maybe because of oil feeding through if it stays elevated for an extended period of time, those risks outweigh the risk of eventually getting it right and ultimately engineering the soft landing that they are all aspiring to. So that's the first thing. And this also justifies for me why central banks are typically on hold or are describing an outlook where they say they are close to peak rates, but no cuts in the near term. And these are hawkish holds, right? So upside risks exist when it comes to inflation. So that's the first point. So, the second point is that the pickup in oil is a recessionary impulse. And that's why I think there's so much uncertainty on the path for treasury yields or bond yields in general, because a oil spike this time around is likely to be disinflationary.
So Daniele, how do you adjust to that hawkish pause environment, that higher for longer consensus that seems to be forming for these central banks? How are you thinking about repositioning to that new reality?
So you need to think about the asymmetry when it comes to the risk or reward on different types of market positioning. One view that we have right now, for example, is that if you look at the US, treasury yields are attractive. They're attractively valued. They're already yielding quite a bit. But spreads, the differential of riskier bonds on safer bonds is quite tight. So treasury yields are attractive, spreads are tight. The full effect of the rate hikes is not feeding through just yet. And so we are overweighting treasuries and we are underweighting spreads on riskier bonds. When it comes to Europe, I think we are more at the peak. The ECB, after all, was on hold. We've been neutral so far on Eurozone bonds. Now we have increased our position with the view that we are at or close to peak rates.
Daniele, good morning. It seems to me that overall your view is very defensive, I think, globally. And I sympathise with that, and I think that many people would share that kind of view at the moment. But what are you most concerned about being wrong? What is it? What keeps you awake at night that you've missed the fact that we're just at a little bit of a slowdown in the equity market and we start booming again into year end? What are you watching for?
Okay, sure. Mark, this is a very important point. First of all, I wouldn't describe our view as very defensive. I would describe it as somewhat defensive. For example, in the first half of the year, we have been overweight US equities. That has worked at around the middle of the year because of demanding valuations. And because of the slowdown that didn't come in the US just yet, we started to underweight slightly the US market. But within that, we like low volatility stocks, because I think at the end of the day, we had already a pretty strong rally, a rather narrow one. And again, valuations are even more demanding. And probably the slowdown, regardless of whether it's an outright recession or more like economic weakness, this should come. What if we are wrong? I think the key here is diversification, really. It could be that this time around, the relationship between policy tightening and economic growth is particularly delayed. It's also true that the COVID cycle could be different in many ways. But you mentioned yourself the triple S, student loans, the government shutdown, the fact that we have basically the supply constraints when it comes to oil, all of this, I think, suggests to us that you want to be somewhat defensive, even though you don't want to overdo it, precisely because the economy could perhaps run a while longer, and risk markets now are facing air pockets, but it's not a guarantee that they have to go down to a great extent.
Daniele, I wanted to ask you about Italian assets at this point. We had some news developments over the weekend that suggested that the government is going to allow banks to avoid paying the windfall tax if they boost their balance sheets. We've seen this as something that has weighed on bank stocks recently, and our colleague Valerie pointing out that this could move BTP markets as well, because it could mean that banks have to buy more BTPs to put on their balance sheets. How are you viewing Italian assets with those news developments in mind?
So these developments, I think they could move markets. So we have seen the back and forth already. On the back of that, initially these policies were supposed to be much more stringent, much more restrictive. Then there was a backtracking already, and that has had a market effect. And so this could continue to have an impact on Italian assets, on bank stocks, for example, but also on BTP spreads. I think it's very difficult to call because these moves could reverse, because also the fundamental picture isn't great. Before you made references to the German economy, by and large, they apply also to the Italian economy or the Eurozone economy for that matter. And at the end of the day, I think BTP spreads also, they are relatively tight and high quality bonds remain attractive. So in general, even though our view on Italian assets isn't negative per se, we are neutral. I think we want to be cautious at this stage because of the uncertainty and volatility that these policies can generate in the marketplace.
Daniel, from Italy to the UK then, and I know you've started to add gilts into your portfolio and your selection as well. How much of that is a valuation, a relative valuation call versus a conviction that this is an economy that is heading for much bleaker times?
It is both, actually. So there's no question in my mind that gilts now are more attractively valued, like other quality bonds, other government bonds of Eurozone economies or the US. But it's also because we think that the probability of recession for the UK is high and higher than its peer group. And so taking both into consideration, we thought it was the right time to move from a neutral position on gilts to an overweight. So it's both the recession call and also because valuations are not demanding at all. These things are cheap.
Daniele, where are you in FX? What's your view on the dollar here? It continues to kind of confound people this year. This was the year the big dollar downtrend was meant to start, then had a really strong bounce, which now seems to be reiterated again after the central banks last week. Where do you stand?
So we thought that too at the start of the year, or rather, when we started 2023, our view is that we were going to see a gradual dollar devaluation because fundamentally we think it's overvalued and because central banks in other parts of the world were going to catch up with the Fed. Then we got this bouts of risk aversion. We got the strength of the US economy. We got more rate hikes or a more hawkish Fed than we thought. We were expecting the pause sort of earlier than it then materialized. So I think that's all of this explains why the dollar has been stronger versus our central scenario versus our forecast. In general, though, over the medium term, I would think that the dollar should give some up value versus the euro. Sterling maybe is a different story in the near term, but the overvaluation argument still remains. Once we are through the recessionary impulse, probably risk aversion will diminish and risk appetite could come back. Some international assets offer better value than US assets, and so the dollar should weaken somewhat. But at the end of the day, I don't think it's a straight line, and I don't think it's a particularly strong depreciation that we would envisage, and not in the near term.
Okay, Daniele Antonucci, thank you for joining us this Monday morning. CIO at Quintet Private Bank. Views are being overweight on US Treasuries, underweight slightly riskier bonds, and leaning into UK gilts as well. Thank you, appreciate your time. The EU's trade chief, meanwhile, warning Beijing that the bloc will be more assertive in defending its interests. We get the latest. This is Bloomberg.
of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Welcome back to Markets Today. We are half an hour away from the start of cash equities trading. Here are your top stories. Chinese property stocks drive Asia benchmarks lower after Evergrande cancels a creditor meeting. US Treasury yields climb amid ongoing concern over a possible government shutdown. The EU's trade chief warns China the bloc will be more forceful in upholding fair competition. Plus, the troubled Swedish landlord SBB gets a $720 million cash injection from Brookfield Asset Management, making the Canadian investor the majority shareholder. Tom, a lot to be negative on from China coming through from the Asia session. More positive out of Japan. How does all of that flow through into the European expectations and European futures?
Yes, a reminder again of the property woes of China. And of course, they will not be cleared up quickly. SBB over in Sweden, of course, a bit of relief coming through there, as you say, in terms of that injection of capital. We're going to be watching Italian banks as well, given there's been some reporting over the weekend around some adjustments from the team led by Maloney around the windfall tax, that surprise windfall tax. That may lift in terms of the adjustments, may see a bit of movement in the Italian banking sector. We've focused on that, certainly, but also the basic resources sector and how that plays into particularly the FTSE 100, given that iron ore prices have slumped in the session today, again, linked to the lack of stockpiling of some of that material by the Chinese developers. Normally, in this period of time, this part of the season, that is what's happening. It seems like it's not happening to the same extent. Futures pointing lower then on the DAX, currently down 41 points, pointing lower by about 0.3%. In the UK, then, the FTSE 100 pointing lower by about 0.4%. And over in France, as we look to the budget being unveiled by Macron later this week, you're looking at losses of about 0.4%, Anna.
OK, so that's what we see on the futures picture. US futures pointing a little higher. NASDAQ futures up by 0.3%. So we keep that in mind as we head into the European session. We'll keep an eye on commodities, where we see some movement lower on, for example, iron ore. Mark, I know that central bank balance sheets, an area of focus for us for many years now, and once again in focus for you.
Yeah, actually what I thought was interesting last week is in all these central bank meetings, and we weren't talking about the balance sheet moves as much. It didn't seem that long ago that we thought Q2 would be the end of the world and wreak havoc. So I decided to have another look at this morning. So first of all, Central bank balance sheets have fallen about 15%, just under 15% from their peak. That's for the 18 months until the end of August. The reason I've done the data till then is because the PBOC hasn't updated beyond the end of August, but we are seeing the ECB and the Fed in particular continue to decline in September, and it looks like the BOJs will in dollar terms because of the yen weakness. So this is the combined balance sheets of the world's 4 largest central banks, the Fed, ECB, Bank of Japan and PBOC. So about 15% down from the peak in 18 months. But I want to show you why that is. And what's interesting is it's mainly the ECB, which is kind of confusing to many people because we hear a lot about the Fed's QT program. And you can see here, the white line is the Fed. And in fact, the Fed is still the world's largest central bank. It has been for the last kind of 6 months or so. The ECB is this blue line. They were the world's largest central bank in terms of balance sheet size. And they've actually collapsed by more than 20%. And a lot of that is the expiry of the TLRTO program, the long-term refinancing operation loans that are maturing all by the end of next year. What is interesting, though, is that means that the PBOC and the BOJ are still way, way smaller than the Fed. Even though we hear all about the Fed's QT, it is still the world's largest central bank. And maybe that explains some of the US exceptionalism from a market's point of view.
Okay, really interesting. We'll certainly keep that one in focus. Now let's move on to matters going on in China, and there's plenty of them to talk about. The European Union's chief trade negotiator has warned China the bloc will be more forceful in upholding fair competition and defending its interests. His comments come just weeks after the EU launched an anti-subsidy investigation into the Chinese electric vehicles sector. Of course, we have the European trade chief in China right now, tracking his movements and his commentary. Let's get to Bloomberg's Europe correspondent, Maria Tadeo, who joins us with the lines from Brussels. Maria, Valdis Dombrovskis then in China, talking trade with the Chinese, saying the emphasis is on de-risking, not decoupling. What are the big themes that strike you?
Yes, Anna, and he is on a 4-day trip to China. Let's also remember Valdis Dombrovskis is a very senior political operator within the European Commission. This is someone who may not be the most animated, but he's certainly very good with numbers and has been on this portfolio for a number of years now. This portfolio trade is key for the European Union because of the single market. Now, today he is in China, as I say, with a number of messages. One of them, as you say, is that the EU does not believe in decouple, but it will de-risk from China, but also it has to do with how to balance out the relationship, the trade relationship between both the European Union and China. And today he's coming across with a very almost heavy message, very assertive tone, saying that ultimately these two blocs are at a crossroad and it can go both ways. Either they find a way to recalibrate their relationship so it becomes one of open, quote, fair trade that is a win-win for both, or actually they will find themselves moving in different ways, and that would be detrimental to the economic relationship of the two of them. At the same time, as you say, we have to put this in context. This is coming at a time in which the European Union, as I say, is looking very closely to that trade relationship with China and the perceived imbalances that they believe are a problem now bilaterally, but also at a time in which the European Union is looking specifically at issues like Chinese subsidies when it comes to the EV. That investigation is also open. I should also note that Valdis Dombrovskis is not just talking about the trade, but he also says when it comes to Ukraine, it is disappointing to see that China has not really pulled its weight to try to get to a peace agreement between the two, perhaps saying that China should have played a much bigger role when it comes to pulling back Russia from that invasion of Ukraine.
Maria, look, you and I know that the Europeans have pushed for recalibration in trade between Europe and China for many a year. A lot of that accompanied by jawboning from EU officials. Are they moving beyond jawboning now? You touched on that EV investigation. Are the Europeans prepared to wield the stick a bit more in this relationship?
Tom, and I think you nailed it there, because this is not the first time we hear this idea of a recalibration of a relationship that needs to be balanced out. In fact, when you go back to the EU-China trade deal, that got a lot of criticism, but some of European officials at the time defended that deal, saying it will balance out the relationship. I think there's one number that has really set off, maybe not alarms, but real concerns in the Commission, and that is a trade deficit. It's pushing now to a record of 400 billion euros. For the European Union, they say this is not about the EU triggering a trade war. This this is more about China perhaps benefiting too much from what is an open market and not so much opening to external competition. I think also we should factor what is a changing political sentiment. I think for a very long time there was this concern idea, almost suggestions that China could retaliate. That was fearful to some. Obviously, I'm thinking of countries like Germany, but I go back to my interview with the French finance minister, Bruno Le Maire, about 2 weeks ago, who said that concern, that fear at times, what will China do? How will it retaliate? Has prevented effective action from the European Union on issues that they believe are both valid and legitimate.
Really, really interesting on this consequential visit, of course, European Union visit to China. Maria today in Brussels with the implications and the latest. Thank you. Now, remaining on the subject of China, but focused on what's happening in the property sector, shares of defaulted Chinese builder Evergrande are slumping once again in Hong Kong after the firm says it's unable to meet requirements to issue new bonds. Evergrande has also cancelled some key creditor meetings and says it needs to revisit its restructuring plans. Let's bring in Bloomberg's China credit editor then in Hong Kong, Kevin Kingsbury, for the details. Kevin, what exactly did Evergrande have to say over the weekend?
Well, first, Tom, they said that they weren't going to hold their creditor votes slated for both Monday and Tuesday. They said that because of sales the last 6 months and after consultations with its advisors and with creditors, it's decided that it needs to go back to the drawing board, essentially, and revisit its debt restructuring plan. Shares have fallen for Evergrande, its EV unit, and for its property management unit, upwards of 75% since the shares resumed trading over the last few months. And so it's really been a question of, because they can't see these shares rise, and because also last night Evergrande said that because of an onshore investigation, it's not going to be able to issue new dollar bonds for the time being. Now that, along with the equity, they were the two key components that offshore creditors were in line to get with this debt restructuring.
Kevin, good afternoon. What are the implications of these latest developments, not just for Evergrande, but for other builders? And what are we watching for kind of next in terms of developments of this story?
Sure, Mark, definitely this was a case where this was going to be a case study for many of the developers. This was going to be one of China's most complex and toughest debt restructurings, and that if it went through, it would kind of ease the way for other smaller builders to also finish up their debt restructurings. But now here we are, 21 months after its first debt default of onshore debt, and they're still kind of having to go back to the drawing board here with this debt restructuring plan. So it does not speak well to the plans of other developers either to kind of get offshore creditors on board to really get their debt house in order.
Kevin, thanks very much. Bloomberg's Kevin Kingsbury in Hong Kong with the latest on the property sector in China, something that is moving markets through the Asia session. As you can certainly see that weighing on Chinese property stocks. Let's get to some of the other stories that are also being covered by journalists here at Bloomberg and feature highly on the Bloomberg terminal. Congress heads into a make-or-break week for avoiding a government shutdown. Leaders of the Republican-controlled House hoping they can persuade GOP holdouts to get on board with 4 full-year bills and a short-term funding patch. A shutdown is set for October the 1st unless Congress acts. If no deal is reached, hundreds of thousands of federal workers are set to be furloughed.
Meanwhile, a senior banker at Nomura has reportedly been barred from leaving China. The Financial Times reports that the chair of the investment banking for China, Charles Wang Zhonghe, is not in detention and is allowed to travel within China. The travel restrictions is linked to Wang's time as ICBC before joining Nomura in 2018.
Striking screenwriters in Hollywood have reached a tentative deal with some of the largest studios, including Disney and Netflix. The Writers Guild of America, representing more than 11,500 writers, could end a strike that began in early May if approved by its members.
President Emmanuel Macron says French troops will leave Niger by year's end, bowing to the demands of a junta in the former colony after a coup that upended France's strategy in Africa. Withdrawing France's roughly 1,500 troops marks a reversal for Macron, who previously rejected a September deadline by the coup leaders and said he'd only do so at the request of ousted President Mohamed Bazoum.
Coming up on the programme, we'll get back to your stocks to watch, including the struggling Swedish landlord SBB, which has taken a major step towards stabilising its finances. We heard from the central bank governor in Sweden last week talking about the difference between these troubled lenders, troubled property businesses and the rest of the sector, but we will get to the details on SBB shortly. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back to Markets Today. We are a little under 15 minutes from the cash equities open. Futures spawning lower by about 0.3%. Let's check in on what you need to know then heading into the open. Sam Munster joins us from our Markets Today blog. Sam, euro inflation, we're getting data later this week. How consequential could that be?
Very consequential, as all inflation data is at the moment. If you've got central banks everywhere telling you that data dependence is still at the centre of what they're doing, inflation very important. I think, you know, the debate around most central banks now, certainly the most major central banks, has shifted to how long are they going to remain, you know, at higher interest rates, and then when are the cuts going to come eventually. This inflation data could give you at least a little hint as to when that may happen.
Sam, in context of that, how are you viewing the oil story?
I think you're quite right to put it in the context of inflation, because I think at the moment, yeah, oil has gone up, and at the moment there are hedge funds now piling into kind of more bullish bets on where the oil price is going to go. There's kind of this underlying threat to inflation coming back down again. We'll see where that goes over the course of the next couple of months, but yes, certainly it appears that oil prices, you know, today a little bit flatter, but still hovering around that $90 a barrel mark. It could pose a little bit of a threat to that.
It was interesting. Our guest earlier agreed with the assessment that you've made a few times on this programme, Mark, which is that, you know, you always look at the oil price going higher and you ask questions about whether that takes us higher on inflation, but he also thought that this, in the end, will offer some kind of deflationary impulse to the economy.
Yeah, I'm with Nuts. I actually think this is deflationary, disinflationary, in terms of the impact on the consumer will be more negative in their spending power over the next couple of months than it'll be inflationary. If you want to be really extreme, it's slightly stagflationary, because of course it is higher prices at the top end, but I think the growth impact on negative is more negative.
But before we get there, does it maybe push oil prices up in a sort of just mechanical, mathematical way for a short period?
Absolutely. I also like the fact that, Anna, despite the fact that my brain has been switched off all show, you managed to find the one win I had in this show. I love it. It's brilliant.
Excellent. I'm pleased you're pleased. But coming back to you, Sam, around the focus this morning. I mean, we're watching the auto workers strike in America with a great deal of focus. It's one of a number of issues that are really sort of unknown at the moment about the US economy. But we have had some better news in terms of the getting back to normal, at least, on the writers' strike in the US. What's the
detail? And I think we were kind of just talking a moment just before the cameras came on that the auto strike is a much larger one, you know, certainly in terms of the supply chain, the number of people involved. But the Hollywood strike, it's only one part of it that they've reached a kind of tentative deal on, the screenwriters part of it. But there is a huge amount of industry that goes around this. I think actually that later on we may see a move in Ashtead shares, for example, in London. You know, they're a company that rent industrial equipment, and because of these strikes, they haven't been doing that so well in Canada. It's actually a big part of their business. And then you'll see maybe some moves in Disney and Netflix. You know, this is a big deal. It's a result in a lot of of TV and film production shutting down.
Yeah, and I wonder about cinema chains, movie theatres, because we've seen a number of releases delayed as a result of an inability to effectively promote the film, basically.
Well, and you've just had a really successful couple of releases with the Barbie and Oppenheimer films, and then the pipeline has then, not dried up, but it's been delayed.
Yeah.
And so, yeah, for cinema chains, which have struggled a lot, of course, during the pandemic, this could be a good story.
And it's interesting, well, I mean, we're talking about the energy input into inflation, and now we're thinking about the wage input as well. And that is something that certainly policymakers are going to have to reflect on stateside with the UAW. I mean, if they're asking for upside of between 30 and 40% in terms of the wage, we don't know what they're going to land on, but they've rejected the 21% or so that's been offered by some of the automakers. So the stickier wages as well, and that's, this is potentially a 3-year deal. So that locks higher wages in for a prolonged period. Good news, certainly for union members,
yes.
But the consequences in terms of higher and stickier wages.
Yeah, and certainly that is much more consequential from the auto side, as we were just saying, because it's a much broader strike. From the Hollywood side of things, as I say, we're actually only really halfway there. The actors are still on strike.
Right.
And so until that gets done, that part of that strike story isn't going to get resolved.
OK, yeah, important detail there. Sam, thank you very much. Sam Unstead from our Markets Today blog, with plenty of the stories that they're covering on the on the Markets Today blog. But you can find that through the Bloomberg UK website, or you can type TLIV Go onto the Bloomberg terminal. Let's get some individual stocks on the move. Joe Easton joins us from our equities team. Joe, we just got a heads up on a couple of stocks that could be on the move as a result of the Hollywood news, but your focus elsewhere.
Absolutely. Morning, Anna. So we are getting news of SBB in Sweden, the big real estate company, potentially getting a $720 million boost as they look to sell a stake in their school buildings business to the Canadian asset manager Brookfield. Now, this is the first boost for the CEO that came in June and is tasked with handling the company's $8 billion debt pile, so it could potentially provide some relief. Now, this is the worst performing stock on Sweden's OMX this year, down 82%, as we can see from the screen here. And it really is reflective of the entire troubles of the real estate sector around Europe and the world as well. But Bloomberg Intelligence noting this morning that this is only potentially a short-term boost because there is still a long way to go if they are to tackle their debt servicing costs, but a minor relief for the company for sure this morning.
Joe, good morning. About a month ago, Italy announced this controversial windfall tax on banks. It caused a lot of fuss at the time, not just because of the move, but also the way it was kind of announced. Now there's a weekend development which might be underestimated by the market. I mean, Valerie Titel on our markets team here was kind of suggesting that maybe this is kind of good for BTPs if that there's kind of a new get-out clause that forces banks to buy more bonds. Tell us what the story is, what the development is. What's your take?
So this is potentially another watering down of that news, Mark. The reports of the weekend saying that some banks will avoid paying this tax if they set aside more capital for a rainy day. However, if they then use that money to pay dividends and buybacks, it will then be taxed. It's also going to be potentially capped at around 0.3% of the bank's risk-weighted assets, according to multiple reports of the weekend. Now, there was a note from Citigroup a couple of weeks ago, and they said a measure like this that we're seeing announced potentially at the moment could reduce the impact on earnings from around 10% a year to around 5%, so a significant reduction in the earnings impact. As we can see, these stocks remain significantly higher this year, given the benefit of those higher ECB interest rates and the big payouts that the companies have been doing. So there's a long way to go until they raise their gains for the year and potentially, as I say, a watering down of those measures at the moment.
So, Joe, from banks to gambling and online gambling, in-person gambling as well, Entain is a bit of a gauge in terms of how much appetite we've had for gambling over the summer.
So Entain, Tom, a bit of a surprising profit warning, it looks like to me. They're citing regulatory headwinds in the UK, slower markets in Australia and Italy, and saying that they expect their pro forma net gaming revenue to be down by a single-digit % for the year ahead. This is the UK's largest online and in-person gambling company, as you say, with Flutter as well, the big rival today. The one thing that traders are pointing to, however, is that the overall headline pre-tax earnings guidance is reiterated. So there is a bit of strength in there, but definitely negative. They say that they will review some of their businesses and look to focus on the higher growth units and also their structure as well. So clearly they are seeing some issues at the companies. We can see Entain actually underperforming. They did a bit of a capital raise recently and this is potentially negative at the moment for that one.
OK, Joe, thanks very much. Our equities reporter, Joe Easton, with a full briefing on some of the stocks that could be on the move. Mark, just a few minutes then until the start of trading, and a focus on commodities, perhaps, because it has been such a story. As you said, a couple of weeks ago, we were watching oil take out these sort of $95 a barrel mark on Brent. Then it sort of paused. Now we are seeing a little bit of upward movement, contrasting that with iron ore, which is actually down by 3.7% this morning over in Singapore.
Yeah, since we started the show 53 minutes ago, oil prices have got look a bit more perky. Energy prices, UK gas prices have opened up higher. And in fact, even iron ore is pairing its kind of losses. So I think we're still seeing that dynamic we've talked a lot about in this show. The idea that there still seems a market that wants to bring oil prices higher, whether it's the hedge fund positioning out there, whether it's the fact that we've kind of had this market that seemed really extremely overbought and excessive, and yet we've gone nowhere the past week. We have not withdrawn. And so this is the market that might consolidate for a bit longer, but it feels like the next move is still higher.
So we get the Cushing data out later this week, which we know is going to be really consequential for these markets. Are you convinced by the argument that this is all about supply rather than demand?
I think it is mainly about supply at the moment, and I think the backwardation in the market shows that. You know, it's people clamouring to get oil at the front end because they just can't get the supply through. But if it was a real demand move, you wouldn't see such an extreme backwardation in terms of that. You'd expect the long end of the curve to also go higher. So, yeah, I think it is more supply. But it's interesting, we also talked in the show, this story that Anna highlighted about the stimulus in China adds up to more than people think. And so maybe there's just more real demand coming through from China than people have estimated.
Well, that's really interesting as well, given the story on the Bloomberg today about the number of flights that people are going to be taking over the national holidays. Something like 21 million, the population of Australia. Yes. So just a reminder, that domestic airline lift, potentially for oil. Coming up, of course, UBS says it is working at full speed with the integration of Credit Suisse. We speak exclusively to the CEO, Sergio Armotti, and thank you, of course, for Mark for walking us through the key market themes this Monday. The Open is next. This is Bloomberg.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in, but I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
A few minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom McKenzie.
And here are your top stories. Chinese property stocks drive Asian benchmarks lower after Evergrande cancels a creditor meeting. US Treasury yields climb amid ongoing concern over a possible government shutdown. The EU's trade chief warns China the bloc will be more forceful in upholding fair competition. Plus, troubled Swedish landlord SBB gets a $720 million cash injection from Brookfield Asset Management, making the Canadian investor the majority shareholder. So, Anna, we're looking, of course, ahead to some data out of the Eurozone and the US later this week. We're watching oil prices, watching iron ore prices, but the sogginess certainly coming through from Asia.
Yeah, absolutely. Sogginess from Asia, and specifically from China, actually, because Japanese stocks going higher as a result of the weakness in the yen. This is all post-BOJ of Friday, but that's not dominating the overall Asia theme. MSCI Asia Pacific moving lower as a result of weakness in China, down another 0.4%. Nasdaq futures, though, pointing higher, up 0.3%. We'll keep an eye on Apple in particular, the launch of some of its new products, just hitting the showrooms and people getting to use them for the first time. This is the oil price. We talked a lot about this last hour, up by 0.7% this morning. We'll focus on that Cushing data, Tom, later on this week. And iron ore down by just shy of 4%. A focus again there on the weakness in the Chinese story. Do we overstate that? But that seems to be where iron ore traders are focused this morning. And also perhaps a lack of stockpiling of iron ore going into some of those important holidays in China.
And that story may tie into why we're seeing the biggest losses being flagged by these futures on the FTSE 100, pointing lower by 0.4%. Slightly less negative picture over in Germany, but still the downside being flagged at 0.2%. The CAC current pointed lower by 28 points, Anna.
OK, so expectation then from the futures picture is that we'll see a bit of weakness at the start of the European trading day. Not getting much of a clue in terms of risk appetite from the FX markets. It was there just a moment ago. There it is. Euro's pretty flat. The dollar's pretty flat. The pound also pretty flat as we go into another trading week. And as we were discussing last hour, last week we had a lot of set-piece central bank events. Yes, this week we've got data, PCE, inflation data, European inflation data. All of that will be really important, and the oil reports. But maybe a few more unpredictable elements to keep in focus. The shutdown conversation, the strike conversations over in the US, even if some of those being resolved at the margins. This is what we see then for European stocks, down by 0.4% on the Spanish IBEX. The French CAC 40 also down by 0.4%. The FTSE down by 0.3. So actually not seeing much of a divergence around the commodity story. Weak iron ore will weigh on London, but it seems to be kind of in keeping with the rest of the markets. The German DAX down by 0.3%. This is the picture then for the sovereign bond markets. We're selling stocks, we're selling bonds. We've got a little bit of strength coming through in these yields. Mark was flagging the 30-year Treasury yield to us earlier on. And I mentioned the weak iron ore price. Well, that certainly is not what is showing up on the commodity space. Just as Mark was talking to us, we're seeing a little more strength in the oil price as we go through this morning. We focus on the data on that front this week, and a bit of strength in natural gases, and perhaps natural gas, and perhaps that is weighing. All of that commodities green is outweighing any negativity around iron ore for London then, Tom, in terms of the stocks trade.
Well, we're breaking out the energy story then. The energy sector is currently down 0.2%, but basic resources is taking the biggest hit across your major sectors as a result of the softness in that iron ore price. So basic resources as a sector currently down 1.7%. Energy off by a little marginal kind of 0.2%. And we continue, of course, to reflect on the hedge fund positioning around oil and, of course, the Cushing data that we're getting out later this week. Other big movements coming through across your sectors. You're looking at downside in terms of travel and leisure of about 0.8%. The auto sector's taking a bit of a hit as well, off by 0.6%. And retail also lower by around 0.5%. Every major sector in the red this morning, so that negativity permeates through these sectors, but it is being more pronounced across retail, basic resources, travel and leisure down more than 1%. And again, across your benchmark, European Stoxx 600 off currently in the session, early days, of course, by 0.3%. There's some breaking lines crossing now around Amazon and an investment. So switching focus to technology, investing as much as $4 billion in the AI startup Anthropic, which is based in the US. The line coming through that Anthropic will use that Amazon investment and Amazon chips to build and train AI models. Amazon partnership with Anthropic will boost generative AI efforts. So we know, of course, that Amazon has AWS, the cloud data and cloud services, cloud center, data centers, part of the business, so important for Amazon in terms of the revenue driver. And of course, they have their own chips. So now partnering with Anthropic, which was set up by some previous executives, people who used to work at OpenAI. They're now rivaling OpenAI. Previous investment for Anthropic has come through from the likes of Google, but also Alameda Research, which was linked to Sam Bankman-Fried as well. So slightly more controversial funding on that front. But the Google backing is important, and now the Amazon backing as well, to the tune of what, about $4 billion US dollars, as the competition around generative AI really starts to heat up, Anna.
Yeah, absolutely. And I think Amazon was seen as a bit of a laggard amongst these big US tech players on the AI front. So interesting to see this announcement from them today. Tom, let me take us to the Swedish property sector, where we have some movement on SBB. We mentioned this, Joe Easton mentioned this in our stocks to watch this morning, and it certainly has proved itself a valid stock to watch. SBB gains as much as 38%. You can see it up by 37% in session today then in Sweden, as the business gets a $720 million investment from Brookfield. So they've taken away, they've got that money from Brookfield, and they are, as a result, in a much stronger position, it would seem, on the balance sheet. That's what the market is concluding, and the stock goes higher today. Interesting, as I mentioned earlier, to see that the central bank is being asked about this over the period of last week when we heard from the Riksbank, and they were saying that there are, of course, the ones that are in the press for distress on their balance sheets, and then there's the rest. So we'll see how this story develops from here, whether this is ring-fenced sufficiently. Sam Ulstead joins us from our equities, from the Markets Today blog, of course, to take us through some of the stories that you focus on. I was too focused on SBB there, Sam, but now let's turn to other matters, and in particular the pound. Really interesting story and commentary over the weekend, talking about how the pound, a year ago, was really beaten up by the Liz Truss administration, the after effects of that so-called mini budget, with a sort of maxi effect on the currency. And now the pound perhaps finds itself a little under pressure again. What are you watching?
Yeah, so I mean, you mentioned this morning the pound's sort of flat this morning, but it's flat and hovering around those kind of 6-month lows that we hit over the course of last week. As you say, over the weekend, it was the anniversary of the mini budget, and now you're seeing a lot of bets coming in on the pound to fall even further, because the Bank of England has gone on pause. That is refocusing everything on the fundamentals of the UK economy, and they don't look too rosy at the moment. And so there is a lot of bets going in that the pound versus the dollar is going to be a winning trade.
Yeah, watching the next level for the pound then, as we weigh up the downside coming through for this economy. You're also looking at a bit of this controversy once again swirling around the Prime Minister, Rishi Sunak, here in the UK, around how he's thinking and how his team are thinking about investments in rail infrastructure.
Yeah, and HS2 in particular, HS2, I mean, a conversation topic in this country for, I don't even remember how long.
And like a decade.
I think it probably is actually very close to that. Yeah, you're quite right. This is actually coming up as well to the party conferences over the course of the next month. So the sharpness of the criticism is likely to increase a little bit as you go over the course of this month, with an election likely next year as well. And certainly, the initial indication appears to be that they are at least considering walking away from a part of that line. And there's actually some criticism out this morning already from, I think there was a lead in the Times, I believe it was this morning, from George Osborne and Lord Heseltine, sort of criticising that decision.
Yes, there's a lot of kickback against it, and we're heading towards Tory party conference, basically heading towards all of the party conferences for the UK political parties. What are we expecting from the UK, from the Labour side of things? If HS2 is going to be one of the focuses for the Tories, what are we expecting from Labour?
I think you're expecting a very different Labour Party to the last couple of elections. The last couple, led by Jeremy Corbyn, very different kind of view towards business and very different noises made towards business. Their party conference this year is going to have a lot of major companies, major corporates there. The British private equity trade body is going to be there. So it's certainly a very different pitch from Labour this time around.
I love the headline in the BN. UK's Labour Party swaps Mao jokes for business charm offensive. Yes. And so that is what is expected to come through at that party conference. Sam Ulstead, thank you very much indeed, walking us through some of the key things to be watching with a particular lens on the UK, of course, from our Markets Today team. You can get more from the team on the front page of the Bloomberg UK website or by typing TLiveGo on your terminal. Let's check in on some of the individual stocks on the move. And Joe, you called some big ones, Joe.
So these gambling stocks are opening lower in the UK and also in Ireland as well. Entain now down around 4%. They do warn of a weakening in some of their gambling spending revenue over the summer, and also particular weakness over in Italy, notably Jefferies analysts saying that they will cut earnings estimates by around 10% for the next 3 years. And we're seeing read across over on Flutter as well in Dublin. Now, SBB, as you said at the open, they're absolutely rocketing earlier, up 28% now as they get this $720 million cash injection from Brookfield over in Canada. They do have around $8 billion in debt, as we said, in stocks to watch, but this is a big boost for that stock, clearly, as we see on the screen here. In terms of the high-speed 2 rail issue that Sam Unstead was talking about there, this is a negative for Balfour Beatty. They make this railway with Vinci over in France. Vinci is a much bigger company, though Balfour has a market cap of around 1.5 billion, and it's an important project for them, and that stock is slipping around 1.3% after reports that Sunak could be looking to shelve the northern part of that line, the part that goes between Birmingham and Manchester, a negative for that building company this morning. Then we'll have a look at some of the mining stocks, all deep in the negative there. This, of course, coming from the news of iron ore futures slammed over in Singapore, down 4%, a massive drop, adding to an 8% decline from last week. So Anglo-American and also ArcelorMittal, the two here, those ones are some of the biggest producers of the metal and among the biggest decliners, but we're seeing red across that sector this morning. Then on the ratings changes, Bank of America swaps Gucci handbags for charm bracelets. They downgrade Kering, becoming the only broker with a sell equivalent rating on that stock. They say that Kering has become a cyclical stock because it's so exposed to aspirational buyers, the Gucci brand, and they're warning there that that stock could start declining soon. Pandora they like, given the valuation, and they say it's showing a bit of strength in some of their sales at the moment. In terms of Ubisoft, this one is upgraded over at Exane BNP Paribas. Interestingly, they cite the Star Wars game that's coming out from Ubisoft. They say that's the boost there. So the force is with that stock this morning. And AstraZeneca, this one gets an upgrade over at Jefferies, who says that the cancer drugs are strong, but the non-cancer is also positive as well. The asthma drugs boosting the stock. They upgrade their earnings estimates and lift Jefferies on AstraZeneca to buy.
Joe, thanks very much. Joe Easton from our equities team with plenty of stocks on the move this morning. Let's get a briefing on what's coming up this week. Today, we'll get Germany's IFO Business Climate Survey, so that's going to be a feature of Monday's trading session. Then on Tuesday, US data, including new home sales and consumer confidence, will be released. On Wednesday, the French budget for 2024 will be unveiled. President Emmanuel Macron has promised to find at least 15 billion euros of savings to cut the deficit. We are expecting him to make some comments on green issues today. On Thursday, we get a barrage of inflation data from several European countries, including Spain and Germany. And later in the day, Nike earnings will be coming out, so we'll watch for any read across into other listed sportswear makers, for example, the likes of Adidas. And on Friday, the Fed's favoured inflation gauge, PCE, will come out. So, Tom, a real focus on inflation then at one level with the European data, the US PCE data. We're going to get some central bank speakers as well, trying to add their steer, I suppose, on what we heard last week. And as Mark was saying, quite difficult to draw fixed conclusions about last week from all of those central bank meetings.
And some more volatility then in the docket or in the cards around the Treasury markets as well. Interesting that Bank of America says the 10-year yield could get to 4.75 and peak out there. Of course, that debate remains live in terms of how much more selling pressure is going to come through, particularly for the back end of the Treasury curve, and maybe some of those Fed voices and inflation data will help give a little bit more clarity. Coming up, UBS says it is working at, quote, full speed with the integration of Credit Suisse. We're going to speak exclusively to the CEO, Sergio Motti. That's later in the show. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
There's a lot of information we need to collect. We will not be satisfied that we are where we need to be until we see inflation confidently. We're confident that it's on a path back to price stability, because the American public, as much as they're getting relief, you all didn't ask for us to just get a little relief and call it a day. You really asked us to do our job.
That was San Francisco Fed President Mary Daly giving her thoughts on the Fed's inflation fight. Let's bring in Raffaella Denconi now, founder and managing director at ADA Economics. Raffaella, we've been discussing on the show this morning the confusion, really, the lack of clarity on the picture around these central banks, the Fed, of course, included, that maybe last week there'd been an expectation that we would have a little bit more clarity in terms of the trajectory going forward. But we're looking at a picture now where dot plots are flagging an interest rate of around 5.1% by the end of the next year, so fewer cuts than expected, a soft landing, a Goldilocks landing, but also, of course, concerns, deep concerns about recession risks coming from other parts of the data set and other views from economists. How much clarity do you have, Raffaella, as we think about the Fed speak that's going to come through this week, as you project out to 2024, right now with the focus on the Fed?
Good morning and happy Monday. I have to say, I don't really think you're going to get a lot of clarity most of this year, frankly. I think the central banks are very keen to restore their credibility. The labor market is likely to remain tight. I mean, we do have the US shutdown, which near term, but broadly speaking, you do have a structurally phenomenally strong labor market with the strikes on top. So I think that the central banks will remain essentially very hawkish through the end of the year. But fundamentally, what the dot plot said to me was that 5% nominal interest rates is neutral for the US. So it's compatible with high growth, which I think it's 150 basis points too high. So I still have a strong conviction that next year you'll see big rate cuts and exceeding what market expects in the US and in the Eurozone, because I think you will see investment faltering in the next few quarters. And that is what is going to make the central banks rethink their communication strategy into next year.
Okay, good morning to you, Raffaella. So you expect investment to falter. Why so? Why now? Why did it not before? Is it a story of resilient balance sheets being degraded for US corporates? Why will things suddenly become much worse on the investment side?
Well, so far, you had a lot of structural support because since 2008, corporates have increased their cash balances and profitability has been really robust. Also because, especially in the US, consumption was staying strong. But as you go into next year, and the communication of the central bank remains that interest rates will stay this high, I mean, corporates will really need to face much higher funding costs. I think implicitly, a lot of companies were just hoping that the central banks will stay hawkish this year, but borrowing costs will stay much lower next year. So I think the uncertainty for me is very important at this stage. Second, the fact that you do have some slowdown in US household consumption as savings are run down. And actually borrowing costs, they're objectively very high if you need to do investments. So the first thing they're going to do is to cut CapEx.
Raffaele, you have a view. I want to get your view and kind of unpack the forward look on Europe, because I wonder how you square the view. One of the lines from your notes to us says, don't be too gloomy on Europe. And yet you think more cuts will come through next year from the European Central Bank. How do you square those two things? Presumably the cuts come through because the economy is doing badly, and yet you say don't be too gloomy on Europe.
Okay, so first of all, we are saying the ECB will take the refi rate to 350 next year, which is lower than where we are now, but it's quite high in historical terms. So I would say the first thing, take stock of the fact that the Eurozone can expand even at much higher interest rates than before. Second thing is, in the very near term, I think the manufacturing sector is pivoting and is going to actually improve in the next few quarters. So that's my message on why don't get too gloomy. But especially for the Eurozone, where the war is really next door, investment is really important. Don't forget that the European Commission has an enormously ambitious target to raise investment spending in the EU in order to finance all of these transitions that they're trying to do. So if you're going to raise investment, you definitely need lower cost of capital. Definitely, you don't need a recession, right?
Okay, so the focus on the Eurozone often around the more industrial side rather than the consumer side, but looking at something that is really interesting on the consumer side out of Germany, Raffaele. I saw some headlines today talking about the German house prices falling at their steepest pace since at least 2000. It's not necessarily a news story because they have been falling since the end of last year, but they've been weak for a very long time. When do you see any kind of turnaround for German data on any front?
Well, I think Germany has a structural growth problem. So I think people shouldn't completely put in the same basket the Eurozone outlook in Germany. Germany is definitely going to be a laggard for several more years. In manufacturing, if I am correct, that Chinese stimulus is going to feed into European data, into the end of the year and into the first part of next year, German manufacturing will show that already in the next few months. But consumer spending and real estate in Germany, I think it will stay weak for several more quarters.
Raffaele, thanks very much for your time. Raffaele Zenconi, founder and managing director at ADA Economics. Coming up on the programme, we'll stick with the real estate theme. Swedish landlord SBB is surging more than 30% this morning after its deal with Brookfield for a cash injection. We'll dive deeper into that story next. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 23 minutes into a European trading session that looks a little bit weaker. US futures, though, point higher, 0.4% higher on Nasdaq futures. Let's go to the property sector. Shares of the Swedish landlord SBB are surging this morning. The company has agreed to sell a 1.16% holding in the education division to Brookfield, a deal that would get SBB $720 million of cash injection. Joining us now, Bloomberg Stockholm Bureau Chief Charles Daly. Charles, good morning. Thanks for telling us this story. So what do we know about the deal this morning?
Hi, good morning from Stockholm. Yes, SBB has struck a deal with Canadian investor Brookfield, which already owned 49% of this education division. And what that means, the stake now essentially means that Brookfield becomes the majority owner in this division. And then that in turn will become a standalone entity, allowing it to raise financing and in turn hopefully improving the overall credit profile of SBB.
And Charles, you know, of course, but maybe some of our viewers don't, that SBB was kind of the unfortunate poster child of the challenges around the real estate sector in Sweden. Does this mark the beginning of the end for SBB in terms of its travails and the broader property sector in Sweden? How much of an uplift does this come through in terms of the corporate, but also the broader sector?
Yeah, I mean, obviously the equity investors are cheering the news this morning with shares surging. But I think it would be wrong to say that the company is out of the woods yet. It has a debt pile of nearly $8 billion, and it obviously needs to sell assets, it needs to raise equity, and it needs to find further equity partners such as Brookfield. So the challenges it faces are still huge. As for the wider property sector, I think you're absolutely right to flag SBB as a poster child for this crisis. All I can say is I think it will probably have a good signaling effect for other companies in the sector, but to say that the broader industry is now on a path to recovery, I think would be premature.
OK, Charles Daly, thank you very much indeed. And the latest when it comes to SBB raising some capital, so a little bit of relief coming through. The stock is up strongly. And Anna, we've been looking at lines as well, China's reaction to this EV probe by the EU, and of course at a time when the Trade Commissioner is on the ground in China. Yeah, absolutely. So Valdis Dombrovskis, EU Trade Commissioner, visiting, making these comments about de-risking, not decoupling, but all of this coming under the cloud of the recently announced probe by the European Commission into EVs. And we're getting these lines through from China. They then saying this morning that the EU's planned measures on EVs are not in anyone's interests. Also getting a couple of lines as well when it comes to the European Central Bank. Just very briefly, we've got data coming out later this week around inflation from the ECB. Villeroy, Bank of France, but also a governing member of the ECB, saying the ECB should focus on persistence, not pushing rates up. OK, coming up, UBS says it's working at full speed with the integration of Credit Suisse. We'll bring you our exclusive conversation with the CEO of UBS, Sergio Ermotti, speaks to the programme. We'll bring you that conversation. This is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European shares fall after a negative session in China amid mounting concerns from the country's real estate sector. SBB shares there surge after the troubled Swedish landlord receives a $720 million cash injection in a deal with Brookfield. Plus, the EU's trade chief warns China the bloc will be more forceful in upholding fair competition. Tom, so I mentioned there the negativity coming through from Asia, the way we saw weakness in the Chinese session, the property sector in focus, but things turning around and actually coming back to the flat line for European stocks.
Just ticking into the green right now for European stocks. And if you look at the benchmark right now, it doesn't tell the full story. It would look pretty dull because it's flat. But the previous picture, of course, you take that into context in terms of the downside that had come through at the start of the open 30 minutes or so ago, and you were down about 0.3%. That has turned around, so we'll unpack the catalysts around that. The DAX currently posting gains of just 3 basis points. The FTSE 100 still in the red, down at about 0.1%. Certainly basic resources as a drag there. The banking sector, though, is coming through with a bit of a lift. Very modest, of course, for these European stocks. Let's have a look at how the sector breakout is shaping up then around 30 minutes into the trading session. And as you can see, it's the banking sector that is one of the sectors now in the green, getting about 0.6%. Industrials are gaining just 0.1%. Retail is flat. But yes, a turnaround. The pressure still coming through for travel and leisure. The pressure still, of course, coming through for basic resources, down 1.6%. But broadly, unch on the benchmark, but that's not telling the full story. There has been a bit of a turnaround in sentiment, very modest as it is, Anna.
Yeah, absolutely. So sentiment improving a little. US futures pointing a little higher, up 0.4% on Nasdaq futures, for example. Let's step away from the immediate mood in markets to the bigger picture, consolidation in the banking sector, in fact. UBS Group CEO Sergio Ermotti says the business is making good progress on the Credit Suisse integration. He sat down with John Liu, Bloomberg's managing editor for Greater China, for a wide-ranging interview on his first trip to Beijing since taking over UBS.
Things are progressing very well. We made shift very swift progress in integrating Credit Suisse. We closed the transaction in record times, also thanks to the big cooperation of regulators across the globe. And that's one of the reasons why I'm also here today in Beijing, because this is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China, while also updating them on the integration.
So I do know that here in China, UBS has a securities venture. Credit Suisse also had a securities venture. It would seem to make sense to sell out of the Credit Suisse venture. Is that something you're pursuing now?
Well, we are currently evaluating the best options. Of course, we are not allowed to have two operations, but we need to really understand exactly how to do that. We are very happy with our historical operation here in China. That we were the first to get the license as a foreign investors to own a controlled stake. So it's a very important element of our strategy in China. And now we need to exactly evaluate how to integrate or what to do with the CS operation.
Sort of how far have you progressed in that process? Are you looking at potential buyers? Are you talking to anyone yet, or has it not gotten to that place?
At this stage, we are examining the situation.
Okay. In your second quarter results, it mentioned specifically that client confidence, sentiment, and activity here in Asia was muted. Are you still finding that's the case into the third quarter?
Well, I think that we saw in general a little pickup in across the globe, also in Asia, in terms of client activity. So the most important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue. But also in general, it's fair to say that investors are more constructive than they have been recently.
So on the momentum you talked about in Q3, there was a net new money inflow of about $16 billion in 2Q. You said at the time you expected that to continue. What is it looking like in 3Q? What does good momentum mean?
Well, I mean, we are pursuing similar patterns, so we are not going to be specific on numbers. The quarter is still ongoing, but the most important issue is that we see substantially our forecast being confirmed, and we are getting to the close of the quarter. So I think that's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations.
And in Asia, I believe in the second quarter there was a net money inflow about 1.8 or so billion US dollars in Asia. Do you see a similar sort of trajectory in the third quarter as well?
Yeah, we see positive trends across the globe in each region. Yeah.
What about here in China? What does the sentiment feel like? Not only here, but like globally, the perception of China and Chinese assets.
Well, look, in general, in the globe, we are going through very challenging times in terms of macroeconomic. In terms of the macroeconomic picture, of course, the geopolitical tensions are not helping at this stage. But I do believe that many investors still see the long-term potential of China. It's exactly how to navigate the current situation that makes our job even more important. We are not only here in China but also abroad are helping clients to understand China, how to invest into China, and also for Chinese investors how to invest abroad. So I think that we see this situation as a evolution of almost natural evolution of things that happen over the last 10-15 years. The macroeconomic, the geopolitical picture has changed completely, and this is part of the journey.
When your employees here in China, when regulators here in China or clients, partners ask, do you have plans for more investment? What are your plans for China as part of the new UBS? How do you respond?
Well, we respond that we have been here in China for 30 years. We were one of the first to be in China and to make substantial investments, and is exactly the reason for my visit is here to be to reiterate our commitment that we see China as an important driver for growth for us. Right now, we are very busy in integrating Credit Suisse. We are very busy in managing our current business, staying close to clients, but we are not losing sight of the opportunities that are still there to grow organically, both in the US but also in Asia and particularly here in China.
Recently, there was a Bank of America survey of global investors that identified Chinese property as the thing that people thought most likely could cause the next global credit event. Where is it ranked for you in terms of risks?
Well, we know that almost any major crisis, if there is one, is triggered by either a real estate crisis or a government debt crisis. So I think it's quite clear that the situation in China is fragile around the real estate sectors. The government is taking actions to contain and to help manage this very difficult situations. But of course, if there is one part of the economy that is exposed to potential threat is the real estate sector.
Back to the integration of Credit Suisse. It's taken your headcount, your staffing, to about 120,000 globally. And you've talked about, pretty forthcoming about the need to reduce that number. How much of a reduction do you think is needed at the end of the day?
I never really spoke about the need of reducing headcount because it's not my and it's not our philosophy. What we need to do is to restructure the bank. Credit Suisse needed to be restructured, profoundly restructured because out of this situation, and then we need to extract the synergies that are necessary to make both businesses viable and stronger. So we are taking actions as we speak to resize the business. We are also taking advantage of the fact that we had natural attrition that is helping across the globe. We have demographic trends helping in that sense. People exiting the bank through retirements or early retirements. We are working also in facilitating movements of people within the bank, also between the two banks as we speak. So I think that I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
Okay, that of course was the UBS CEO Sergio Ermotti speaking to Bloomberg's John Liu in Beijing. A couple of lines crossing then from that interview just on his views around China. UBS has very limited direct China property exposure. Still sees, though, investors having positive views on China in the long term in terms of the potential there, and also addressing the question around those assets, of course, linked to Credit Suisse, saying that there has been some progress there, but almost impossible to get back all of those assets.
Really interesting that he makes this visit at all, isn't it? Because as John Liu was asking, trying to probe for his views on the opportunities in China. There's UBS recommitting to China, I suppose, by this visit, because this is a business that's really busy doing other things with the Credit Suisse integration. But he says there's still opportunities to grow, and some of that coming from the US, some of that in Asia, specifically in China. So that recommitment and that appearance in itself, news, I suppose.
Very diplomatic in his language, of course. He's absolutely right. They have been there 3+ decades, and they were one of the first banks to get licenses around securities business in China. So they're kind of ahead of the curve on that front. But clearly, it's a challenging operating environment. But as you say, points to the importance of that business for UBS going forward. Coming up, President Biden switching focus. We're going to focus on his visit to the auto workers, of course, on the picket line, showing presidential support for their workers and the union. Is that a thawing relationship, or is there a thawing relationship now between the unions and the US president? We're going to discuss that next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
UAW Union President there, Sean Fain, talking about work still to be done on these strikes and conversations with manufacturers. Now, President Biden says he will travel to Michigan on Tuesday to support striking United Auto Workers Union members. His announcement comes as GM and Stellantis are facing walkouts at 38 more facilities after talks last week failed. That's an incredible number of production locations. Let's get to Bloomberg's Oliver Crook, who can take us through the latest developments here, because this is being watched for the micro, what it does to the sector, but also for the macro, what this does to the US economy. A week passes then, Oliver. Where are we on these negotiations?
That's right. You saw there Sean Fain in sort of like military fatigues camo, really going out there to turn up the pressure on Friday, again, mostly against GM and Stellantis, and totally sparing Ford, saying that basically enough progress has been made there that they are content with that they're going to spare them. The question is, what actual progress has been made? We've got nothing in terms of the headline front in terms of the percentages for increases and that sort of thing. So what progress has been made with Ford? What we understand, it's an agreement on reinstating the cost of living increases, inflation protection for paychecks, which was suspended in 2009 after the restructuring of the auto sector, and also enhanced profit sharing. So that's where we think we've made some progress. However, Ford did come out, the one that's made the greatest amount of progress, saying there are still very complex and interconnected issues, and there's still significant gaps. If you look at what happened in Canada with the union there, they struck a deal with Ford, and they're going to take that model now to the other car companies. So in the U.S., they've taken on all big three. They found an amenable one, go to perhaps the diminished two, and maybe get an acceptable deal with the big three.
What is the political dimension here then, Ollie, as we hear about Biden's proposed visit to go and meet union workers? How are the politics playing into this?
Yeah, I mean, as you know, we have an election in the United States just over a year from now, which in U.S. political time is basically no time at all. And so Biden saying, it was Sean Fain who called to him, said, hey, come stand with us. And Biden's going to stand in the picket line tomorrow. And this is sort of an event without really precedent in U.S. history. Another event that perhaps does not have a great deal of precedent is the leading Republican candidate skipping the debate in order to give a speech on Wednesday in Detroit to, again, speak to the auto workers and try to woo the blue-collar vote. It's about Michigan, yes. It's about Pennsylvania and Wisconsin. These are states that have flipped back and forth. They went to the Republicans in 2016 when Trump won. They went back to Biden in 2022 when he won. And Sean Fain, throughout this whole thing, has really tried to stay out of the politics. There's that statement they put out last week saying, quote, We can't keep electing billionaires and millionaires that don't have any understanding of what it's like to live paycheck to paycheck and struggle to get by and expecting them to solve the problems of the working class.
Okay, so the political tension runs on. How long could this go on for then, Ollie, when you look at the extent of the strike activity and the demands being made?
Exactly. So let's look at one of the constraints, which is how much money there is in the UAW strike fund. So this is not really CPA level accounting, but it's sort of back of the envelope. They have $825 million in the fund. You get $500 a week per worker. You have 18,300 workers striking. That's about $9 million a week. That could mean you could go on for 90 weeks, right? So there's a lot of dry powder. And now they've only hit the the parts plants. There are still assembly plants for the Ford F-150s, the Silverados, the Rams, the real profit centers. They haven't hit those yet. And remember, even with the expanded strike, that's only 12% of the workforce. So you still have a huge amount of dry powder going into what may be still the early phases of the strike.
Okay, Bloomberg's Ollie Crook with the latest in terms of the strike, the politics, and just how long this all could run on for. But Ollie, thanks for the latest. Joining us, of course, out of Berlin. Coming up, Amazon making another big push to boost its AI presence. We're going to have more on that $4 billion investment in Anthropic, what it could all mean for Amazon and the broader push into AI. That is next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
Happy Monday. This is Markets Today. We are 53 minutes into the European trading day, and you are flat across European equities, pairing some of the heavier losses at the start of the session. US futures pointing up around 0.4%. To technology now, and Amazon is investing and will be investing as much as $4 billion in the AI startup Anthropic, bagging a crucial partner in its effort to become a major player in generative AI. Let's get the context now with Bloomberg's Alex Webb. Alex, tell us about Anthropic. Tell us about how significant this deal, this investment is.
Yeah, Anthropic is a
impressive company. It's got an impressive roster of founders who essentially were refugees from OpenAI. They left soon after the changes to OpenAI's essentially constitution. OpenAI was supposed to be open for the world. In the end, it started taking outside investment. So a bunch of them went and founded Anthropic, and it is a big player in the generative AI space, creating models that are very similar to ChatGPT.
Okay, so that's what it does. Why might Amazon need it then, Alex? What's Amazon looking to get out of this?
Amazon has very much been seen as a laggard in this space. You know, Google obviously got strong AI chops. Google Bard is their forward-facing like chat model. They also have Microsoft as the big competitor in cloud. They are very close to OpenAI, so they have got first dibs on a bunch of generative AI stuff. Amazon did not, and so this potentially beefs up their capabilities in that space, which helps them when it comes to the battle for the cloud.
Alex, what does it tell us about the business model for generative AI? I speak to some people in this space and they talk about just how much is needed to build out the compute to underpin these models. How is the business model changing in the way that these different companies are looking at it?
It increasingly looks like it is a sort of piece of technology that gets companies to build their products on your particular cloud. So if you're Amazon, now you have something to encourage a company to build on AWS, on Amazon Web Services. Google obviously has been using its AI stuff to get people to build on Google Cloud, and OpenAI gets people onto Microsoft Azure. That's where they make the money, right? On the cloud services, the processing cost of this stuff is high. You're not necessarily going to be paying directly for the language models, for the generative AI technology. You are paying for the compute that's needed to drive it, and that's where the likes of Amazon, Google, and Microsoft are looking to make money.
Okay, Alex, thanks very much. Bloomberg's Alex Webb with the latest on Amazon and what it's doing on the AI front. Really interesting. We'll get to the markets in a moment, Tom, but really interesting to see Amazon make this move. And it reminds me, just listening to Alex there, reminded me of some of the reporting and research I've been reading recently about whether companies decide to go to use the large language models and use very general applications around AI, or whether it's going to be about companies that create specific solutions for them using AI tools. There's a lot we don't understand perhaps about the way businesses are going to jump on this trend.
Well, and how investors position around that theme then, whether they do invest in those companies that are building out the products on top of the models or invest in the models themselves, is going to be really consequential as well in terms of the money flow around this space. Checking back on the markets then, for now, you're looking at European stocks currently just clinging on to the slimmest of gains, but it has been a turnaround in the session, hasn't it, Anna? And in terms of what's happening across the commodity space, because arguably that's where most of the interest has been, at least so far in the session, a divergent picture when it comes to iron ore prices versus oil.
Yeah, absolutely. Stocks really flat. Nothing much to see in terms of the European story. US futures do point higher, but as you say, commodities in focus. We've got iron ore down by 3.8%. Some concern around the Chinese growth story weighing on things there. That doesn't seem to be weighing on Brent. Actually, a lot of volatility in Brent, though, because just in the break when we were talking, the Brent price was up by more than 1%. Now, not up that much, but 94.08. So we see a lot of movement around the commodities this morning.
That is a focus for us this morning, and that is it for markets today. But of course, you can get insights from us and the team on the front page of the Bloomberg UK website, or by typing TLive Go on the terminal. US futures pointing higher. The pulse is up next, and this is Bloomberg.
you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who've occupied areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. European stocks following Asian markets lower, all thanks to those renewed concerns in China's property sector. Meanwhile, some green on the screen in shares of SBB after the troubled Swedish landlord gets a $720 million cash injection from Brookfield Asset Management. Plus, the EU's trade chief warns Beijing that the bloc will be more forceful in upholding fair competition during his trip to China. That is your headlines. Let's get a quick check on the markets here and take a look at the European markets map, because already you are seeing a little bit of movement, but perhaps not the kind of movement that we actually want to see. A lot of micro moves is what I'm going to call them. The outperformer here is going to be the French index. Of course, you're seeing it higher by 0.1%, but the rest not moving much, which is interesting given that we are getting some German data as well. The September IFO Business Confidence Index coming in slightly hotter than what the estimate was at about 85.7. The estimate there at 85.2. When you look at their expectations index, I would call it right on par at about 82.9. The estimate there, 83.0 as well. And of course, the current assessment index, 88.7. The estimate, 88. Now, on the surface, it looks like some pretty inline data. But of course, we're going to get some real time analysis. We'll be speaking to the IFO Institute President Clemens Foist coming up at 9:20 a.m. London time. What does this all mean, though? Because, of course, the fear here is that do you start to see in these kind of micro pieces of data some sort of indication that Germany is, at the end of the day, going to be the sick man of Europe, dragging the rest of the continent and perhaps even the world with it? A lot of pressure on just one country. Let's see what the markets think. For more, joining me now is John Bilton, head of global multi-asset strategy over at JP Morgan Asset Management. John, pleasure to have you on the show.
Thank you.
Let's start with the data. What'd you make of it?
Well, you know, I think what it's demonstrating is that we've got some weakness going on, but you're getting to be towards something which is forming a bit of a base. I mean, the PMI data on Friday, showed Germany still in the depths of a contraction. So the issue I think that we've got is it starting to leak out more broadly in Europe, as you mentioned? There is some indication that France is starting to catch down to it. But I think what's interesting is over the course of this year, we haven't had that big sort of global slowdown that everyone came into the year expecting, because it's kind of like the baton's passed from place to place. So while I think there are some concerns around Europe in general, remember, inflation is now beginning to come down. The ECB are probably at peak rates. And at the same time, the US economy actually is looking as if it's hanging in there. So I think there's reasons to be perhaps seeing this more of a score draw than necessarily seeing it as being a big red flashing problem.
Well, the resilience is tricky here, right? Because when you look at the U.S. economy, you arguably look at the European data as well. We were supposed to be in a recession on the continent, 2 years ago? That never happened. I might just be jinxing it. We'll see. If we turn to a recession this winter, it's all my fault. Let's talk a little bit about what's actually priced into the markets here, because it's really hard to find the trade that works late cycle in an economic cycle, right? And it feels like Europe specifically and Germany specifically has been in that standpoint for 2 years now. What's the trade here?
Well, I think there's, first and foremost, Europe did have a recession. Think about it. But, Ireland and Germany, admittedly through technicalities in the data, took the Eurozone to the mildest of mild recessions over the course of the winter. So are we facing a situation where Europe gets pulled back down? And we think we'll see probably a couple of quarters of more or less zero growth. Could the Eurozone trip into recession? Possibly.
Yeah.
I think right here, right now, it's more a question of waiting. What's kind of interesting, within Europe, a lot of the more defensive sectors, things like pharmaceuticals, other parts of the defensive complex, starting to look kind of interesting, particularly now that we think we're coming towards peak rates. If inflation starts to cool, ECB at peak rates, excuse me, lower long-term yields, potentially could give a bit of a boost to those defensive segments. It's not the same in the rest of the world, though. If you look at cyclicals versus defensives in the US, actually there's a little bit more support coming through for cyclicals, more scope for inventory restocking. So perhaps a more cyclical tilt in the Americas, maybe a more defensive tilt in Europe, gives you a little bit of juice there.
How quickly does that defensive tilt in Europe get even more severe, especially as we're looking really down the barrel at $100 oil? We're looking at a conflict in Ukraine that's getting truly worse and worse, impacting suddenly not just the oil supply, but the commodity supply as well. Natural gas was never a strong suit to begin with. Talk to us about how that thesis of resilience, that defensive play, falls apart.
Well, I think we've got to be a little bit careful what we look at. If we look at the headline price of Brent, yes, I mean, high oil prices, if they go streaking upwards, it's a tax on the consumer. But for Europe, the most important piece is the natural gas price. And yes, we've seen some upside in terms of the front end of the natural gas curve, but contracts for delivery later on actually haven't really moved. So Europe's not facing the same very clear and present risk that it was this time of last year. So I think some of those fears can be taken away. Right now, we're facing a manufacturing sector in Europe which is going through a destocking cycle. Of course, very plausibly, companies decided to overstock in basic material, intermediate goods, etc., immediately after the invasion of Ukraine. And those inventories take some time to play down. And with a relatively lackluster consumer base in Europe at the moment, folks are very happy to sit on their excess savings, unlike their American counterparts. That means that you've got this lack of dynamism coming through in the economy. We think that the destocking cycle will play through, and at that point, actually, you'll have a relatively clean slate to play.
But you're saying that the European Union and European traders broadly have kind of priced in this idea of peak rates. How quickly does that thesis kind of collapse? Again, given the commodity story that we're talking about, yes, the idea here is that inflation has come down a little bit. Has it come down enough to say that it'll stay down, or are we still subject to fuel costs or utility costs, et cetera, which would then, the ripple effect there be simply that maybe the EU, maybe the ECB has to go even harder on inflation and turn that pricing in on its head?
Well, I think this is why we look at the difference between headline and core CPI. And of course, we've got the data coming through later this week. We think that the European Union will see, or the Eurozone will see, the headline inflation come down below 5%. We also believe that if you take food and energy, yes, it can have a pass-through effect in terms of headline inflation. But again, I use that phrase, it's a tax on the consumer. If you've got a consumer who's squeezed and they're suddenly paying more for their household spending, more to heat their homes, more to drive their cars, they're spending less on other things. So I think when we face, as we've read many, many places, something of a cost of living squeeze, it can actually have a countervailing effect on core because of forcing consumers to make choices. So we think the ECB will look through it. It's worth noting that we had comments this morning from DeCoste suggesting that we need to have time for the impact of higher rates to really come through. So I think we're seeing a much more balanced ECB council now. Yes, you're going to get the hawks pointing at inflation, but more and more I think you're going to have the doves saying, you know what, maybe time to wait and see. We've gone from negative rates to 4%, we
Yeah.
haven't seen the full effect yet.
I mean, then it brings up a topic of just how long the lags really even apply here, which don't worry, I will not make you answer. A little bit of cringeworthy words, isn't that right? John Bilton, head of global multi-asset strategy over at JP Morgan Asset Management. We thank you, as always, for your time and your insight. Coming up on the program, we bring you an exclusive conversation from UBS CEO Sergio Ermotti. Expect lines on the Credit Suisse UBS integration and, of course, business in China. That conversation coming up next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Things are progressing very well. We made shift very swift progress in integrating Credit Suisse. We closed the transaction in record times, also thanks to the big cooperation of regulators across the globe. And that's one of the reasons why I'm also here today in Beijing, because this is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China, while also updating them on the integration.
In your second quarter results, it mentioned specifically that client confidence, sentiment, and activity here in Asia was muted. Are you still finding that's the case into the third quarter?
Well, I think that we saw in general a little pickup across the globe, also in Asia, in terms of client activity. So the most important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue. But also in general, it's fair to say that investors are more constructive than they have been recently. So on the momentum you talked about in Q3, there was a net new money inflow of about $16 billion in 2Q. You said at the time you expected that to continue. What is it looking like in 3Q? What does good momentum mean? Well, I mean, we are pursuing similar patterns, so we are not going to be specific on numbers. The quarter is still ongoing, but the most important issue is that we see substantially our forecast being confirmed, and we are getting to the close of the quarter. So I think that's very encouraging to see that so quickly. Our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations.
It's taken your headcount, your staffing, to about 120,000 globally, and you've talked about pretty forthcoming about the need to reduce that number. How much of a reduction do you think is needed at the end of the day?
I never really spoke about the need of reducing headcount because it's not our philosophy. What we need to do is to restructure the bank. Credit Suisse needed to be restructured, profoundly restructured, because out of this situation, and then we need to extract the synergies that are necessary to make both businesses viable and stronger. So we are taking actions as we speak to resize the business. We are also taking advantage of the fact that we had natural attrition that is helping across the globe. We have demographic trends helping in that sense. People exiting the bank through retirements or early retirements. We are working also in facilitating movements of people within the bank, also between the two banks as we speak. So I think that I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
UBS CEO Sergio Armati there, speaking exclusively to Bloomberg's Jean-Loup in Beijing. Now, sticking with European banks broadly, let's talk about Italian ones. Looks like Italian banks will be allowed to avoid paying a controversial windfall tax introduced last month if they set aside additional capital reserves. That's according to a government amendment seen by Bloomberg News. Joining me now is Bloomberg's Chiara Albanese. Chiara, pleasure to have you on the show. Talk to us about the logic behind this move.
The pleasure is all mine. So the logic is kind of a compromise that the government is doing with lenders and also within the coalition. The main message and decision that we need to keep in mind is that the government is still planning to get the same amount of money from the levy, so around 3 billion euros. So banks will be allowed to opt out if they put aside sufficient capital reserves, but the requirement is so high that we might expect only a few banks to do so, meaning that they will prefer to pay the tax itself.
Does this mean, from a market's perspective, there seems to be this thinking that this is going to somehow create the extra demand for BTPs, pull down the borrowing costs, and ultimately let Giorgia Meloni's government borrow at a smaller rate. Is that good news for the budget, or is this good news for Italian banks? Who benefits here?
So for sure, the budget is going to benefit from the tax. The state will have more money from the tax. But we need to keep in mind that this is going to be diluted over time. Banks will only pay in coming months. So in the meantime, the government will find different ways to finance its budget. At the same time, I also think that banks will live with it. They have factored the fact that they will have to pay this tax in. They will set aside more reserves. So the compromise is very political, and the news has been absorbed by the markets and by lenders.
Certainly something we're going to be keeping a very close eye on. You can already see slight outperformance with BTPs off this headline. We'll see if there's more market reaction to come. Chiara Albanese joining us this morning. We thank you as always. Coming up, Germany's business confidence index fell less than economists expected in September. The IFO Institute president joins us to discuss the latest German economic data and more. That's coming up next. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Let's recap some of the data we got from the top of the hour. Germany's business confidence index fell less than economists expected in September. Joining us now for more is IFO Institute President Clemens Foist, joining us from Munich. Clemens, a pleasure to have you on the show. Thank you so much for joining us this morning. Let's start with a very simple question. The data came in kind of tepid, kind of lukewarm. Where are the indications that perhaps Germany is falling apart?
Well, I guess it's not falling apart, but it's not stabilizing. The German economy has difficulty leaving this downturn or stagnation, whatever you call it. So what we see in the data is a mixed bag. Companies are saying the current business situation is getting slightly worse, but they expect things to improve a little in the months to come. So it's not much change, but saying, like some people do, that the German economy falls apart is also an exaggeration.
So perhaps not falls apart, but weakness, as you just pointed out yourself, something you're seeing around the rest of the world. What kind of timeline does that mean for the rest of Europe? Is this something people should be watching as that Germany is the sixth man of Europe and will drag the rest of the continent, or is that an exaggeration?
Well, I think it's an exaggeration. We expect the economy to stabilize next year. At the same time, yes, I think what Europe needs to watch is that the outlook for potential growth for the coming year is lower. And that is related, of course, to demographic change, declining labor force. It's related to the particular part of energy policy Germany is taking. Its decarbonization strategy is extreme in the sense that it has switched off nuclear. It has an approach to decarbonization which is very regulatory. There is detailed regulation, a lot of bureaucracy, and this approach seems to be failing. Companies are telling us they face a lot of uncertainty, and it's policy uncertainty in Germany. And this is not good in a situation where the economy faces headwinds anyway. High energy prices, the energy-intensive industry is leaving. So there is a lot of substance in the German economy, but the government needs to make an effort to use that substance properly.
What does that then mean in terms of the bright spots here? Are there any when it comes to the German economy?
Well, the bright spot in the short term is probably that disposable incomes, that wages are stabilizing. So there have been some fiscal policy measures to raise net wages, some tax breaks, so that we expect a consumer demand to stabilize in the coming months. That's because wages are rising and prices are coming down. Inflation rates are declining, so that will lead to a stabilization of consumption demand. And of course, in a world with high inflation and stagnating GDP, one might say demand is not what's lacking. But what we do see and what companies do tell us is that we are in a transition towards problems coming from the demand side. So the bright spot is a certain stabilization of demand, and with prices stabilizing, also the perspective that the ECB may not raise rates further. That will also have a stabilizing effect.
Well, it's no secret. I mean, it's Europe 101 to know that Germany is and has been for some time kind of the beating heart of Europe in terms of economic growth. Talk to us a little bit about just how sustainable that actually is. I mean, if you look at the German economy, there are cracks, there are structural issues as well. To what extent can Germany have that reputation, for lack of a better term, continue into the next decade or two?
I would say it's unlikely to continue into the next decade. Potential growth will be lower. The demographics are one reason. I mean, this will also affect other countries in Europe. So it's a problem for Europe as a whole. And then there are particular issues in Germany. The energy-intensive industry, the chemical industry, the paper industry, these are industries that are currently making plans to leave Germany. The car industry is in a difficult structural transition, probably the most important sector in Germany. A lot will depend on government policies in that context. Government policies have created a lot of uncertainty for companies. There is a lot of bureaucracy, and the question is, does the government manage to turn this around, take a different path? If it does, I think there is potential
certainly something
in Germany.
We're going to be watching very, very closely. And Clemens, we're going to have you back on soon. We're sadly pressed for time, but we, of course, will be speaking with you soon. President Clemens, voice of the IFO Institute, thank you, as always, for joining us this morning. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
European stocks follow Asian markets lower over renewed concerns in China's property sector. Meanwhile, some green on the screen in SBB, shares surging after the troubled Swedish landlord gets a $720 million cash injection from Brookfield Asset Management. Plus, the EU's trade chief warning Beijing that the bloc will be more forceful in upholding fair competition during his trip to China. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lacqua. Let's go to one of the major market movers of the morning. Shares of Swedish landlord SBB surging this morning, higher by almost over 25%. The company has agreed to sell a 1.16% holding in the education division to Brookfield, a deal that would get SBB $720 million of a cash injection, an extension of a lifeline, if you will. Joining us now with details, Bloomberg Stockholm Bureau Chief Charles Daly joins us this morning. Charles, what do we know? How much does this prolong some of the issues that SBB has had?
Yes, hi, good morning from Stockholm. The cash injection basically covers SBB's short-term funding needs for the next 12 months. And as a consequence of that, we're seeing bonds also rally in the market today as well, alongside the shares.
What does that then mean in terms of kind of the broader real estate space? One of the concerns from a macroeconomic point of view is that even though this feels idiosyncratic to Sweden, perhaps it might be kind of the canary in the coal mine for the rest of Europe. Is this the kind of moment where SBB's worries are over?
No, I think it's very premature to make that conclusion. I think with a debt pile of nearly $8 billion, there is still a lot for this company to do, be it further asset sales, further equity partnerships, or even an IPO of one of its divisions. And I think in the current climate around real estate and the concerns that investors have, all of those objectives will be very difficult to achieve.
A fascinating story, I think, and again, one that has really macroeconomic ramifications for the rest of the continent. Bloomberg's Charles Daly joining us from Stockholm. We thank you as always. Now, at the core of this kind of property story, the housing story, is going to be, in the case of a recession, who gets hit first? And of course, we have seen this resilience show up around the world in the higher income, the higher wealth brackets of specifically Europe. And if you start to see that case for recession, that this property sector woe is getting even worse, who gets hit first? Well, it's going to be the higher income anyway, which brings me to the first sector that gets hit as well, and that, of course, is luxury. Who better to talk about it than our next guest, Rashid Mohammed Rashid, the chairman of Valentino and the founder and chairman of Alsara Investment Group, joins me right here on our Bloomberg TV studios. A pleasure to have you here right in person.
Thank you very much.
Let's talk with the macro here first. The future of luxury. We've seen this resilience, a lot of money, of course, coming in from China, from the Middle East. How long does that last?
Well, the reality, it have been, for the last few years, very resilient. I think last year, 2022, have been an exceptional year post the pandemic. We have seen luxury goods grow by 12 to 20%, depending how you treat the currency. But we came into 2023 with a prediction that luxury will probably grow 10%. We are seeing very strong signs that it will be much worse than what we expected. We have a number of factors at the moment which are impacting the market in a negative way. The American market is slowing down due to the reality that department stores are really in a suffering situation at the moment, plus the reality that spending is slowing down. The expectation that China will come into the market in a big way after the closure that they have suffered from in the last 2 years is not happening.
Yeah.
For many reasons people are aware of in terms of China and the economy inside of China. Despite the reality that Europe is still receiving a lot of tourists, but I think the spending of tourists is now becoming different. With the hike in the prices of airline and hotels, they are putting more money in experience and buying. Yeah. So all in all, we are going definitely to see in 23 a market which is less than 10% of growth. Yeah.
Well, that's really leading to your point about the slowdown you're seeing in luxury around the world, to consolidation with a lot of the American luxury names. We just had this major deal as well, I think, between Tapestry, another more consolidation between the parent companies, Kate Spade, Stuart Weitzman, et cetera. Is that a similar logic when it comes to the recent about 30% stake that Kering had taken in Valentino? Is it coming off of these worries?
Well, not exactly, because Mayhoola, the investor of Valentino, has the intention to be a long-term player in the luxury market. And it is very clear, as you said, that there is a trend towards consolidation because bigger and bigger companies are having much bigger influence at the moment. The reality, of course, is that this deal is going to open the door to both companies, Kering and Mayhoola, in a way that they can play a much bigger role in the future of luxury in the coming years. And I think for Mayhoola and for Valentino, we have achieved a significant growth through the last 10 years, but this is hopefully will continue for the next 10 years also in a different way, and we will be more and more a player in the luxury market. Yeah.
Well, Mayhoola, as you said, wants to have this kind of long-term presence in the luxury market. Do you then foresee some sort of investment going into Kering, going into Balmain, which you are the chairman of as well? Where is their next target, in your opinion?
Well, I think it is very clear that initially we wanted to have an IPO with Valentino because the intention of the IPO was to achieve a number of positive points. One is really to have more institutional arrangement in the company, attract even better talents, but at the same time it was really an ability to grow and become a much bigger group. With the arrangement that we have at the moment through the deal that we have with Kering, that could happen by joining hands with Kering. And there is definitely an agreement that Mayhoola could and will become a shareholder in Kering in the long term. Of course, you know, Kering is very much a success story in development of the luxury in the last 2 decades. Yeah. They have done a fantastic job. They have amazing brands. They have a fantastic vision. They have a very, very strong leadership and a group. And I think Mayhoola will be very proud to join hands with them. Yeah.
So let's talk about this from the perspective of Kering here.
Yes.
Do you see them taking on an even bigger stake in Valentino? They, of course, have the option to do that until 2028.
Yes. Well, that's the intention. And in the meantime, we are going to have the time to discuss and to explore and to negotiate together even further investment between the two groups here. So the intention really is to get more integrated together, but at the same time to expand the horizon of the luxury investment. Yeah.
So when you say the idea is to create this partnership and to expand to it, are we ultimately talking about a full takeover of Valentino down the line?
Well, it's possible because at the end of the day, it's a situation that is mutual because we also have the possibility of acquiring more shares in Kering, which is something that we put it very clearly in the agreement that we had between the two groups here.
Talk to us a little bit about who else they might partner with, for example. There's some speculation that perhaps Kering should partner with Richemont, of course, the parent company of Cartier as well. Do you see that happening?
Well, I know that Kering is a very, as I said, they have a vision, they have an intention to expand. I think the wish of Kering to join hands with Mayhoola into Valentino was a very clear indication of where they want to go, because Valentino is today one of the most influential and the most prestigious brands existing to be able to grow in the future. What we have done with the brand in the last 10 years is amazing. I mean, we acquired the brands in 2012. It was almost less than 300 million. Today is 1.4 billion. It's really represent, you know, the ultimate luxury of what haute couture and Italy can present.
Yeah.
This is attractive for Kering, and this is the kind really of expansion that they want to build for the future. When it comes to bigger acquisitions as the one that you have mentioned, I mean, this is really something up to Kering what they want to decide. But I think a lot is happening in the luxury market because we have seen, as you said, growth over the 20 years, which have made this market one of the most attractive in the world. Yeah.
But you're being humble. Look, you're an expert in this stuff. You are an expert in the luxury business. We, of course, know it's Kering's decision. In your view, does it make strategic sense to have a partnership between a behemoth like Kering and Richemont?
Well, I think, you know, this kind of mergers of any big identities, you can not only take, you know, the numbers and the brands and look at it. I think there is another element in the equation, which is the culture. And I think this is really up to the management of both groups to decide if this is something that will fit or it will not be the right fit for them in the future, yeah.
So talk to us then about the Balmain piece of this equation.
Yes.
If you start to see ultimately a potential full takeover of Valentino from Kering, where does Balmain stand in that equation?
Well, Mayhoola has a number of investments. We have Valentino, we have Balmain, we have Palzeleri, we have Bayman in Turkey. These are 4 big assets, and they're all behaving in a very successful way and growing. And we will continue to grow, and we will continue to have a much deeper involvement in the luxury factor, luxury market. For that reason, I think Balmain will continue to grow. We acquired Balmain as a very, very special French brand, which is almost 75 years old, have a very, very distinctive DNA. It is a brand that is growing in many markets, especially in the United States and China at the moment. And we will continue to grow that brand to a much, much more influential place in fashion, yeah.
Lately, after its, I believe, debut in I want to say Milan, it dealt with a major robbery. What can you tell us about what was taken, where you expect those goods to go? Any insight you can give?
Well, this was in preparation for the fashion show that will be in Paris the day after tomorrow. And unfortunately, a robbery happened, moving, some of the pieces of the fashion presentation. But luckily, we have an amazing team of people who have been able to reproduce it. What it will happen with these pieces? Well, I don't know. I mean, some people might be very, very obsessed about having, Balmain pieces to the extent that they want to rob them. Yeah.
But what does, if you could put a number on the loss, what is that?
Well, it's probably 25% of the collection, yeah. But it have been reproduced, yeah.
A lot to digest, and you've hit it all. A pleasure to have you on the program. We thank you as always. Rashid Mohammed Rashid, the Al Sara Investment Group founder and chairman of both Valentino and Balmain, joining the program. Coming up, we take a look at LanzaTech Global, the carbon recycling tech firm. We'll discuss the challenges around capturing carbon emissions and more. Stick with us. This is Bloomberg.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. LanzaTech is a carbon recycling company transforming waste carbon into sustainable raw materials for everyday products. By partnering with companies across the global supply chain like Zara, H&M, and Coty, just to name a few, LanzaTech is trying to pave the way for a more circular carbon economy. But the company's share price has struggled against the economic headwinds this year, down around 40%. Joining me now is LanzaTech Global CEO, Dr. Jennifer Holmgren. A pleasure to have you on the show and meet you in person. Let's talk a little bit about the costs associated with something like this. Look, it's a noble cause. Everyone wants to recycle on a scale that you were talking about. But in terms of growth for your company, how much is this going to cost?
Fundamentally, what we do is we capture carbon and make products, which means that the people that have a burden and a cost to reducing their carbon emissions actually can have a profit center. So the costs might be high now, but they're coming down quickly. And like I said, it becomes a profit center rather than a loss leader.
Talk to us a little bit then about plans for scaling up.
Mm-hmm. So our technology is already commercial. By the end of this year, we will have 6 commercially operating plants in China, India, and in Europe. And we just need to get ourselves to the exponential growth, kind of like solar, right?
Yeah.
Everybody's always wondering, when is it going to emerge? We're at that exponential growth stage. So I do expect to go faster, and 6 of our plants are going to prevent 500,000 tons of CO2 from being emitted. So that's a pretty big deal already.
Well, let's use the example of solar that you so beautifully laid out. I mean, one of the ramp-ups in solar, specifically in 2020 after COVID, everyone was saying, look, oil companies are dead, traditional energy is dead, we're going to go to renewable. And you did see the active investment in solar and wind, even in hydro. The problem with that is when people kind of hit scale and it became too much. If you have excess solar energy, what do you do with it? And that infrastructure at the time hadn't existed, and it created kind of an investor exodus that came just as quickly as the inflows did. Do you foresee that happening with your kind of technology?
Actually, no, because what we do is we're making everyday products, right? So we can make sustainable aviation fuel. The world uses 100 billion gallons a year, and we currently, globally, not us, global economy has 30 million gallons. So the gap is massive right now. The same thing with, we're converting our ethanol to things like polyester for clothing, you know, Zara, H&M Move. Craghoppers has a fleece out right now that uses our technology. I don't think we're going to run out of places to put it, to put our product, not at all.
Talk to us a little bit about just how global your market actually is. You mentioned H&M, Zara, Coty, et cetera. Where are you expanding?
Right now, one of the biggest places for us is India. There's a lot of interest in India. I think you know that Prime Minister Modi just announced at the G20 the Global Biofuels Alliance. And we think India is a great market for us, and we're making a lot of progress. Our partner, Indian Oil, just started up our plant that uses their refinery off-gases to make ethanol. So, yeah, that's going to be a great place for us.
How much fiscal support do you have from India, though? Because from my understanding, one of the hesitations to invest in India is just how much hesitance there is to bring foreign companies, specifically American companies, into India's kind of ecosystem. You've seen that with IKEA, not that that's an American company, but IKEA was a great example of that. How much support do you have from the government?
So we're a licensing company. So we license our technology to companies that have the balance sheet to build our plants, like Indian Oil. And they, of course, partner with their own governments. So we don't have to get in the middle of that. And there is a lot of government support with incentives and also infrastructure building.
Yeah.
But really our partners, who really are big gorillas, right? Indian Oil, you're not going to do better than Indian Oil in India, are really the key to helping us be successful.
Yeah, well, let's get some updates, if I can, really quickly on major projects coming from your company, specifically LanzaJet. And I believe there's a production facility, your first, in Georgia, I want to say. Talk to us a little bit about the timeline here. It's scheduled to come online. Are you on track for that? What does that look like?
Absolutely. So that's going to produce 10 million gallons of sustainable aviation fuel per year. it will be mechanically complete by the end of this year, and it is on track for that. And you know, that's a really nice opportunity, right? Soperton is a small county in Georgia.
Yeah.
And so by building this plant there, we're creating jobs in that rural economy. So yeah, it's going quite well.
And then an update as well on the status of Project Dragon, which I've got to say is a pretty cool name. So I'm very excited to see that on T-shirts and hats. That I believe is your first commercial scale facility in Wales.
That's right.
Talk to us about the update there.
Yeah, so actually we just did our permitting application, and we've done the comments for the permitting. So we've made quite a bit of progress on the engineering. That's receiving some funding actually from the UK's Department of Transport, and that's massively helpful in getting the project moved quickly. Yeah, that's also progressing. I expect there'll be another 2 years though till that is up and running.
Another 2 years from right now, so
Yeah.
2025, whereas I believe it was planned for 2027. So you're actually ahead of schedule, is that right?
The alcohol to jet plant, the sustainable aviation fuel, should be end of 2025.
Wow.
Yeah.
Okay, so ahead of schedule then. We appreciate your time as always. That's just a crucial conversation in the transition to green technologies. Dr. Jennifer Holmgren, LanzaTech's global CEO, joined me right here on set. Thank you as always. Coming up on the program, the EU warns China it will be more forceful in upholding fair competition and defending its interests. We're live in Brussels next with the details. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
A quick check on the markets here because you are seeing some movement. Suddenly, you are starting to see U.S. futures really get on the same page as what you saw in the rest of the world. Remember, we really started off with sour sentiment in Asia. A lot of those property concerns out of China coming into the European indexes as well. The Stoxx Europe 600 has only worsened when it comes to the sell-off, down about 0.8%. And now you're seeing the same thing feed into U.S. futures as well, down about 0.2%, which again is a recent development. A lot of that movement coming from that German IFO index as well. The strength that you are seeing, though, is from the Bloomberg dollar, higher by 0.2%, and even yields in the 10-year seeing a little bit of a sell-off in the bond market as well. So again, a defensive play, at least when it comes to the FX space, that seems to be the story there. So certainly something we're going to be keeping an eye on very, very closely. Now to one of the major stories here. The EU's chief trade negotiator warned China during his trip to the nation that the bloc would be more forceful in upholding fair competition and defending its interests. Joining me now is Bloomberg's Maria Tadeo. She is all over that story. Maria, we're talking about imbalances. What does the EU actually want from this trip?
Yes, Kriti, and we have Valdis Dombrovskis in China. He's on an official trip there. Remember, he's the head of the trade portfolio, as you say, for the European Union. This is a crucial portfolio for the EU when you look at just the size, but really the magnitude of the single market. And Dombrovskis is going there with a couple messages. In fact, one is obviously no decouple, but yes to de-risking. He also says the European Union does not want to cut off economic relations with China, but as you say, they have to be balanced out. To me, there's also a quote that's very striking. He says at this point, China and the European Union find each other at a crossroad, and it is up to China to figure out where this relationship goes, either balanced out or the two will have to move further away. Let's take a look.
We stand at a crossroads. We can choose a path towards mutually beneficial relations, one which is based on open, fair trade and investment, and working hand in hand on the great challenges of our time. Or we can choose a path that slowly moves us apart, where the shared benefits we enjoyed in recent decades weaken and fade, and as a result, where our people and economies face reduced benefits.
And that was Valdis Dombrovskis, trade boss for the European Union. And you heard it there, Kriti, really striking language, saying either we recalibrate or we will have to move further apart from each other. A lot of this obviously is underpinned by that massive trade deficit, 400 billion euros in favor of China.
Certainly something I know Maria will be all over tomorrow. We thank you as always for the update in the program. Up next on TV, Bloomberg Brief with Danny Berger in London and Manus Cranny in New York. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site, whereas this we can do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute. and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Fresh signs of concern in China. The property sector delivers a blow to risk this morning, and global risk appetite shifts. Wall Street's picking up the pieces as the higher for longer mantra sinks in and stocks flash a recession warning. Some signs of hope elsewhere. The U.S. Transportation Secretary says UAW and Big Three car makers can strike a win-win deal. Meanwhile, the end of the Hollywood strike, it could be near. A very good morning to you. We've just shifted gears quite dramatically in the past 30 minutes. What happened? The world began to look at China and $1/3 billion. That is $1/3 trillion, $327 billion worth of debt, which is mounting at Evergrande and a liquidation risk. You were told it was supposed to be contained in China. It's shifting out to a global week of risk off. S&Ps were down 3% last week, NASDAQ down 3.3%. And there's something else going on in the underbelly of the market. We have industrials flashing a recession. Yes, that word is back in the form of a market narrative. Industrials down 8% from the peak. Russell 2000 down 11% from their peak. And money is gushing out of stocks at a global level. $17 billion walked out the door of equity risk last week. The NASDAQ continues lower this morning. Higher for longer is the real sort of narrative here. And Europe is under pressure. The miners are at the bottom of your screen. The reason why we have that, they're down 2.3%, is because of the Evergrande debt woes, Danny, and that's the bottom line. We're looking at one of the worst weeks for markets in equities since the SVB crisis. And this morning, yes, it may well be contained in China, but Evergrande risk is pervasive, it's live, and it's crossing borders.
Manus, that's why oil is so interesting this morning, because even though all the other commodities are getting trashed this morning on the fears of the property crisis in China, oil is still marching higher. Brent crude trading at just under $94 a barrel, up 0.6%. Perhaps it is the U.S. stockpiles that have collapsed. We've also heard warnings from J.P. Morgan saying an oil super cycle is on its way, saying we're heading to $100 a barrel. Or it could also be those hedge funds turning sentiment, boosting their bullish WTI positions by the most since February of 2022. Either way, no cracks there despite the China narrative. Now, the euro, a lot of cracks here. 10 weeks in a row. 10 weeks in a row, the euro has weakened versus the dollar. That is the worst run since the common currency was created about 20 years ago. So we are looking at also hedge funds at the same time. They're also getting more bearish on the currency. They've boosted their bearish positions to the most extreme level in about a year's time. Meanwhile, the 10-year yield, that is also climbing higher, 5 basis points. It's duration that has been under pressure. We had a little bit of buying last week, but the curve steepening is still in. Manus, that trade is very apparent. And it's coming at a time that, sure, the economy seems like it's been able to handle those higher rates, but we're about to have a quadruple whammy of potential shocks that are fully out of the Fed's control, be it oil, be it loans, be it strikes, be it at the same time China and a shutdown. Okay, that's 5, a little bit more there, Manus. But there's a lot here to contend with at the same time, you're seeing some corners of this equity market whispering about a recession.
And it is whispering, or it's beginning to howl a little bit louder. I like the way you frame those risks. They're not exogenous risks, they're known knowns rather than unknown knowns, to channel the ever-famous Rumsfeld. But looking at your yields, Danny, the question is this. You've got Bank of America saying yields can march higher to 4.75%. Ben Amons makes the point that once you're at 15-year highs, you're still 75 basis points away from the maxed out levels of 2006 and 2007. And that yields, in his view, Ben Amons at Medley Global Advisors, yields are too low for the extra duration risk. So again, Danny, we've got the recession on one side, which could take these yields lower, with that other concern about duration risk. Good morning from New York.
Good morning from London, Manus. I mean, hopefully it will be a good morning, but as you pointed out, we had everything turn, stocks turn pretty quickly. Now, there are those fresh signs of debt woes coming from the Chinese property developers. Let's get into a little bit more, because China Evergrande Group certainly running out of time to get back on track with its restructuring plan. We have concerns mounting. The latest setbacks included a last-minute cancellation of credit meetings and detention of money management unit staff. Raises the risk, all of that, of liquidation. The developer's restructuring plan would be one of China's biggest ever. Now, this is happening as stocks in that sector fell more than 6%, marking its worst session in 9 months. Now, joining us on this risk is Klaus Bader, Global Chief Economist at Societe Generale. Klaus, always such a pleasure to see you. Thank you for coming in. Look, at what point do you look at this housing crisis and say, despite the stimulus China has injected, this will overshadow it all?
Well, I think that's already happening, but you know, I think what really the key risk is there going to be an implosion, i.e., a financial implosion? You know, what people, okay, I was at Lehman for 10 years, a Lehman moment, and I don't think that that's going to happen, because you must not forget that basically the entire financial sector in China is government-owned. But the fact is that the Chinese government has been, you know, it's been, I think I saw in your service, there was a very good headline, which was no bazooka, but lots of pistols.
Yes.
And that's exactly what the Chinese government has done. It's kind of a piecemeal attempt at stabilizing the economy and stabilizing the housing sector. I think the housing sector, you know, can be stabilized. What I'm much more concerned about is, will you be able in China to rebuild confidence in the private sector? And that, I think, is the much bigger challenge.
Klaus, good morning. You stole my line, no bazooka, but many pistols. And of course, we've seen incremental moves from the triple Rs, a couple of triple Rs. Another one will come live now, or has just gone live, I should say. So you feel confident that this risk is contained, the Chinese can handle it, so there's absolutely no global reverberation? Or where does the shoe fall on the reverberation as a result of the implosion in the housing market?
Well, you know, I certainly wouldn't agree with that there are absolutely no reverberations. You know, the Chinese economy is going to grow a lot less quickly than it has in, you know, the last years. In particular pre-COVID. And I don't think that that's going to change. And that, of course, affects not only direct sales of companies to China, but also, you know, indirectly, i.e., you know, suppliers to companies in Germany, to Japan, for whom China is a very important market. You know, those are all affected. So I wouldn't say that there's absolutely no risk. You know, the great Chinese growth story is over, and I think that it has several elements. One, of course, is the demographics, and the other one is also that I fear that the Chinese growth model has been broken, and so far no one has come up with a new model. But the Chinese economy has been, you know, driven very substantially by the housing sector, and that's unlikely to come back.
Will a new model arrive, especially when you have, you know, Xi Jinping really talk about not wanting the excess of Western stimulus?
Well, that's right. And of course, he's very critical about welfare, what he calls welfareism, because unusually for socialist leader, he fears that it's going to breed lazy people. So I'm not sure that there is a new model. You know, Xi Jinping, clearly his line is, the party controls everything. And the party is present in all companies. And I think that's problematic because, you know, no growth model lasts forever. That's obvious. I mean, in the 50s and 60s, the CIA was regularly predicting when the Soviet economy was going to be bigger than the US economy. And of course, people have been speculating, when is the Chinese economy going to be bigger than the US economy? And I don't think it's going to happen. Because the model of, you know, industrialization and housing driven, you can't do that forever, particularly not when your population is shrinking.
But Klaus, you reflect and you say it is about patching up the housing market, delivering some kind of confidence again to the consumer. My question to you is, these, no bazookas, but pistols, will they deliver the confidence that you need in the consumer versus perhaps the helicopter money and the consequences of that in the G10 nations? How do they deliver consumer confidence? What is the policy function that will deliver that to steady this situation?
Well, I think the stabilization of the housing market, you know, housing, of course, is a huge part of Chinese households' wealth. And Chinese households save a lot because they have to save a lot, because the whole social system, the healthcare system is, you know, very poor. And housing, Chinese households have a limited ability to invest abroad because they're capital controls. And so housing has really been the go-to asset. Now, I think how you put it, I think, is a little bit dramatic. I just read this morning about the absolutely meteoric growth in travel that's going to happen over the next couple of weeks, when the Chinese Mid-Autumn Festival coincides with National Day. So there's a lot of travel. So it's not as if, you know, Chinese consumers are absolutely, you know, buckled up. And our view is that the worst in terms of economic growth for China is behind us, but it's going to be a very moderate growth path and incomparable to what it was.
Klaus, Manus and I are never dramatic. Never. We're always very sensible.
I'm just trying to get you to rise to the occasion, Klaus.
He does that. He does that. He pushes you, you know? He's not an easy one. All right, Klaus, stay with us. Okay. Much more to cover. SocGen's Klaus Botter there. All right, coming up, U.S. Transportation Secretary, Pete Buttigieg, is standing up for American auto workers as the UAE strikes drag on. We're going to have more on that. And we're going to bring you our exclusive interview with UBS CEO Sergio Armati later this hour. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
He is proud of being the most pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. You're not going to find somebody who has more consistently stood with unions. Now, having said that, it's also the case that these auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
That was the U.S. Transportation Secretary Pete Buttigieg speaking on CNN's State of the Union. That was Sunday. President Biden says today he will travel to Michigan to support the striking United Auto Workers Union. Tomorrow, excuse me. Joining us now is Oliver Crook. So this is a huge, well, actually, you put it in context. You're American, I'm Irish. I don't really have an opinion. Is it a huge political gamble for Biden to go and join the picket lines?
Well, it's an interesting situation, and it's a situation that doesn't have a huge amount of precedent in U.S. history, with the president going and saying he's going to join the picket line, right? This is something that we don't tend to see, and as you know, the election is next year, and in U.S. political time, that is basically no time at all. But it comes also with another unprecedented act, which is on Wednesday, Trump is skipping the Republican debate to give his own speech in Detroit, both of which are really trying to woo the workers here. But just to get the latest on the strike, we had talks through the weekend going, and really no concrete progress in terms of the headline, in terms of the number on the raises. What's interesting is that Ford was spared the expansion of the strike. Why was Ford spared? The reason is they say they've made progress on a couple of things. One, reinstating the cost of living adjustment, the increases that were scrapped in 2009 when they restructured the auto industry. This is inflation protection for the paycheck, but also the right to strike and also the enhanced profit sharing. So this is where they're rewarding Ford for having made progress in these talks, but there's still a huge amount to go, and there's a lot of dry powder. Sean Fain has only 12% of the union striking right now. They have not hit the pickup truck assembly plants, which is really where, if they want to make it hurt, they'll start to focus next.
Oliver, thank you so much. That's Bloomberg's Oliver Crook. Now, in other strike news over in Hollywood, screenwriters have reached a tentative deal with studios that include Disney and Netflix. And in a strange twist of fate, The American is now going to ask a Brit about this. Joining us now is Bloomberg's Alex Webb. But we all watch Hollywood, so we all feel the significance about this. Is this success? Is this strikes over yet?
Well, it certainly looks as though we're getting very close to it. The members of the union will still have to vote on whether they agree with the terms that have been put forward. The assumption is that they probably will. We don't yet, however, fully know the details. The union have said that they think they've made good progress and they're happy with the deal. So when we have the details of it in a few days' time, then we'll be better able to gauge the temperature of the writers themselves.
Okay, well, they've certainly been on strike for, more than 140 days now. Alex, thank you very much. Alex Webb with the very latest on the Hollywood strikes. Meanwhile, you've got Congress heading into a make-or-break week for avoiding the government shutdown. Leaders of the Republican-controlled House, they're hoping that they can persuade the GOP holdouts to get on board with 4 full-year bills and a short-term funding patch. Shutdown is set for October the 1st unless Congress acts. And if no deal is reached, hundreds of thousands of federal workers are set to be furloughed. Klaus Bader is the global chief economist at Societe Generale, our guest this morning, setting the tone. Danny talked about a number of risks. None of them are exogenous. But on a scale of tail risk, a government shutdown, how do we need to look at it if it happens, if it's short, fast and furious, or if it's dragged out? What is my risk with the government shutdown, Klaus?
Well, that it is a reflection of the political process in the U.S. Being stuck and being rather dysfunctional. I mean, in the past, shutdowns have not tended to have an enormous impact on the economy. People are just furloughed. They eventually get their money, but with a delay. So I don't think it's a huge risk. There is, of course, a way out. Even if the holdouts in the GOP refuse to play ball, there's always the chance of a bipartisan deal, although that might very well mean that the Speaker of the House gets thrown out by his own party. It's just all part of this dysfunctionality of Congress and in particular of the GOP.
You previously have said that you're concerned about a U.S. default. when we had the debt ceiling problem last time. How acute is that concern for you now? Is it still simmering in the background?
Absolutely, it's simmering in the background. And my concern with the inability to getting these funding bills through is only raised. And my concerns are only raised by this imminent risk that the Speaker of the House is under constant threat to be fired by his own party. So I think that risk is very much there. And what we're finding is that the resistance and the intransigence of a few people who can really hold up the whole process is becoming greater, rather than that there's an increasing degree of willingness to make compromises. So I am still concerned about that, now, not in the immediate future because it's not on the agenda in the immediate future, but I think it's a risk that doesn't go away. And as I've said before, I think the debt ceiling makes absolutely no sense. Congress agrees to spending bills, and they should finance it and not have a separate vote on whether there's a debt limit or not. I think that's it's an institutional flaw that shouldn't be there.
Well, it's a long old haul in politics, isn't it, Klaus? One thing is well, nothing's for sure, but we should get the PCE deflator on Friday, and we're expecting that to dip below 4% for the first time in 2 years. How close are you, as a global economist, to saying, look, we are at or near mission accomplished? Or what would it take for the Fed to go for the extra hike? What data do you want to see to confirm no hike for the rest of 2023?
Well, I think it's first and foremost about inflation. But as I've said before, it's the low-hanging fruit has been picked as far as the fight of inflation is concerned. Now, the Fed looks more at core inflation. We'll see how that develops. The U.S. is actually, compared to a lot of other economies, in a slightly better situation, because in the most recent past, labor productivity in the U.S. has suddenly accelerated, and therefore unit labor cost has slowed a lot. And it doesn't look anymore for the U.S. as if reaching the 2% inflation target is completely out of reach, which was still the case a few months ago. In most other economies, except Japan, that's simply not the case. So I think that the fight against inflation has definitely not yet been won. And, what we talked about earlier, about the wage pressures in the U.S. auto sector, that's the kind of cycle that makes inflation last, is that you get high inflation, workers lose purchasing power, they demand higher wages, and companies raise prices. That's the age-old wage price spiral, which should really be called a price-wage spiral, because usually prices move first.
Fair enough. All right, Klaus, thank you so much for doing. Unfortunately, we're out of time. Always a pleasure to have you. That's Klaus Spotter of Societe Generale. Now, coming up, how much would you pay for a chance to get matched on an exclusive dating platform? Tinder figures it is $500 a month. That's its subscription for its most active users. More on that next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1, so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York with Danny Berger in London. Now, a story that caught my eye over the weekend. The dating app Tinder has rolled out a premium subscription service. Tinder Select, at its most active users, will pay $500 a month. The service is offered to less than 1% of its users, according to the company, with the access to features such as exclusive search and matching. Now, Danny, you can roll with this any way you want. This is the cost of love. You've got to be a power user. Question is this, right? I think I'm more the $24.99 subscription. $500 a month to find the perfect match. What do you reckon?
It makes me want to be single. That's what I reckon. What is this? Is this like love inflation? I don't understand. This is crazy to me. Although I have to say, I don't think people are on Tinder paying $500 a month to find love necessarily. I won't go much further than that. But this seems crazy to me, Manus. Absolutely crazy.
Well, you know what? $25 a month is enough to swipe. Go find me. The other thing is, of course, the owner of Tinder is Match. And in 2022, they bought the league. Now, get this. This is an invite-only dating app. I don't know whether I constitute this. Tell me whether I do. Ambitious, career-orientated singles. Do you think I hit those 3 benchmarks? Apparently, it's a VIP plan for $1,000 a week.
Manus, if you're not that, I don't know what is. If you're not that, then something is broken. I'll be honest, I
think we might be stretching it at the young.
Before.
I think we might be stretching it at the. It doesn't say young.
Yeah, it's any age, Manus. Love will cost you $500. Doesn't matter how old you are.
No, it doesn't. We're going to talk FX next. From love to FX. Which currency is the choice for Esther Reichelt? She joins you shortly, strategist from Commerzbank, right here on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Welcome back to Bloomberg Brief. I'm Menace Granny in New York.
And I'm Danny Berger in London. Here's what you need to know. Fresh signs of concern in China's property sector deliver a Monday morning blow to global risk appetite. Wall Street's picking up the pieces as a higher for longer mantra sinks in and stocks flash a recessionary warning. And signs of hope elsewhere. U.S. Transportation Secretary says UAW and the big three car makers can still strike a win-win deal. Meanwhile, the end of the Hollywood strikes may be near. Now, let's take a look on your markets, because Manus is going to get into some of the doom and gloom on this equity market. A lot of it is emanating from China. Concerns about Evergrande. We're just hearing from Klaus Spotter. Yes, there are some concerns that it could come over to other parts of the world, but big-scale contagion, maybe we're not there yet. Even so, oil still climbing higher, up 0.5%, just below $94 a barrel. JP Morgan says we're going for an oil super cycle. Euro, that's also seeing its 10th straight week of declines. That is its most on record. Hedge funds there adjusting their bearish bet to the most in just about a year. Meanwhile, it's duration that has been under pressure. Manus, 30-year yield, that is off about 5 basis points. Same with the 10-year yield. We're looking at some curve steepening going on. It's everything from the higher for longer, Manus, to also the concerns of Treasury supply, shutdown, strikes. All those things are simmering in the background right now.
Yeah, and Bank of America make the point that you're probably going to see higher yields, 4.75%, Danny, in the near term, because it's the longer end of the curve where you're going to see the workout rather than the short end of the curve. You're right. When it comes to cross-asset risk, that is driving are being driven, I should say, really by what's happening on the equity side. We're going into the fourth week of a dip in these equities. We've had a downside shift in equities for 3 weeks in a row. S&Ps were down by nearly 3% last week. The Nasdaq was down 3.3%. So we've got this risk-off sentiment from Evergrande in China. It's a name that you know well. Yes, SocGen say it's contained within China, but you're looking at $1/3 trillion worth of debt on liquidation risk. And that will impact the consumer in China, perhaps not seeping globally across borders. But what you've got is the biggest outflow of this year from global stocks. $17 billion walked out the door. There is an underbelly of concern that word "or" is back in our lexicon again. Recession risk. Industrials are down 8% from their peak in August. The Russell 2000 down 11% since the peak earlier in the summer. European stocks down. That's where the real pressure is, and it's the miners at the bottom of your screen which are down by 2%. That is the real source of angst. As iron ore comes lower, commodities under pressure. We're trying to understand the parameters of the impact of a liquidation of Evergrande. How pervasive would that be? How much contagion would that deliver? And whether that's going to cause the PBOC to come out with something much more substantial in terms of stimulus. Right now, stocks are on the back foot as we kick in at 5:32 New York time. But Danny, the debate really is about what we get on inflation data this week. We've got shutdown risk, we've got strikers, but we have the PCE deflator, and that, to a certain extent, will imbue the argument about whether you get another hike in the back quarter of this year.
Yeah, there's a lot of hope. We'll get a figure that comes under 4%. We'll get European data. There's hope there that it will start to come down. But Manus, I mean, you mentioned it. There's a lot beyond that. There's a lot that could upset things here into a week after the worst week for risk since March. We're starting on the back foot yet again.
Okay, well then that brings you to what is your hedge? Where do you want to be? How do you want to be positioned? Let's kick off the conversation with our next guest from Commerzbank. This is what she had to say. Anyone betting on a continued dollar strength or even appreciation should realize that this is a bet on the performance of the U.S. economy, which results in increased susceptibility of the dollar against weaker economic data. Esther Reichelt is the lady who wrote the quote. She's from Commerzbank FX. Esther, I was looking at the chart. I was looking at the quote. The dollar's rallied by 5%, give or take an eighth, since the middle of the summer. That rally is either going to be driven higher. We're in this risk-off mode, but you're concerned about growth. And with that in mind, that is what caps the dollar rally. Should we start there?
Yeah, clearly, I think this is the big risk, but because there is simply a lot of US optimism priced into the US dollar. This was supported, of course, by the Fed's view, which basically said that even if we are seeing a cooling of the economic dynamics, this will not sip through to the labor market. We'll only see a very slight increase in the unemployment rate. So if this does not play out as the Fed has painted at its last meeting last week, I think there is still the potential for a rather sharp correction of the recent dollar strength.
What could possibly rally against it, Esther? What would be the currency du jour in that scenario? Because I'm guessing if the U.S. economy is turning, surely euro is not where you want to be.
Well, yeah, clearly, because, I mean, of course, we are seeing clear signs for the recession risks in the Eurozone deepening. However, this is already priced in. So, in my opinion, the risks with respect to the economic risks, the risks to euro dollar are rather asymmetric. You know, like we would need to see a very serious surprise for the Eurozone, but only a very slight surprise with respect to lower growth, to a lower growth outlook for the US to justify higher euro dollar levels.
We're at 106 on euro dollar. The calls for parity, Esther, have been picking up. We've seen it recently from Capital Economics. What do you think? Parity? We're going to see it sometime soon this year?
I'm rather doubtful. As I said, I'm still thinking that right now the upside is more attractive because in the end, you should not you should keep inside the huge inflation risks. You know, we've heard it before in your show. The fight against inflation is not yet won, and this is, you know, like inflation is showing very much a global pattern. You know, like so either inflation goes down everywhere or inflation might stay up everywhere. I don't think that we are seeing a very significant divergence in dynamics, inflation dynamics in the Eurozone and the United States. So I doubt that such a significant move in euro dollar would be justified.
One of the big debates, Esther, is whether you see a vicious second round pump higher like you saw in the 1970s. I do read the research. I went back and had a look. You talked about 1976. You talked about 1979. And you talk about the re-emergence of a second round pump in inflation. I look at oil. I've got a number of houses telling me there's a super cycle coming, a renewed super cycle in the oil market. What is it that you see that could deliver that second round, really a second round pump higher in inflation globally?
Well, I think it's largely really the underlying risks stemming from the labor market, because to be honest, we simply are not we don't know very much about what is driving recent inflation dynamics. I mean, like central banks were surprised by the pickup in inflation in 2021. They were surprised on how robust inflation developed in 2022 and even in 2023. So what is giving us the confidence that everything will decline in exactly the way the central banks are expecting in 2024? I'm just thinking that the market is a little bit too optimistic with respect to these risks.
What does that do especially to my EM trades, the EM disinflation trade, expensive oil, Esther? Does that completely throw it out the window?
Yeah, exactly. I mean, in particular, if you look, for example, at Latin American central banks, they were very sensitive to inflation risks. I mean, yes, they have now started their rate cutting cycle. However, they clearly still show that this is just, you know, adjusting to these extraordinary real interest rates levels they have by now reached. So I think as soon as we are seeing any signs of this inflation supercycle, of inflation levels picking up again and the risk, I think this is emerging market central banks might actually be the one who would be the first to react, in particular as the chances for a soft landing in these countries is quite promising. So I think this might actually where we have to look for, where we have to look at for also to determine the risks for the G10 central banks.
Well, maybe that's the bigger divergence play. We're trying to understand China risk this morning. We're looking at it through the prism of the equity market, of miners, and to what extent it's going to impact the world. We've had SocGen say it's fairly contained. The Chinese have the power to contain the angst within the property market. But through the FX prism, the yuan has been literally, unleashed. It's gone lower and lower and lower. From a broader FX, Asia FX perspective, the weakness in the yuan, is it done, or what are the reverberations of this weakening yuan and a China in stress?
Well, the debt risk or the debt problem might be contained to China, but it's clearly showing us that China will not become, like a supporter of global growth anytime soon, because the problem will dampen the growth outlook for China for quite some time to come. And this also implies that the yuan will remain under depreciation pressure for quite some time to come. We have seen the PBOC stepping up their verbal intervention if dollar yuan moves too much higher. We have seen that they take several measures to dampen the up move in dollar renminbi. However, this will only, dampen the up move. The pressure is clearly to the upside, and we think it will remain there. So we would need to see, a substantial reduction or a substantial pickup in Chinese economic dynamics for this, for the pressure in dollar renminbi to turn around.
And then what does that feed into Japan, into the yen, Esther? Because you have a Bank of Japan governor who has continually reinforced that they are not there yet with a 2% inflation. If China continues to be a problem child, does he seem more and more right with every single day that passes?
Well, it seems like it, in particular, as long as global inflation levels move lower, there is a high chance that inflation rates will, continue to move longer. As I said, either it will work out for the whole world or it won't work out for the whole world. And for the Bank of Japan, the risks are clearly the highest, So if they wait for inflation to turn lower, as they expect, they might be confirmed with their still ultra-expansionary monetary policy stance. Of course, downside risks to the Chinese economy might help there actually, because it also dampens the outlook for the Japanese economy. But still, it's not the only thing they can bet on, of course.
So every day, Danny dreams of a more expensive lunch at the Ivy, the original one. She sends me messages with the menu, and she says, now you're in the big dollar league.
It's true.
You can afford this sterling lunch. Look, the ghost of Liz Truss hangs hard. It's a year ago we had the crash. Trussonomics trashed the pound, but the market is rebuilding its short positions. You say it was a tight decision, 5-4 in terms of the pause. When you look at the landscape of the UK, would you be loading up? I mean, the hedgies are loading up to short the pound. Is there renewed pressure to come? Are you a seller of the pound at these levels? We have Nomura talking a really bearish trade on that. Cable this morning, 122.20. So we're near the short point for Nomura. Is it getting tight for you in the pound?
Actually, not. I still think that the pound still looks attractive. It still looks attractive to sell the pound. I think the recent Bank of England's decision has clearly confirmed our view that the Bank of England is very reluctant to do what's necessary to fight inflation. Inflation risks in the UK still look quite high, in particular because they have a strong or quite a high wage inflation compared, for example, to the Eurozone. And even compared to the ECB, the BOE seems more reluctant, as they have shown with the recent rate pause. So we have been skeptic for the pound for quite some time now. It was too strong in our opinion. So we are seeing the correction we have expected, but we still think the correction to go on further.
All right, good news for Manus, who still owes me lunch at the Ivy. Esther, thank you so much for joining us. Esther Reichelt there of Commerce Bank. Now, coming up, we're going to bring you our exclusive interview with UBS CEO Sergio Armati. That's next. This is Bloomberg.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
It's Bloomberg Brief, Monday morning with Manus Cranny in New York and Danny Berger in London. UBS CEO Sergio Armati says it's making good progress on the Credit Suisse integration. He sat down with John Liu, Bloomberg's managing editor for Greater China, for a wide-ranging interview in his first trip to Beijing since taking over the helm again at UBS.
Things are progressing very well. We made shift very swift progress in integrating Credit Suisse. We closed the transaction in record times, also thanks to the big cooperation of regulators across the globe. And that's one of the reasons why I'm also here today in Beijing, because this is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China, while also updating them on the integration.
In your second quarter results, it mentioned specifically that client confidence, sentiment, and activity here in Asia was muted. Are you still finding that's the case into the third quarter?
Well, I think that we saw in general a little pickup in across the globe, also in Asia, in terms of client activity. So the most important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue. But also in general, it's fair to say that investors are more constructive than they have been recently.
So on the momentum you talked about in Q3, there was a net new money inflow of about 16 billion US dollars in 2Q. You said at the time you expected that to continue. What is it looking like in 3Q? What does good momentum mean?
Well, I mean, we are pursuing similar patterns, so we are not going to be specific on numbers. The quarter is still ongoing, but the most important issue is that we see substantially our forecast being confirmed, and we are getting to the close of the quarter. So I think that's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations.
It's taken your headcount, your staffing, to about 120,000 globally. And you've talked about, pretty forthcoming about the need to reduce that number. How much of a reduction do you think is needed at the end of the day?
I never really spoke about the need of reducing headcount because it's not our philosophy. What we need to do is to restructure the bank. Credit Suisse needed to be restructured, profoundly restructured, because out of this situation, and then we need to extract the synergies that are necessary to make both businesses viable and stronger. So we are taking actions as we speak to resize the business. We are also taking advantage of the fact that we had natural attrition that is helping across the globe. We have demographic trends helping in that sense. People exiting the bank through retirements or early retirements. We are working also in facilitating movements of people within the bank, also between the two banks as we speak. So I think that I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
UBS CEO Sergio Ermotti there, speaking exclusively to Bloomberg's John Liu in Beijing, warning about some of the fragility in China. Now, also in China, we have EU Trade Chief Valdis Dombrovskis. He'll be meeting with counterparts and business leaders. Let's bring in Bloomberg's European correspondent Maria Tadeo on this. Maria, what will the message from the trade chief to China be?
Look, it's going to be a striking message, and already we got a glimpse of it today in a speech that Dombrovskis made in China. As you say, he is on an official visit for 4 days. And again, a striking quote that really caught my eye, where he says, at this point, where you look at the relationship between China and the European Union, it is at a crossroad, and it is up to China to figure out whether they want to recalibrate and rebalance, so it is a win-win for both, or inevitably they will have to head in different ways. Let's take a look.
We stand at a crossroads. We can choose a path towards mutually beneficial relations, one which is based on open, fair trade and investment, and working hand in hand on the great challenges of our time. Or we can choose a path that slowly moves us apart, where the shared benefits we enjoyed in recent decades weaken and fade, and as a result, where our people and economies face reduced benefits.
So it's a win-win or lose investment. Those are the words of the trade boss for the European Union, Valdis Dombrovskis. And a lot of this, you can see the frustration is underpinned by that trade deficit, which keeps getting bigger. At this point, you're close now to 400 billion euros in a trade deficit that benefits China. The European European Union says they want to see that recalibration and make trade more balanced between the two countries, repeating no to decouple, yes to de-risking, and not an abuse of the single market. If China wants to enter this market, they have to open it up too for European competition.
Okay, Maria. Yeah, and there is pushback here from the States as well in regards to the reach of China into the Middle East and across Africa. Maria Tadeo in our headquarters in Brussels. Coming up on the show, we're going to take a look at some of the market-moving events for you throughout the week. We're going to set the agenda on Bloomberg Brief.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now let's get you set up for your week and what is ahead. Central bankers will be coming back on stage. We have Chair Powell speaking on Thursday. President Lagarde will be speaking on Friday. Will we get any adjustments from the message that they had last week? Now, we're also going to get a host of data on Thursday, CPI out of Germany and Spain, plus, of course, U.S. GDP, core PCE, and jobless claims. Will we get that under 4% print? And more data coming on Friday, the latest inflation out of the Eurozone, France, Italy, UK, and China PMI. Manus, for the time being, it is Europe under pressure from the China property woes.
It is indeed, and that is displaying itself perhaps most in the equity market, but the FX market will have a carry through. Danny, what you got here is, of course, dollar yuan, dollar up, yuan lower and lower to go, according to Esther Reichelt over at Commerzbank. Keep an eye as well on the Aussie dollar. Iron ore gets trashed, and as commodities come lower, high beta drops down 0.25%. Bloomberg surveillance is up next.
Middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
To digest higher rates for longer will take time.
I don't think rates need to go any further than where they are today.
It's not so much the level of the rates that's the problem, it's the adjustment.
What's going on in markets is quite different to what's going on in the real economy.
The economic soft landing narrative is definitely being challenged.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene back in New York. Well, some of us are back in New York. Farrow on assignment. Lisa Abramowitz and myself to bring you a most interesting Monday on radio, on television. And Lisa, we can just get to the national rate adjustment that's going on, a veritable soup of higher yields. I'm going to go moments ago, the U.S. 10-year real yield out to new levels. I have 2.11, rounded up 2.12%. That's a higher yield.
The highest real yield, inflation-adjusted yield, going back to 2009 at a time where it's something that has something else to do than just inflation. It has something to do other than growth. There is something else going on, and Deutsche Bank put out a note saying this is partly quantitative tightening and this is partly something else, not tied to traditional reasons for why yields are going high.
Can't emphasize enough how much I agree with that. Olivier Blanchard talks about other factors. We're going to go over the other factors here as we stagger into October. One of the other factors we have, and I didn't see this in London, I get back to New York where there are no for sale signs up, bank rate 30%, 30-year mortgage rather, bank rate 30, 7.75% 2 days ago. You wonder where that will print later this morning.
And we've been talking about who's paying it, right? I mean, that's the sort of question is this actually going into effect? Michael McDonough over in our Bloomberg Intelligence unit, our Bloomberg Economics, came out and said that basically the average monthly payment has gone to about $2,300 from less than $1,000 in March 2020. That there is this feeling of just things getting more expensive in the basic day-to-day necessities.
You know, there's a number of swirls going on this morning, folks, and one of them is China, a mystery of what China is going to do. One of them is a strike. One of them is a shutdown. Good news from Hollywood. I mean, at least we got, thank God there's something out there. There's a difference between the screenwriters and the actors. Right. They wait on tables in different parts of the restaurant.
Exactly. I think the screenwriters wait on the ones in the back and the actors are in front
because
they're usually the front-facing ones. Okay, there is that good news. But I will say, is there the word quadfecta? I was thinking about this because everyone talks about the trifecta, but there's kind of a quadfecta brewing behind the scenes. There's the auto strikes, the government shutdown, student loan repayments, and higher gas prices. You put those together, any one of those couldn't necessarily derail the U.S. economy. But increasingly, in a lot of the reports that I read overnight, there was a question around, if put together, this is a different kind of, if you will, toxic brew. The tension's
there.
This, to me, you know, each one of them, it doesn't matter. You put them together, suddenly something feels different.
We're in a new studio here. What do you think? It's like, you know, it brings back memory. I teared up, me and Scarlett Fu and Sarah Eisen. I got all emotional when I walked in the big room.
They're very nice.
They're going to put a brass plaque outside, the Alex Steele room. That's what they're going to
Well, I know. I think that John isn't going to come back until we resolve the government shutdown issue.
Yeah, well,
I think he's particularly frustrated by the issue.
Now, to say the least. We should say we are building a new edifice for your morning attention. They're working on it. And so for 4 or 5 weeks, we're going to be here as well. The data check's the same, whether we're here or in our new studio, which you'll see. The VIX 17.83 says it all. Futures are in. The Gloom Cruise picked up on a number of those things Lisa was talking about, including China real estate. We'll touch on that. But -3 on the SPX futures. I've got nothing else really working here. We'll talk about the drawdown later. We got to do Bitcoin because John's not here. 26,000. Greifeld's up early watching, so we have to do.
I'm glad you did that. Thank you very much.
Yields elevated, and this is the key point. We are 4.49%, almost a 4.5% on the 10-year yield. 2-10 spread gives us some disinversion. That's a really important philosophy. Jim Bianco land there. That real yield, 2.12%, is right where we are. That is an absolute key determinant. For me, I'd look at dollar strength. We haven't really broken out to new dollar strength, but yen rounded up 149. I wonder how they deal with it. What do you see in, Lisa, the data? Before you do the brief, what's in the data that gets your attention?
Crude. Going back up.
Thank you.
And I think that that's interesting, the fact that on WTI, you're above $90 once again, and that there was actually data over the weekend showing that hedge funds are now the most bearish, most bullish, most bullish on crude, on WTI in particular, going back to February of 2020.
We got to come back to this on short selling. Do the brief now, because young Kyle is going to hang up if we don't get to him.
All right. Well, you know how you don't like Fed speak? There are 7 Fed speaks this week. 7 Fed speakers this week. Just this week alone. No, Minneapolis Fed President Neil Kashkar at 6 p.m. Today. Tomorrow we have Fed Governor Michelle Bowman. Thursday, the big bonanza of Fed speak. Fed Chair Jay Powell, Fed Governor Lisa Cook, Chicago Fed President Austin Goolsbee, and Richmond Fed President Tom Barkin. And on Friday, the Fed's John Williams. Whether they really lean into this idea that they are done, because it seems like that right now in the literature, Ellen Zentner among them, saying they are done. Earnings, and this to me is really a big deal, especially off of Mike Wilson's comments over the weekend. Retail earnings in particular. Tuesday, Costco. This is fourth quarter. Wednesday, H&M and Micron. That is the whole semis kind of question. And Thursday is Nike. Curious to see whether these are bespoke stories or whether we get a theme that starts to come together. And on the economic data front, you talk about home prices and the mortgage rates. Well, we get home price data as well as new home sales, just how much this market is broken. We get that tomorrow. Jobless claims Thursday. And personal income, spending, and core PCE on Friday. That is key.
Brief.
The consumer, how much do they really continue to surprise to the upside the way a lot of the economic data has?
This really lays out the week ahead, folks. It's not a sleepy week into October. No. And for the first time, you can look at this, folks, on the Bloomberg Professional Service on the DES screen, the description screen, a plethora of data there. They have JP Morgan, October 13th.
Yes, I saw that.
October 13th. They've also got December 14th, which is when the Bruins pull ahead of the Toronto Maple Leafs. Joining us now, Luke Kawa, asset allocation strategist, UBS Asset Management. What'd you write about this weekend, Luke? What is the distinction you see in literally the cacophony of news we have?
Oh, this weekend it's a lot more reading than writing as per usual, but very interesting for us to watch as we go into year end. A couple of things that seem like pretty big highlights or things that markets will be resolving is one, a lot of the, as Lisa's noted, there's the, I'll call it the quintet, throw in higher rates in there too into the mix of things the U.S. economy will be dealing with. We're dealing with a bit of a turn in the second derivative of U.S. growth from Q3 into Q4. So the most consistent trend in markets since May, we would say, has been U.S. growth both accelerating and surprising to the upside. That's something that's going to change. On the other hand, two of the biggest drags for markets, arguably in the past couple months, have been that resilience of U.S. growth that's driven the part of the higher real yield story. Also, certainly elements of term premia and supply in there, but that possibly changing as a second derivative of U.S. growth changing and getting a little stability. So that relationship to us is really at the fore in terms of what we look at as driving markets for the coming 3 months.
Aquinas, be sure that Luke gets the memo that we don't do Newtonian calculus on Mondays. There's a great rule about that. Luke, you've got a really, really smart idea that earnings haven't deteriorated. And yet the zeitgeist this morning is, should I sell stocks? Dovetail a non-deterioration of earnings with the idea I really want to get out of equities.
Well, I guess we would take the other view to that. We're not necessarily adding risk, adding cyclicality into this pullback at this time. But our view is that real underlying story is what's going to win out at the end. That there is a limit to how much good news for the economy can be bad news for stocks in terms of the valuation pressure, that you really are going to have the real key driver of earnings growth. And, by the way, since S&P 500 peaked for this year, S&P 500 earnings estimates 12-month forward still up another 3%. We think that's ultimately the story that's really going to win out when it comes to the equity market. But we're very cognizant that some of the signs we've seen in markets recently, I would say credit spreads perking up a little bit, some of the outperformance of defensive equities. Those are just things that have us on alert, on watch, I would say.
So Luke, just if you could frame where you are, because you have been bullish for quite a bit, whether you're becoming less bullish now. Just because of the quintfecta, or whatever you want to call it, the 5 different areas coming together, I could see Tom looking at me like, what did you just make up? Yes, I'm trying to make up words on this Monday. But, at what point do you start to become less bullish and start to look for signs that maybe things are turning and the economic data is going to start surprising on the downside in a more substantial way?
Well, I think one thing that we do expect to see, or that we'll really be judging a lot in the coming quarter, is that that odd juxtaposition of the second derivative of turning in the U.S., but still expectations seem to us too low. Now, you can quibble whether the ECFC economic forecast for Q4 GDP in the U.S. of about 0.5% are really what the market is pricing in. Market's probably pricing in a bit of a better outcome than that. But it's that juxtaposition of us. Okay, these temporary factors are going to be slowing growth in the fourth quarter. But even so, we probably see growth coming in a bit ahead of that. How does the market deal with the issue of the turn versus continuing to be positive versus expectations? We're very aware. We're very cognizant of the idea that as you slow, as you turn, there are going to be points in this market where it's going to be tough to tell whether you're heading for a soft landing or whether that deceleration continues and you're heading into something a little more severe of an outcome. Our view so far is what's shaping up in the fourth quarter is not going to be that latter, more negative outcome, but something we're definitely going to continue to monitor in the weeks to come.
If yields stay where they are, can stocks keep doing well?
This is interesting because it's almost it's a mirror of the question that we asked when we started the year. Can the economy handle a 5% potentially federal funds rate for the entire year? The view then for us was yes. The view then for us with stocks is that stability is really what's needed, much more so than yields coming down a lot for stocks to work. It's just that the negative momentum in the bond market really does have to calm out. The positive momentum in oil prices really do have to cool a bit, and that cooling in the second derivative for rates and oil is going to be something that offsets that turn in the second derivative for U.S. growth and net out a little better for risk assets is our view.
Are you still bullish on China?
We've been neutral on China for a while now. Hopefully we discussed last time, but it's just in China, it's the continued dichotomy between the fact that valuations are very depressed.
Right.
It's not clear that there's a catalyst to see higher, faster growth in China. But when risk assets in China are at this depressed valuation, when they're this unloved by fund managers, that it's often a time where you get to see more meaningful moves to the upside. So a neutral view on China, but we're really counting on some of the piecemeal stimulus putting more of a floor under growth. Don't expect anything bigger from Chinese policymakers in the near term.
Look, your charm is a student of the street. What's the bet on the street right now? Is there a massive short bet out there?
I'd say the bet on the street is continuously, everybody knows what history says about buying the last Fed hike, et cetera, buying the end of cycle hike. I think the big bet is also right now the big worry. It's the idea that, Lisa talked about in the intro, just these other factors that we're seeming to be pushing up yields. That's making the term premium argument. The most difficult thing about the term premium is nobody really understands it. We're all going to have very, very different definitions of it. But usually some of the things that people associate with term premium, they're going to correlate with how growth and inflation are moving. What's different this time is that supply is moving much more much more pro-cyclically than it has in the past. So that's something where you have this element of term premia that we've typically come to have associated as being associated with growth, with inflation that might be moving in a bit different direction this time, and that's what I think causes a bit of a scare to relying on your kind of traditional models for how and when to be adding a lot of duration.
Lukawa, UBS, thank you so much for getting us started strong here on a Monday. Merriam-Webster, thanks so much for watching in Springfield, Massachusetts. Merriam-Webster emails in and says, what in God's name was that? Bramo's quinfecta, it's like a trifecta or a quadfecta, but I think it perfectly captures where we are. I think you nailed it, Lisa. The quinfecta that we're in here is all the reasons not to participate.
Well, I originally thought it was a quadfecta, but Luke Howe, I was grateful enough to him for making it a quinfecta. This is the issue, and we talk about toxic brew and we laugh.
Yeah.
But when you put certain things together, they take on a new meaning than if they were just taken in isolation. Right. And I think that's the reason why people are starting to feel like, maybe this time we're going to care a little bit more about a government shutdown in tandem with all the other factors.
Our focus after London and the greater picture is market dynamics. Luke Cowell with us with UBS. Coming up, Katie Kaminsky, Alpha Simplex Boston. She is absolutely brilliant on the trend, the new trend, or is it a range? Stay with us. Futures at -2. This is Bloomberg Surveillance.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I still believe if you shut down, you're in a weaker position. You need the time to fund the government while you pass all the appropriations.
So does that mean you're going to try to push forward with the Republican CR still?
I would like to. You need to.
He is the beleaguered Speaker of the House, a gentleman from California, Kevin McCarthy. Really interesting background from below the Imperial Valley, Bakersfield, California. Just a whole different story there of Republican politics. And I just really can't say the moment we have Lisa over the weekend. There are various sundry people in the Keene House. And, of course, we were in London. You know, Vet Bill, I got home, was mental. So Vet Bill demanded we have an Arnold weekend. So I had to watch like 5 Arnold Schwarzenegger movies. And I put on for various people in the family the Arnold Schwarzenegger speech at the 2004 Republican Convention. It might as well have been from Venus or Mars compared to what McCarthy's putting up with today.
Does Vet Bill drink martinis while he
requests
Arnold Schwarzenegger
he gets the olives, though, and there's no question about that. McCarthy is beleaguered as Schwarzenegger never was. We're going to do a market check, and we're going to get to this, and this is a shutdown in this week. Lisa knows when the shutdown occurs. I have no clue. Red and green on the screen here. A little churn of the tape within the Bramo quinfecta of tension. Yields say it all. Lisa, comment on a 4.49% 10-year yield. Wow.
Well, Luke picked up on this, right? This is being driven by something ambiguous. It's not that inflation expectations are going up. It's not that growth expectations are going up. Is this something else, whether it's people protesting the budget and all of that? Is it because of that? Or is it simply because the Federal Reserve is selling bonds. They are not the buyer of last resort in the same way. And it's the same with the ECB. And this is a game changer in a very unusual cycle. And that, I think, is something a lot of people are picking up on.
We're going to watch this very carefully as global Wall Street greets the week 2.12% in the 10-year real yield curve disinversion. We'll get to that with our economists here in a moment. We need to jump now to one of a set of series of interviews we're going to do to brief you on a shutdown of the federal government of the United States of America. It is different than many other processes: debt, deficit, budget shortfall, and all the other fancy words only Anne-Marie Horton understands. Briefing us on Washington's from Strategas, it's a Baird company, Jeanette Lowe, Director of Policy at Research. Jeanette, you got a 75% odds on shutdown. What will you listen for today or tomorrow to change your odds to calibrate a government shutdown?
Well, good morning. So we won't have Congress really start to work on any of the potential bills until tomorrow. So that is where we're going to start to see the process really develop. Our anticipation is that the Senate is going to move first. They are going to try to put forward a short-term continuing budget resolution, so that will keep the government funded for potentially a month, 2 months, up to 3 months into early December. And then they're going to send it over to the House. The House then has to decide, do they have the votes to potentially pass that CR, even if it's with changes? Or does McCarthy have to then move with the Democrats to try to pass this? Or does he allow the government to shut down? So we're going to be listening to the rhetoric that we hear within the House. You have heard a lot of Republicans over the past week been frustrated by the handful of conservatives who have blocked any movement. And so as that chorus might change, we may be able to see this potential change that we won't hit a government shutdown if they're willing to work with Democrats.
Asking for a friend, Bramah went into Morristown on the Gulf Stream. She took the Gulf Stream back from London. I had to go through EWR. If there's a shutdown, is the border check customs lines worse than they were when I came back 2 days ago?
So that is always the risk. And there's been already some thoughts about, you have to be careful that you might see more delays at the border and at the airports. They do have an essential component to a shutdown. So anything that is deemed essential should still be in operation. But as we've seen in shutdowns in the past, if you're showing up to work and you're not being given a paycheck, sometimes people don't actually show up. And so that's where we've seen some issues in the past with FAA and transportation screening and all the like.
This is a maddening issue, Jeanette. There are going to be 800,000 workers, including people who are military, people who are teachers, people, the rank and file, who do a lot of the work in the country, who are not going to be paid as there is this shutdown. And this comes at a time that's fragile, right? How much is this really going to end up being a political tit for tat, where Democrats count on Republicans as gaining sort of the brunt of the blame for this? And how much is this going to be something larger that leads to an economic slowdown that leaves both parties with egg on their face?
Yeah, so we've seen in the past, looking historically at the shutdowns that have occurred, and there's been quite a few over the past number of years, in general, they do not have a major economic impact. So you do have people who are furloughed, they are not receiving paychecks, but generally shutdowns last on average 8 days. The government reopens, that fill is then paid back. There's retro pay, and so everything kind of is filled in to some extent. So there hasn't really been a large economic impact. The last 6 shutdowns occurred in quarters with positive economic growth. The issue this time is that we're also now seeing, the auto strike that is occurring. We're seeing increasing pressures on consumers from student loan repayments, higher oil prices. You continue to have, the Fed has higher interest rates, and that is leading to higher debt issuance in the U.S. So these things are also putting a strain on the U.S. economy. And so the longer the shutdown lasts, that's where the issues really become into play. If we look back at the 2013 shutdown, that one lasted 16 days. So that was, 2 weeks is a long time, but it's not as long that it has as big of an impact as you might think. And so if we have something about the same time period, then that wouldn't be that egregious to the economy overall or to the stock market. But what we do have to think about is, how does the government reopen? And usually there is political pressure that starts to kick in that then forces the hand of policymakers to actually get back to this. This one actually could end up being shorter, or it could end up being longer. And the longer it lasts, I think the more risk there is to the economy, to the markets, And the other thing we're kind of watching out for is there something like Moody's could start to put the U.S. on credit watch if this lasts particularly long, because the credit agencies have been more focused on process rather than even the U.S. finances and those decisions.
Amid all of this, President Biden is heading to Detroit on Tuesday to join the picket line. It is the first time that a sitting president has joined strikers going back, I believe, more than 100 years. What is the significance that the focus is all going to be on Detroit rather than Washington, D.C. amid this shutdown?
Yeah, I mean, so one of the things that obviously for Biden too, this is, if there is a shutdown, there's obviously a political price to be paid, but Biden actually could have an opportunity here to improve his standing and actually show that he's trying to work to have the government reopen. But I think the fact that there is a lot of pressure on the auto workers is also trying to highlight, at least from Biden's perspective, a little bit about the impact that this could have on the election, on the economy. And so that's going to be really important ahead of these decisions, because unfortunately, we're probably not going to know whether or not we're going to shut down or not until about Friday or Saturday, right as the deadline hits.
Jeanette, help me here. And you know, I just listened to you very carefully on the path of a shutdown. If it's 8 or 9 days and everybody gets retro pay, etc., why are we doing this?
So this is usually about making a point. So if we look back at the 2013 shutdown, that was really a shutdown that occurred because the Republicans were looking to block funding for the Affordable Care Act that was going into implementation at that time. This is now an argument about saying we want lower spending and we want something done about what's happening at the southern border. And so usually the people in Congress feel that doing a shutdown will allow them to get their message across. It has not been particularly successful. They do not necessarily win concessions. And in fact, this time, if we look at what might ultimately happen, we can see where the bipartisanship is in Congress, that we're going to have a spending deal. It's going to be higher spending than the conservatives want, and they're the ones who are pushing for this shutdown. And they have to see whether or not they're going to have leverage to actually get something done on the border, which is ultimately what they want. So shutdowns have not been particularly useful political instruments. They do not get much of a point across. They kind of allow people to get their frustrations out, but then we have to go back to governing. Now that can be a positive outcome, that we've kind of fleshed out some of the frustrations within both members on both parties in Congress. But then you have to reopen the government and you have to start governing again. And that actually can be a positive outcome that comes out of this.
Jeanette Lowe, thank you so much. Greatly appreciate it. We're going to continue to monitor this. I need to tell you about balance of power, a very focused attention on what we see going on in Washington. Joe Matthew, Amory Horton, Kaylee Lyons helping out as well. Balance of power, look for that in the early evening, each and every day. Holger Schmieding, Berenberg, next.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
On a Monday on radio and television, thank you for joining us. Thrilled at the anecdotal evidence that was discerned in London about a global audience. We're thrilled you're with us around the world, and Awakening America is well. We do a data check here. Futures flat, I'm bored. No, I'm not. In the yield space, volumes are being spoken. 10-year real yield, a new level, 2.12%. What'd you say, back to 2009?
Yeah, March 2009. I just want to point out, okay, every Thursday at 4:30 p.m. Eastern, I am the person who looks at the Fed's balance sheet.
It's just...
And I've been watching it, and it's fascinating. It's down now to about $8 trillion. The peak was about $9 trillion.
So that means we're more restrictive.
$1 trillion of bonds that they have allowed roll off. How much is that the underestimated story behind the real yields continuing to climb when it is a global quantitative tightening?
It's an overlay, and I look at the Bloomberg Financial Conditions Index, 10 ratios. You don't have to memorize it. There's not going to be a quiz. It's become a little more restrictive in the last 3 or 4 days as well, 0.19%. Really not restrictive, but not the accommodation that was confounding Chairman Powell earlier. One other quote, as Lisa mentioned earlier, Brent crude rounded up $94 a barrel. We are over the Atlantic Ocean, flying in, doing circles over White River Junction, Vermont for an hour.
Not that
2
you're bitter.
hours. I was like, are they going to run out of gas? What are they going to run out of gas? I'm glad we're looking at Mount Katahdin under surveillance this morning. Lisa Bramlett.
Well, what we were talking about is sort of the Midlands, right, and what's going to happen there. This morning, we're watching President Biden, who's going to be joining the picket line in support of striking UAW workers this week. He will be speaking from Michigan on Tuesday. This comes ahead of Wednesday.
So on Wednesday, does he go to the board meeting of Ford?
Well, that's the question, right? The union is expanding its strike against automakers GM and Stellantis, not Ford. Senators, as the two sides continue to work on a new deal. I wonder how this is going to play. Is he picking sides at a time where auto manufacturers are getting subsidies from his policies with some of the electric vehicle makers? And then, oh yeah, by the way, former President Donald Trump is going to be there on Wednesday instead of going to the debate that's going to be happening.
To me, and John was very good about John. You remember John?
I do.
Farrow?
Yeah.
John was very good about this. He's on assignment in England, by the way, folks. Somebody said it was at Arsenal Tottenham, and I said, yeah, I think so.
He actually has a very cool project.
But
we'll talk
he's
about
got
that
a project going on post-Arsenal Tottenham, and his huge success with Daniel Levy, really making global newsways there. And Lisa, what was so cool there, to John's point, is any of this environmental stuff feasible? Is it economically feasible? And that's a whole side project into Q4.
Is it economically feasible on the time frame that they're talking about? And this is with the whole Rishi Sunak London kind of flavor where he's pushing back and actually delaying it. Yeah. The other thing that we're focusing on is, as you pointed out, this resolution baby, the Hollywood writers' strike. may be coming to an end. You could see the move in Disney and Netflix this morning. The WGA and major movie and television producers announced a tentative deal late Sunday night. The new agreement is expected to lift pay and create new rules around artificial intelligence. Meanwhile, the Screen Actors strike still ongoing.
Right.
This, to me, the changes in technology underpinning some of the angst fueling these strikes is something we cannot talk enough about, I think, Tom.
So if you go down to the University of Texas and get a graduate degree in screenwriting, it's lifetime employment. That's what this agreement's about, right?
Oh, I don't know the contours of the specific. She can read the details and then come on and we can interview her. But I am curious about that.
What else you got?
The EU's chief trade negotiator warning China that the bloc will ramp up pressure on fair trade. I find this fascinating. Valdis Dombrovskis, executive vice president for the European Trade Commission, made the comments. He's in China right now. He said the EU welcomes competition. It makes our companies stronger and more innovative. However, competition must be fair, and we will be more assertive in tackling unfairness. Early this month, of course, the EU did talk about some sort of new probe into Chinese subsidies for electric vehicles. But this trip in China by Valdis Dombrovskis, very interesting at a moment that is pivotal for European-China relationships.
In particular for Germany, it was interesting from London to see the distance between Berlin, Frankfurt, Bonn, and London as well. With a voice on this, picking up the debris of our London trip, is Holger Schmieding, his chief economist at Berenberg, and has been incredibly perceptive about this linkage of monetary and fiscal economics in Europe and China.
Which is really a key question at a moment of flux. And Holger Schmieding, I would love to get your opinion starting on what we were just talking about, which is this trip of Valdis Dombrovskis over in China. What is the likely outcome to some of the rhetoric that is increasingly hardline out of European leaders?
Well, the likely outcome is clear. Germany, the European Union, is reducing its dependence on China. De-risking is the word, not decoupling. But the message from Dombrovskis is clear. We are serious about this. And in a way, we are self-confident in Europe. Yes, we do have some economic problems, but China probably has economic problems that are worse. We are the bigger market than China. We, the European Union, don't have to just accept what China does with subsidies, with its distortions. We can push back.
Well, is there a sort of a tacit acceptance of slower growth or even recession during this transition process away from really depending on trade with China?
There is a tacit acceptance, yes, that of course the de-risking with China will mean some short-term losses. It also is an acceptance that, yes, if we want to be less dependent on China in the long run, an economy, China, that is actually struggling and will likely continue to struggle for quite a while, it means we get less boost out of foreign trade with China. But having said that, the lesson we've learned from Putin is clear. If you're too dependent on somebody whom you don't fully trust, you may eventually pay a heavy price for that. So it's probably worth de-risking now with modest near-term pain in order to secure a longer-term, fairer, more equal relationship with China.
One of the great criminal acts in New York City is the Oak Room at the Plaza Hotel has been shut for, I think, 20 years. Absolutely ridiculous, beautiful and historic room as well. Holger Schmieding, right now with dollar, day after day, up, 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 day after day, euro, down, 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 over 9-10 weeks, whatever it is. Are we getting a distance to a Plaza Accord? How many kilometers are we from the discussion of a new Plaza Accord?
I think we are quite far away from any discussion of that. So far, the move seems to be gradual. It's not disruptive. It seems to reflect that the U.S. economy is holding up better than expected, whereas the Eurozone is kind of in stagnation. So as long as the currency moves gradually and does not seem to be fully out of kilter with fundamentals, I don't think we need a massive intervention. Come next year, with the European economy picking up again, the Fed cutting rates sometime next year, and the ECB possibly not cutting rates, the euro will likely recover on its own.
This is really, really important, because a key thing there you said was we are not disruptive right now. Market participants feel we're disruptive. We were making jokes about a quinfecta, 5 different things we're bouncing off of right now. What is the best policy prescription for Lagarde and government leaders in Brussels?
I think it's basically now stay the course. For monetary policy, okay, I think we've tightened a bit more than we should have, But now the fairly clear message is we are probably at the peak, which has actually been, when it came out, been sort of reassuring for markets. And for fiscal policy, I would say the same, stay the course, which largely means we have a big fiscal program in Europe, this Next-Gen EU program, which is now above 800 billion. The task is more to make sure the money is being spent, that is the rollout of the program, rather than thinking about any new money.
Is Jerome Powell central banker to the world? Is Jerome Powell, whether we want to admit it or not, central banker to Europe?
Not quite. Europe is not that dependent on the US to really say so. For Europe, it really is Madame Lagarde, the central banker, that we are glad to watch.
Do you think that people are too bearish in Europe? Is that basically what I'm hearing from you?
Not for the next few months. We are having a sharp inventory correction in manufacturing. We talked about China. The US economy near term will probably be slowing down. So near term, trade export dependent Europe is having trouble. But come next year, global manufacturing will pick up. The inventory correction will be over. Next year, I think Europe could actually surprise here and there a bit on the upside.
Will some of this slowdown and surprising negativity in Europe correct inflation?
Our inflation doesn't have that much to do with domestic demand, a bit. Inflation is coming down largely because this big Putin shock on energy and food prices is largely fading. We have a bit of wage inflation to pass through for the next half year, but all in all, inflation in Europe is heading to probably around 2.5% by the second half of next year.
Okay, but this to me is really the dilemma, right? If it's not going to really lead to low inflation, if we're facing a stagflationary type of environment in Europe, how much is that the template that we're basically being forced to live with higher inflation, even with taking the pain of de-risking, even with taking the pain of recession, even with all of the other toxic brew of the quinfecta that we're talking about this morning?
Well, stagflation is a description as to where we are now probably in Europe. We may see later this week already a fall in this inflation rate year over year into the 4% handle from a 5% handle, basically on base effects. And again, the big rise in energy, especially gas and electricity prices late last year, drops out of the comparison. Goods prices are stabilizing. I think that even without needing to constrain demand further, inflation will fall to around 2.5% by the second half of next year on its own.
I look, Holger, at our trip to London, and I look back on how Europeans, the United Kingdom, how they perceive an America in disarray. How's it different this time?
Well, it is a weird perception. On the one hand, we marvel that the US economy is holding up better than expected despite the massive Fed rate hikes. But we find reasons for that. Yes, consumers and companies had good money to start with, yeah? But when we look at anything that comes close to US politics, we basically shake our heads. Right. How is this going to end? Was there another talk of a government shutdown?
Yeah,
We've had that so often, it's kind of ouch. By those standards, we think European politics, especially the ones in Brussels, actually, are not working badly.
It's running like a Swiss watch. Good luck leaving JFK. Holger Schmieding, thank you so much, with Berenberg. And on that tune, Greg Vellier publishes this morning. He's been such a support of Bloomberg surveillance. And Lisa, it's really simple. He frames out the McCarthy options, and Vellier says this could be a crisis, quote, well into winter. I find that sobering.
It's one of ideology more than practicality, and that is something that people have talked about, because even if some of the desires of the holdouts goes into effect, the deficit is only going to decline slightly because it's really just a small package of cuts, not affecting Social Security payments and some of the other major elephants in the room that a lot of lawmakers say need eventually to be dealt with.
I mean, it's as Churchill said in St. Louis a few years ago, somehow we get through it all and get it done. Where will we be October 2nd? Where will we be October 3rd? It's going to be interesting to see, to say the least. You see the poll this weekend?
Which one?
Washington Post, ABC.
Which one?
They've got Trump 80% ahead of Biden, or whatever the number is. And it was such an odd poll. It speaks to modern polling. I think we've been very good about being suspect about that. That even ABC Washington Post came out and said, we're really not sure about our polling.
Honestly, I think it's so early. I feel like I'm channeling Tom Keene. So early. How can we know anything from these polls? I'm really curious to see who's going to actually be in the running. I mean, to me, the bigger question is going to be, you know, do you end up with the Virginia governor as the front leader of the Republican Party? Do you end up with a different candidate for the Democrats that comes to the fore? I think that's increasingly the discussion of, is this really the field that's going to make it to the end?
Into the Republican debate, I believe it's Wednesday. We'll have coverage of that across all of Bloomberg as well. Futures, well, there was a tone here hours ago that they were up, and then they were down off of China news. We'll get to that. Futures -6 right now. Dow futures at -35. VIX getting out to an 18 level. That's important. 17.98. The VIX, you know, 14, 13. Life is good, and we ease back. We'll do the drawdown for you here in a bit, but 2.12% on the 10-year yield permeates the American financial experiment. That'll be interesting to watch. Brent crude, 93.44, up fractionally this morning. Gold, 19.43 the ounce. Lisa Abramowitz and Tom Keene, Jonathan Farrow on assignment. It was a draw. This is Bloomberg. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1, so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike.
Sean Fain, inch by inch, mile by mile, factory line by factory line, leading a strike at the UAW. Sean Fain, president of the UAW. That on Friday, which seems distant, on Stellantis and General Motors as well. Lisa, this is for real.
38 new plants, none of them being Fords. What did Ford do right that GM and Stellantis are
what
failing
they did
to do?
right is they agreed to negotiate. They walked in the room in Dearborn and they said, we're different. And I would also point out they didn't go bankrupt, which I think is a heritage issue here on a seismic shift to the UAW of the time of Steve Ratner, the car czar, and the restructuring of American manufacturing. All of that's great. Quick market check here. We did one before. Why do one now? 2.12% on the 10-year yield. That's a huge deal on the real yield. That's life-changing for all of us. 93.53 on Brent crude. I got a little bit of red on the screen. The VIX nearing 18 level. There's some tension in your markets on Monday morning. Right now, joining us, following us across the Atlantic Ocean, Lisa had the Gulf Stream. Craig Trudell and I had to fly conventional. That was a nightmare. Joining us now, running all of our auto coverage, Mr. Trudell, of course, in Bloomberg, on his way to Detroit. I want to rip up all the discussion about the strike and understand that Eisenhower or Kennedy or LBJ didn't join the picket line. To me, this is a huge deal. Biden will picket. Am I wrong?
There's been a lot of question about that, and I think the fact that the UAW went from being in no hurry to invite him to inviting him is really fascinating, and the fact that when it surfaced that Trump had plans to go visit workers, the union very clearly gave him a sort of brushing off and a sort of you're not welcome here message. So the politicization of everything is coming to cars in ways we haven't seen before.
Is Gina Raimondo, the Secretary of Commerce, a governor of hugely labor-centric Rhode Island, is she going to drop by Dearborn and have a Nescafe or a Sanka? What is the Secretary of Commerce? How does she respond to her president?
Well, it will be interesting sort of where the lines are drawn here. I do think, at the sort of factory level, we have our reporters in Detroit have been speaking with workers on the picket lines about their sort of level of comfort or lack thereof with Biden joining them in these actions. I think they are a little bit wary of Biden because of what happened with the rail strikes, the fact that he sort of inserted himself there. That being said, this is a president who, calls himself the most pro-union president in history, absolutely has made no bones about the fact that he wants to get behind the labor movement in the U.S. And absolutely is sort of, putting money where his mouth is in terms of, freeing up IRA funds, the way that he was trying to structure that law before it was passed to actually benefit union-made EVs. He wasn't able to get that done, but nevertheless is, very much going out of his way to boost labor in the U.S. in the auto sector.
Let's build on that. There was a really awkward moment on Face the Nation over the weekend with Alexandria Ocasio-Cortez, the representative from New York who bought a Tesla during the pandemic and had to talk about how it wasn't union-made and try to square this circle that the Democrats are kind of facing, which is they want to put forward electric vehicles, but it's not benefiting some of the constituents that they want to really say they represent. How much do you feel that angst and reconsideration in the policies that you hear out of the White House?
I think it's really interesting the fact that Ocasio-Cortez, by the way, I should mention, has said before that she was looking to trade in her Tesla. So I think this is a sort of long in the works sort of move away from Elon Musk on the part of some members of Congress in Washington. But absolutely, it's the case that the union was not making a ton of electric vehicles until very recently, and for the most part, the cars that they are making that are electric are on the higher end side. Cadillacs and big pickups and pretty expensive vehicles that you wouldn't necessarily see foresee an AOC in necessarily. I think we're going to see that change in the next few years in a pretty significant way. Maybe the lone exception in terms of the Detroit 3 making a sort of cheap electric vehicle has been the Chevrolet Bolt, and they haven't really made those in very significant numbers, in part because the demand has not necessarily been there. But we're seeing a huge movement on the part of General Motors and Ford in particular to try and move down the price scale and bring electric vehicles to more of a mass market and follow Tesla into that.
Let me put it this way. How much is President Biden considering doing what Rishi Sunak did last week? This idea of pulling back from some of the more ambitious goals to roll out electric vehicles in the United States?
I think it's more of a case of the U.S. I do think we have to sort of, call strikes here. The U.S. is far behind in making the electric vehicle transition that Europe has been making for several years now. There's a lot of concern in Europe lately about the fact that the IRA is really, going to make an effort to significantly change that. You want to talk about anti-subsidy investigations that the EU just launched against China. The amount of money flowing into this sector, not only on the consumer side, obviously there's a lot of attention on $7,500, but a lot into the manufacturing sector, and that's leading to huge investments. And so there's a real effort to play catch up here, and for the unions to sort of come along in that journey.
I want to make clear, folks, this is the Bloomberg Advantage. We've got the team, Keith Naughton and all in Detroit. They're not in speaking terms with Trudell, but that's a different story. We've got Craig in London looking at the global EV market. And what I learned in London, way ahead of us on all this chit-chat in Europe and China, is that we've got China, 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 and we go back to Don McLean, American Pie, and we got a Chevy going over the levee, but the levee's dry. Not good. Okay, so what does Chevy do over the levee to compete against China? That's the heart of the matter.
I do think that one of the interesting things that we're seeing is an attempt to kind of, go from a global industry to kind of battening down the hatches and bringing manufacturing to regions.
Come on, stop. Let's cut to the chase. Are we going to build American non-union EVs in South Carolina, or are we going to try to build a $40,000 fake cheap EV in Dearborn?
I think we're going to try and build a lot of Chevys in General Motors plants that have been making combustion engine cars. I think we're also going to see new plants go up in the South, interestingly, from some of these Detroit companies. So you see Ford making big investments in Tennessee and Kentucky. That is the big question and the big rub of these union negotiations.
Is that in the negotiations right now?
I think in terms of the electric pickup that they're going to make in the South, I would be shocked if that isn't a unionized plant.
Lisa.
But in terms of the battery manufacturing, that is the big rub, because these are joint ventures between Ford, General Motors, and Stellantis, and companies that are not necessarily unionized and have little desire to be unionized.
And down in the South, when they're doing union or non-union, they'll be drinking whiskey and rum.
Okay, can I just tell you, my favorite part of every day is when you ask a question like that, and then the guest has to answer completely seriously without laughing, and with you about to break into song.
Where this started?
Seriously, that's my favorite part of the day.
We could do this with Craig. Craig has been a huge value add for us. I'll take 30 seconds here. Lisa, jump in here when I'm talking too much. We're in radio. We're inventing Bloomberg surveillance with John Farrell. That in itself was overtime at work. And I started, he's going on about Africa or something. And I started in with the lyrics of Toto. And John's looking at me like, what have I got myself? Go.
Well, honestly, it's just my favorite. I just want to finish up with, how close are we to some sort of resolution? Are we hunkering down for this lasting a very long time?
I think we got a positive message from Sean Fain last week about some progress on the part of Ford and the union, but I don't think that we necessarily have the details from his comments to really have a strong sense of just how close the union and this company are. My bet is that that this will continue probably for several more weeks, and the folks in Dearborn are just hoping that we don't see any setbacks and sort of feeling of bad faith on the part of the union that not only prolongs this strike, but results in the union adding additional Ford plants to the strike.
For fossils like me, it's simple. This Biden walking the picket line is just stunning.
It hasn't been seen for more than 100
I wonder
years.
if I'm overplaying this or underplaying this. No question.
We don't know if he's going to be doing that, though, yet at this point.
Oh, we don't know
We
yet.
don't know if he's going to be walking the picket line.
Oh, I thought
he
we
will
did know
be
that.
there addressing them, right? We don't know.
I was just going to say in Dearborn, I hear the drums echoing tonight.
Okay, honestly, I mean, you're like the Chevy to the levee, but the levee is dry. Craig, what do you think about the levee being
Did you
dry?
see Don
Craig has to
McLean
answer
playing
completely
with Toto?
seriously.
Look how great.
dear Lord.
Futures to -2. The group says, everybody put a cork in it. Stay with us, I
Don't
hope.
change.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
To digest higher rates for longer will take time.
I don't think rates need to go any further than where they are today.
It's not so much the level of the rates that's the problem, it's the adjustment.
What's going on in markets is quite different to what's going on in the real economy.
The economic soft landing narrative is definitely being challenged.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance on radio and television. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. John Farrow on assignment after a 2-2 draw at Arsenal Tottenham. I watched the highlights.
I did too, actually. I was trying to make sure I kept up.
Very good. Farrow recovering from that. We hope to see him maybe tomorrow because the Gulf Stream's over here. So, I think maybe
Okay,
Wednesday.
hold on. Let's just make this real clear right here.
Yeah.
I do not take a Gulfstream or a private plane because people have actually stopped me and said, why are you not on a private plane? I have never taken a private plane before in my life, but carry on.
I was stopped in Heathrow about Lisa on the Gulfstream and said, well, the Bombardier we're looking at, but we just don't think we can pull that off. Futures are -1, Dow futures -14. You're waking up on a Monday to a changed world. Bramo nails it with a quinfecta. IDF 5 or things in a swirl. Let's go to something we haven't talked about yet with the real yield up to new highs, new generational highs, 2.11%. China, the developers, that story unravels to the point I think I can say there's no bid in the market because there's no market.
There is a feeling that something could happen where there could be a real default and suddenly there is a difficult scenario that the government can't control or is unwilling to control in a meaningful way. We talk about the quinfecta, and that includes real yields. It also includes the auto strikes. It also includes a government shutdown. It also includes this idea of higher gas prices at a time where oil prices are rising yet again today. And you put that together, and it's very hard to see how any of them, yes, maybe in isolation, not that significant. You put them together, it feels different.
It's like Craig Trudell and the EV vehicles. Well, who cares? Nobody can afford them but the rich people. I'm going to look at the housing market where nobody can afford to do housing except the rich people. And while you and I were sojourning in London, I thought, I wasn't in Mayfair. I was west of Mayfair a little bit looking at a closet. Bank rate 30, 7.75%, rounded up. How close are we getting to an 8% mortgage.
At a time where perhaps not a lot of people are paying for them, for that kind of mortgage rate, because you can see that the housing market's basically broken. On the other hand, it highlights how expensive things are getting. Mark Zandy of Moody's over the weekend put this out.
Yes,
and he said it costs $734 more each month. That is thousands of dollars a year each month to buy the same goods and services as it did 2 years ago for the average median household in the United States. You start looking at that, you understand some of the dissatisfaction. You understand why people are less concerned about the pace of the disinflation and are still looking at just outright inflation and making a lot more discretionary choices with their buying.
We've got a guest on this in the market dynamics. If you're part of Global Wall Street, Catherine Kaminsky will join us here in a moment. Shall we brief?
Let's brief, because this has to do with the entire week ahead and really framing out this discussion of real yields climbing to the highest levels or about the highest levels since 2009. 7 Fed speakers. Tom is on the edge of his seat waiting to hear them all. Minneapolis Fed President Neil Kashkari, that is today at 6 p.m. Fed Governor Michelle Bowen tomorrow. Thursday, the Fed Bonanza. Fed Chair Jay Powell, Fed Governor Lisa Cook, Chicago Fed President Oscar Goolsbee, Richmond Fed President Tom Barkin on Friday. We hear from New York Federal Reserve President John Williams. Really key to hear anything on real yields. Earnings, and this to me, it kind of speaks to the same story, Tom. How much do people keep buying if you get their overall expenses continuing to climb? We get earnings on Tuesday from Costco, Wednesday H&M, Thursday is Nike. How much are we looking at a new pressure on consumer discretionary that start feeling it first?
This is nominal. Sales of all this is done in nominal, including Mike McKee's retail sales number. And I usually don't pay attention to this, and I think you're dead on. This time around, the retail pulse is a huge precursor to what we see beginning October 13th with J.P. Morgan.
Anecdotally, we hear people pulling back. When do we start to see that in the granular earnings data on the overall economic data? Yeah, exactly. Again, it's just why would people spend that if they're spending so much on everything else? Economic data this week, home price data, as well as the new home sales that comes out tomorrow. I'm curious if anything's moving, considering the fact that this is basically a broken market. Jobless claims Thursday. And to me, the key day of the week is Friday. Personal income and spending, as well as core PCE data. Again, how much do we see the economic surprises continue to inflect upward in a U.S. that is seeing this quinfecta of threats, this toxic brew of feeling that maybe it's getting difficult. Hexfecta? What's that?
Six.
Yeah?
7.
What do you think Hexfecta says? Like what?
You know.
Vet Bill having a martini?
Yeah. No, we didn't have that. But, you know, again, he has the olives. We've cut them off. You know, they're trying to cut me off, too. I'm going to focus on the VIX 17.84. If you're part of Global Wall Street, arguably this is the conversation of the day. Catherine Kaminsky, and the title's boring, Chief Research Strategist at Alpha Simplex. But far more importantly, out of the Andrew Lowe Combine in MIT Boston, is trend-based. She and her shop follow trends in the probability of coming out of a range into some trend across all assets like nobody on the street. Katie Kaminsky to brief us this morning. Katie, I'm going to be honest here. You correlate across some bonds, economics and all that, over to equity markets where you are more than tentative. Tell us about the repricing that we could see in the equity markets.
Good point. Okay, so this year what we've really seen is that the equity market has been disjointed from the fixed income market. So it's been blissfully going along relatively positively, ignoring the fact that there might be some issues and we might need to have higher rates for longer. We feel like last week we finally saw a point of recognition. We saw a breakout in the fixed income market where we saw yields higher significantly on the long end. What this means is the market has really finally said, wait a minute, these upside risks are real. Like higher energy prices, that's a challenge. I mean, these things have to be solved for the equity market to waver through this.
And now we go where the pros fear to tread. Wells Wilder, 1978, with Katie Kaminsky. Katie, cut to the chase. There's a green equity feel of up, 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 and a red down, down, down from Wells Wilder called ADX-DMI. It's a toxic soup of calculus as well. What are you learning right now from a broader S&P or NASDAQ 100 ADX-DMI available only on the Bloomberg terminal?
Well, if you look at most of the technical signals right now, they all are pretty consistent. The equity has been relatively positive, but a little more tentative recently. But if you look at fixed income, I mean, let's be honest, fixed income is actually set to have 2 years in a row of negative returns. And fixed income signals have been consistently short for months and working well, particularly this month. We've seen energy breaking out more recently, and then we've seen in the currency basket, we've seen the dollar trade also being one of the stronger ones in the last 2 months. So we're really seeing last year repeating itself.
So is that what you're leaning into? I mean, that's my question is, are you basically doubling down on your bond bear thesis and doubling down also on oil prices going higher, or are you seeing this starting to reach a topping point that makes you pull back?
This is a good question, Lisa, because we're not really in the business of picking tops and bottoms. But what we are doing is following where market themes are moving and what people are actually doing. And what people have been doing all year, which has confused me, is sold bonds but said that they liked them. So it's really sort of this weird dichotomy. And so what we're seeing as well is we're seeing continued acceleration in the bond market on the short side, not more than before. So I wouldn't say that we're seeing more short positions. We're just seeing a consistent view. Although we've seen somewhat of a bottom at the short end of the curve. So remember earlier this year, we saw the short end of the curve bottom to some degree. We've been looking for more of a bottom on the long end of the curve. So when are long-term rates going to sell off, or long-term bonds? And that's exactly what we saw last week. And that was our point of recognition, where the market said, wait a minute, you're right. Maybe we have to be higher for longer and we need to disinvert the curve. And that's finally starting to happen.
Katie, I was struck by maybe people capitulate just ahead of the market actually turning their way or the economy turning their way. And it feels like a market that wants to inflict the most pain on the greatest number of people, as markets are wont to do. It feels like things are turning on the edges in ways that might challenge the bond bear thesis and how high yields can go. So is this a point where you start to reassess, this is the capitulation moment where things can start to normalize in a more significant way? How much are you leaning into that?
So what's interesting is we did a study last year. We studied the short bond trade. And empirically, if you look over different cycles of the markets, during inverted yield curves, trend signals tend to work very well being short fixed income. During a flatter yield curve, it becomes more mixed. And as we see a steeper yield curve, then we tend to lean more into longer positions. So that's something we've been kind of monitoring and thinking about over the last year, is this concept of we need to find that inflection point. And since we now have a much flatter yield, look at that 10-year today. It's close to 4.5. That's pretty flat. And so as we see that flattening and disinversion, that means that we're going to see more of that inflection point closer to the bottom of the bond market.
What you just heard there, folks, is gospel from Katie Kaminsky. I can't say enough about disinversion and the point of a tip point, if you will, an emotional point. To pick up on that, Katie, I'm looking at the Bloomberg Total Return Treasury Index. You know it. We're back to 2016 pricing. You mentioned 2 years of negative return in the bond market. For the pros out there, on bills, on notes, on bonds, do they have gamma-like equities? Is there an emotion there where if we break through certain support levels on price, go lower in price, higher in yield, that you get so-called gamma or the emotion, get me out?